Good afternoon, everyone. I'm Natalie Brunell, author of Bitcoin is for Everyone, and I'm honored to be here with all of you. If you've been to Strategy World and Bitcoin for Corporations before, then you know that this isn't just another conference. This is where the leaders putting Bitcoin on their balance sheets come together not to catch up, but to push forward. And that brings us to our keynote. Agree with him or challenge him, there is one thing you cannot deny about our next speaker. Founder and executive chairman Michael Saylor doesn't borrow his beliefs from the room. He brings them into the room. For more than 3 decades, he's been a builder at the highest level, taking a startup and turning it into a category-defining enterprise. But over the last few years, he's done something even more rare in corporate history. He's led a public company through this era of monetary uncertainty by making a decision that was radical and to many unthinkable at the time. He chose a new foundation, not as a trade, not as a headline, but as a strategy. And he didn't stop there. Through the introduction of innovative digital credit instruments, he showed the world that Bitcoin isn't just an asset you hold. It's a way to unlock capital, give every investor a seat at the Bitcoin table, and redefine what corporate treasury can be. The results have forced the world to pay attention, because in an environment where most leaders are just trained to optimize for quarters, Michael Saylor has the courage to think in decades. He has a gift for taking big, complex ideas, money, energy, technology, freedom, and turn them into something you can feel in your bones, a call to build something that lasts. He will challenge you. He will entertain you. He'll drop a line you'll repeat at dinner tonight, and maybe quote for the next 10 years. So if you're taking notes today, here's my suggestion. Don't just listen for what he thinks Bitcoin is. Listen for what he believes your company can become when you stop optimizing for short-term comfort and start optimizing for long-term strength. Ladies and gentlemen, please welcome the founder and executive chairman of strategy, one of the most visionary voices in modern finance and technology, Michael Saylor.
Thanks for joining me today. This talk is about everybody's favorite subject. I'm going to speak with you about how to make money. Literally, how to make money. How to make money for your family, for yourself, for your company, for your public company, for your country, for everything you love. And specifically, I'm going to talk about how to make money digitally. And the title of the talk is Digital Credit, but really, this is about a revolution in the way we think about money. So let's just start with the subject of digital credit. You know, what is digital credit? Well, digital credit is built on digital capital. Well, digital capital is Bitcoin. How do we create Bitcoin? Well, we put together a bunch of technologies that were available, proof of work, public key cryptography, peer-to-peer networking, distributed timestamping, some semiconductor technology. And of course, the fundamental question is, what is Bitcoin? And people debate this ad infinitum, but it just seems quite obvious. It is digital capital. What is digital capital? Well, it's economic wealth stored digitally. What is economic wealth stored digitally? It's the ability to move something of value somewhere else on Earth over a digital rail, right? People oftentimes ask, well, what's the use case? What's the value? Well, the value is if I can send $1 billion from here to Tokyo, that's valuable. Try taking $1 billion of land out of Tokyo. Try to take $1 billion of gold out of Tokyo. Try to remove $1 billion worth of companies from Tokyo, or $1 billion of mineral or oil and gas rights from Tokyo. You just can't do it. On the other hand, you can move $1 billion of Bitcoin into and out of Tokyo. And if you can do it, a computer can do it, and AI can do it. And so it seems very straightforward in the world of digital, that if everything we've got that's digital is better, whether it's digital photos or digital music or digital video or digital communications or digital intelligence, then when we finally have digital wealth, digital capital, it will be the basis of something that is extraordinary and beautiful. And Satoshi gave us this. The truth is, there's nothing deeply complicated about it. It's just putting together, it's an engineering breakthrough, putting together a bunch of techniques that were readily available and well-known in the day. It was the way that it was used that was an extraordinary breakthrough. Digital credit is very similar. There's nothing deeply complicated about this. What we're doing is we're taking a common thing, a publicly listed company, a public security, a capital asset, a digital capital asset in this case, a preferred security, the idea of a monthly dividend that's variable, and a tax treatment, return of capital, that's been around since 1910, and then an ATM actively managed. And you put together all of these components, no one of them is all that difficult. You pretty much could understand them if you're a sixth grader. You put all of them together, and you create something which is much more than the sum of its parts. You've created an extraordinary breakthrough in the entire world of credit. We call it Stretch, STRC. What is our company doing? What does strategy do? Our company is converting capital into credit. We're converting economic wealth into a stream of cash flows. That is the big breakthrough. You need an operating company in order to take a block of economic energy and turn it into a currency, peg it to a currency, strip away the risk, damp the volatility, extract the cash flows in the form of yield, and compress the duration to now. I don't want to wait 30 years to get rich. I just want you to give me money every month or every day forever, consistently, without risk. The former, right, is a capital investment. I buy a big chunk of Manhattan and I wait 30 years and maybe I get rich. The latter is a bond, or is it a money market account? So this is all about conversion of capital into credit. And you might wonder, well, how did we discover stretch? Sometimes people ask us this, and this is the most poorly understood concept. Most people don't really think deeply about capital at the first order. But STRC is at the end of a long journey. I oftentimes say, we got a PhD in leverage at strategy. Well, let's just start with a basic question. How do I raise the capital to invest? If I want to invest in real estate for 40 years, where's the capital come from? If I want to buy gold and hold it for 40 years, where do I get the capital? If I want to buy Bitcoin and hold it for 40 years, where do I get the capital? Well, I'm going to tell you the easiest place to get the capital, and it's the worst place. It's an exchange. You go onto an exchange and you use exchange leverage. So I post $100 and I do a 50x levered Bitcoin buy. And when you lever up 10 to 1 on an exchange, they loan you $1,000 of capital against your $100. And when you lever up 50 to 1, they loan you $5,000 of capital, right? And of course, that's DeFi, that's crypto. People think this is a wonderful thing. If you look at my chart, you can see exchange leverage is 1 hour capital. If you think about the credit terms, the risk factors, the covenants on the credit, and the optionality that you have for the credit when you enter into the relationship, and you ask the question, how long do I have the use of this capital on a probabilistic basis? Well, the engineer would say that's the stochastic duration of the capital. What is the stochastic, the likely time frame I have the use of the money for? Well, on an exchange, you might have that money for an hour. If you lever up 50 to 1 and Bitcoin trades down 2%, you're going to get margin called. They force liquidate you, and you get all your capital ripped away in an hour. So on one extreme is very short duration capital. What's the next big idea? Well, I do a margin loan. I borrow the money under Reg T, or I do asset-backed financing. I borrow against my Bitcoin or borrow against a stock or an asset. How long do you have the capital for? Well, when you get the margin call, you've got no more than a day. You might have 4 hours. But that's about 1 day capital. That's like repo financing. When you read the history of long-term capital's bankruptcy or Lehman Brothers bankruptcy, the reason they're bankrupted is they were financing 100 billion or hundreds of billions of dollars of long-term investments with 1 day money. Right? Okay, you invest the money for 10 years and you have the use of the capital for 1 day, and you think, what could go wrong? Okay, that's a duration mismatch. Well, we had some of that. We had a Silvergate loan where we actually borrowed from Silvergate, and when Bitcoin crashed, you have to post more collateral. That creates extreme anxiety for your equity investors. It's reflexive. It'll unwind your company. That's why it's not a great idea to do asset-backed financing. The next idea is senior debt. You go and you borrow money from a bank, or you borrow money via a bond that has covenants. Well, I've actually marked it stochastically as about 1 year money. And you're like, well, if it's a 5-year loan, why do you think of it as 1 year money? Well, the term is 5 years. The covenants are checked every quarter. You might get to the end of the quarter where you break the EBITDA covenant or break a lien of some sort, at which point either the loan comes due, it accelerates, or the covenant prevents you from accessing the capital markets anymore. So you have lost the ability to raise additional capital because you tripped over a covenant. That means in order to grow the company, you have to pay off the loan. So you thought you had you have a 7-year loan, but you have to pay it off in order to raise any more money if your EBITDA ever falls by 2%. So it's kind of a banker trick where I pretend I'm giving you a 7-year loan, but it's really a 7-week loan because I know you're going to have to continuously refinance it. So senior debt is actually stochastically much shorter duration than you would think. Junior debt is like a junk bond with no covenants. You've just got a big interest bill, and so you've got it a bit longer, but it's still very expensive. Convertible debt is a bit longer because you've got a very low coupon. Maybe you've got a 0 coupon or 1% coupon convertible debt. You can carry it for 5 or 6 years, but eventually you have to pay it back. So convertible debt is a little bit longer duration on a probabilistic basis. But as you can see, as we march through these debt capital, we find something better. If you ever credit default, if you default on your interest bill, if you can't refinance, or if you bust a covenant, you lose the capital. In the extreme case, the equity goes to 0. The company's bankrupt, right? That's very dangerous, if not toxic capital. When you get to equity, right, if you look at a senior preferred like STRF, well, you have the money for a while, but you've got covenants and you've got penalties if you don't pay the dividend, so it's a little bit longer. But it's better than debt, but it's not as good as junior prefs. The junior pref doesn't have the covenants, so you've got more optionality, fewer covenants, longer capital. The convertible prefs have a lower cost, fewer covenants, longer capital. And then when you get to a variable preferred, what's going on is the optionality is exploding. You're getting more optionality. You don't have the option to vary the coupon of a bond, but you do have the option to vary a monthly dividend. So as the optionality explodes, the duration lengthens. And so of course, the last form of capital is equity. I sell $10 million of equity, I have the money forever. Well, from a net present value point of view, that means I've got economic benefit for about the next 100 years before the benefit becomes third order. So if you look at the table, you can see if you want to invest for a long period of time, you'd really like to use equity. But if you can't get the equity, what's the next best thing? Well, it's variable preferred credit. We discovered digital credit and stretch because we kept moving out this curve of risk, and we found what we thought was the longest duration capital other than equity. Now, what is digital credit? It's solving the investor dilemma. The dilemma of the investor is I either get double-digit returns and I get deferred tax treatment on equity, and I take large volatility, large drawdowns, and I might lose my capital. Or I buy credit where I have principal protection, low volatility, but I lose the double-digit returns, and I have to pay ordinary income tax, or I have to pay capital gains tax every time I receive anything in that year. So what if you wanted the benefits of equity and the benefits of credit, and you wanted to get rid of all the liabilities of both? What we did with STRC was created this instrument which gives double-digit returns, deferred capital gains tax treatment, low volatility, principal protection, all at the same time, right? And that's the big unlock there, right? You don't have to make a compromise. And who's it designed for? Well, it's definitely designed for retail investors. It's also designed for corporations, but you can also offer it to an institutional investor, a hybrid investor, or a crypto-native investor. So there's lots of different classes of investors that might want this. In the process of building the longest duration credit, we inadvertently discovered that all of the dividends for that credit are return of capital dividends. There are 3 types of ways to tax credit. You either tax it as ordinary income, and you got to pay income tax up front, or it's taxed as capital gains, or it's taxed as a deferred return of capital. You don't have a tax on it. Well, in order to create return of capital, you have to have a treasury company that doesn't have positive earnings and profit that would create a tax liability that you'd have to pass on to your credit investors. So what we discovered was we could create credit where the tax benefits go directly to the credit investors instead of accruing to the issuer. And because as an issuer, we don't actually generate taxable cash flows, we don't need the tax benefit. Most credit created by companies was always to the benefit of the issuer, to the detriment of the investor. And we stumbled upon a new idea. What if we created credit which was the benefit of the investor? The best credit. The credit becomes the product, not the means to the product, right? Well, so you create this, and now the issue is, how do I assess the digital credit? What's the mathematical framework for assessing credit risk? And really, we created 3 metrics. BTC rating is the amount of collateral coverage. Like if you're BTC rated 5, it means you got $5 of equity for every dollar of credit outstanding. BTC risk is the probability that you get under collateralized at the end of the term. If you have $5 today, will you have only $1 of collateral at the end of the term of the credit, to pay it back if you had to pay it back? And then if you calculate that BTC risk, you can back into a credit spread. What is the fair credit spread above the risk-free rate that you have to pay the investor to offset the risk, right? So there are simple formulas here for people that like formulas, but maybe the bigger point is the credit spread of investment-grade bonds today is 78 basis points. That means you're getting paid 0.75% more than the risk-free rate in order to take the credit risk of a company like Apple or Microsoft. The credit spread of junk bonds, or high yield, I guess, is 288 basis points. So those are the 2 benchmarks worth looking at. And now we move to the theory of asset-backed credit. What is it? Well, the idea is I buy a capital asset that's going to return 30%, and I strip off the first 11%, and I pay it to the credit investors. Maybe I buy the S&P index, I expect to pay 12%, I strip off the first 6%, and I pay it to the credit investors. If gold is going to appreciate 10% a year, I could create a preferred instrument that pays 5% a year and pay that to the credit investors. So, logic says you're not going to pay a dividend greater than the return of the capital asset over 100 years. That you're going to eventually run out of collateral. But you can certainly pay a dividend rate lower than the ARR of the capital asset. And that takes us to the question of what's really going on here. It's signal processing. Okay, digital capital is highly volatile, growing in a rate. If you look at that chart, that orange line kind of looks like the Bitcoin price chart if you've looked at it over the past 10 years. It's doing this. The credit line is what most people want. People don't want to get rich suddenly in the distant future, unexpectedly, after a roller coaster ride. What they want is to get risk steadily with very, very low volatility, no anxiety. They don't want the fighter jet, they want the jumbo jet airliner, and they want to recline in first class while they go to their destination. So digital credit is just stripping out that smooth 11% out of that very volatile 30%. Now, where does the excess volatility go? There's a conservation of energy. Conservation of volatility. So if you want to take a 30% roller coaster ride and strip it down to 11% jumbo jet luxury ride, then you have to put the volatility somewhere else. So what you can see is the excess volatility goes to common equity. And what I've just shown you is basically digital equity, digital capital, digital credit. It's completely digital stack. It's changing every 15 seconds. In our case, the equity is MSTR. It's up 52% ARR. The capital is Bitcoin. We expect to be up 30%. The credit is the STRC. Now, what's the highest yield you can pay on digital credit? Well, if you expected 30%, then you have to plug in the collateral coverage. What's the BTC rating? What's the duration? What's the volatility? Once you plug in your assumptions, what pops out is, well, in this case, I can pay 15% and still stay investment grade. On that assumption set. You go up to 23% and you're still in high yield. But there is an envelope of dividends you can pay out, or a dividend ratio you can pay out, that's just a function of the volatility and the performance of the underlying capital asset. So what's this chart show? This chart shows if you're a skeptic and you think Bitcoin's going up zero, there's a very small amount of credit you can create. And most of it is low dividend yielding. And a little bit of it is 5 to 10%, and a very small amount is more than 10%. If you think Bitcoin's going up 10% a year like the S&P, you see you can issue a lot more credit, and you can have a bit more flexibility on the dividends. As your view of the capital asset, whether it's gold or Bitcoin or real estate or the S&P or whatever, as your view of that improves, as you think it's going to improve over time, your ability to issue credit and higher yielding credit is enhanced. And you can see what's going on here. If you're a bull and you think Bitcoin's going up 30% a year, you can see you can issue quite a lot of high yielding credit that is investment grade. That's the big idea here if you're staring at this. And of course, if you think about high yield, right, you're willing to accept a slightly higher risk instrument, then you can create a lot more credit. You can create exceptional amounts of credit if you think Bitcoin's going to appreciate faster than the S&P. And of course, if you're a Bitcoin bull, you can see you can issue monstrous amounts of credit, even 1x collateralized at this level, right? And so the amount of credit you can create is really a function of those variables. Now, so how risky is STRC? What is stretch? Well, I put it on the chart. If you're a Bitcoin skeptic and you think Bitcoin's going up zero, it looks like distressed debt. If you think Bitcoin's, a 10% grower, it's almost high yield. It's like kind of suboptimal high yield. But then as you start to have a better view of Bitcoin, it starts to float into the high yield. And then, of course, if you're a Bitcoin bull, it's investment grade. And so what I've laid out here, we call the theory of digital credit, but really it's just the theory of asset-backed credit. You could do the same exercise with the S&P index, Mag 7 stocks, NVIDIA stock, gold, real estate. Now, why haven't people? Well, because the Investment Company Act of 1940 prevents you from levering or capitalizing a publicly traded company on equity portfolio or securities. So no one does this in the public market on securities. You'd have to go to gold or real estate, and the performance in gold and real estate has just been not compelling enough to be worth the trouble. Bitcoin is the first time when you have a non-security asset which is outperforming the S&P where it's worth the trouble. And that takes us to the question of, well, what's the performance of this stuff anyway? Well, since the all-time high 4.5 months ago, Bitcoin's fallen 45%. That's the capital investment. If you're a capital investor, you got no dividends and you lost 45% of your wealth. Just wait for 10 years, you'll be fine. I'm okay with it, but your 3-year-old's not okay with it. On the other hand, look at STRC, right? STRC is for everybody else. It's actually lost 0% of its value. It's paid 4.5% in dividends through a very big capital market drawdown. Since the beginning of the year, same story. STRC holds its value and pays a dividend. Bitcoin's down 25%. Do people want this stuff? Well, it's trading 130x more liquid than the average preferred stock and 1,000 times more liquid than the over-the-counter preferreds. This is, in fact, the most successful, most liquid preferred stock probably in the entire century. Okay, and this is 6 months old, right? And I would love to tell you we knew what we were doing, but what I just showed you was we were running from risk, from credit risk, until we got to prefs, and then we were chasing after the ideal product until we got to stretch. And so at the end of our journey, after trying 10 different things, we found the 11th thing, and then the market told us they liked this. We didn't know that they'd like this. Stretch is seasoning. The health keeps improving. Here what you can see is that each month that goes by, it spends more and more time in its target range. The volatility strips off. It holds its principal value much higher. And so what are we competing against here? You're competing against a multi-trillion-dollar universe of credit instruments. Most of them yield 3-4%. Most of them have long duration. The world of credit hasn't changed much in 50 years. You're trapped in the 20th century. Most credit instruments are created by issuers whose objective is to pay you the least amount they can with the worst tax treatment. Right? When a conventional credit issuer issues credit, they're keeping the tax benefit to themselves, they're minimizing what they pay you, and the irony is when it's over the counter, it's illegal for you to buy it. Huh? Say that again. Most credit, it's manufactured to be awful, very tax inefficient, and it's illegal for you to buy it. Well, why does that even happen? That's just the way the world was 30, 40, 50 years ago. What we've done is flipped it on its head, and our view is, well, we actually want to pay you the highest possible dividend, make it tax deferred, and make it easy for you to buy it, right? That is the credit revolution. So why do you have to wait 10 years to find out if you get paid back? I mean, strip the duration down to a much shorter amount, increase the dividend, and then make it easy for the individual. So what's the tax equivalent yield on this? If you're a company, well, let's just start with the number. It's 11.3%. If you're a company, that's the same as getting paid 14.3% because you don't have to pay corporate income tax on this. If you're an individual in Miami and you are able to defer the 37% federal income tax rate, it's like a tax equivalent yield of almost 18%. How does it compare to everything else? Well, you can see it's anywhere from 50% to 4 times better than all the other credit in the world. Right? And the next best thing is like private credit, which is sort of illiquid, and it's half as good for a taxpayer, and it's 60% as good for a non-taxpayer, just on the basis of yield. What if you're lucky enough to be an individual living in New York City? Okay, digital credit is like a bank that pays you 23.3%. If you live in San Francisco, it's like a bank account that pays you 22.6%. Okay, so as you can see, this is, 4 or 5 times better. Okay, what else did we discover? Well, when you create an instrument like suggesting, more to the point, is the difference because your nonprofits, your endowments, the other hand, convincing the board of directors that they should actually collect two or four times more cash flow of not selling Bitcoin. We got very good at it. We have a PhD in hodling, you know? And so I figure, why don't we just opinion, 10 years is a healthier, 7 to 10 years is it's like, I've got it sitting on the back goes to zero, you don't have capital in digital assets. It's a no-brainer. So we've got a product which is makes it 50% better, and I mean, what was the big idea? Just wire me 100 billion. Right? Company, you got $500 million, and you know you're trying to figure out what do you do next? Create an ETF. MSTR is amplify. And what you can see is we're the most liquid And if you turn up that amplification, you can double you can expect to outperform the Bitcoin by anywhere from 30% to 100% or more. Podcast on that formula. Ask him. The big idea of digital is every 15 seconds we're creating value. Okay? In 15 seconds, we might sell $10 million of credit, buy $10 million of Bitcoin, increase our capital by $10 million, loop, rinse, and repeat. We are synchronizing the capital and the credit. How do you build a $10 million building in 15 seconds? Right? We're doing it without people. We're doing it without labor. There's no tractors. There's no bulldozers. There's no land. There's no expensive long-form contracts. Right? You don't have all of the friction of the world, right? The reason that digital equity is so compelling is because you're creating digital property, digital capital, and digital credit instantly in a synchronized way, friction-free, in cyberspace, in digital space, in financial space, if you will. And that makes it the most transparent, most efficient, most compelling type of credit. And so what are you going to do if I could snap my fingers and I could build a digital building in 1 second, don't you think I would probably sell it to you cheaper than the guy that took $1 billion to create an actual building in 10 years? If I can do this, I can give you a better deal. So what are we doing? Well, we're just making sure the credit's twice as good or 4 times as good. We can pay 4 times as much because we have the most efficient credit generator in the world. And I will just end with this thought of the reflexive flywheel. It's not complicated, but the credit creates the amplification. The amplification from the credit creates the volatility. That's what creates the open interest in the options market. All of that creates enterprise value. You're doing something. You're accumulating capital, and the capital increases the size of the enterprise. The capital we're gathering is going into Bitcoin, creating capital appreciation. We're appreciating the value of the Bitcoin network. You can't buy $55 billion of Bitcoin without the value of Bitcoin being higher than if you didn't buy the $55 billion. We're also putting capital appreciation on our own balance sheet. The credit creates the equity premium. How are you not a Bitcoin holding company? Well, we're doubling our Bitcoin per share. Well, if you double your Bitcoin per share, I'll give you 100% premium, right? If I'm an equity investor, I have to have something to believe in. You're doing something. The credit business creates the equity premium. The equity premium attracts more capital. The credit thereby attracts new investor base. You get credit investors. You get retirees, and corporate treasurers. They wouldn't have bought Bitcoin. New investors. That diversifies all the macro correlations. The business is going to trade versed on the junk bond index or the investment grade index or the forward yield curve or the euro versus US dollar index or the relationship of Bitcoin to gold or people's forward view toward Bitcoin, or their view toward big tech or macro or something, or maybe they just get excited about the future of digital credit. You've got a lot of different correlations. Each of those attracts new pools of equity. All of those things strengthen the brand. Everybody wants to talk about you. The brand is who wants to talk about you. So you're continually building awareness. And that creates optionality, right? We have the option to sell the credit, not sell the credit, raise the dividend, lower the dividend, right? The more optionality creates more volatility, creates more equity premium. And that creates trading because people disagree with you. It's like, I think it's a bad idea. I think it's a good idea. I'm going to short it. It's too cheap. It's too expensive. Well, I don't mind if people short $50 billion of the instrument, they got to buy $50 billion of the instrument back at some point. That's creating the liquidity. That creates credit. In this particular case, the credit attracts credit. And what I mean by that is people are more likely to offer you loans against the stretch or against the MSTR because of the liquidity in the instruments, and that attracts more capital. All of that brings arbitrageurs who think that someone mispriced something and they want to sell that to buy that and hold that and then get rid of that. And every guy with a Bloomberg that thinks he's smarter than you are, and maybe he is and maybe he isn't, but it doesn't matter, right? I mean, because they're bringing capital to the party. The entire thing is just a massive reflexive flywheel because the more stretch we sell, the more Bitcoin goes up in price. The more stretch we sell, the more MSTR capital grows. As capital and MSTR grows, liquidity grows, we raise more equity capital, the Bitcoin price goes up. So we're driving MSTR, driving Bitcoin, driving stretch, and of course, soon to be driving this entire ecosystem of digital money and digital yield. Everybody that's upstream to us, levered to Bitcoin, is in the ecosystem. Everybody downstream to us, levered to stretch, is in the ecosystem. Who are we competing with? None of those people. We're competing with under-collateralized junk bond issuers that are going out of business in 6 months that are offering you 5% yield, and somebody's buying that garbage, right? And so, yeah, at some point, really distressed credit issuers or illiquid private credit, they will find it harder. Look, now, nobody's going to stop buying T-bills because of this stuff. You don't got to worry about that. We're not competing with the U.S. government. We're competing with the marginal borrowers issuing illiquid, low-yielding, tax-inefficient junk bonds, high-yield bonds, private credit, and other types of garbagey credit instruments. And then the ones that sell things over the counter that you can't legally buy. And we're actually making it available to you. So who wins? The world wins. The digital asset economy wins. Everybody wins. And how big is the market? Well, there's $300 trillion of garbagey credit right now. And it's probably going to double over the next 10 years. So if you can get 5% or 10% of it, there's a $50, $60 trillion opportunity. What do we need? We need you. We need you to go tell people that this is an opportunity for the CFO or the treasurer. Tell your retired dad that maybe this is an opportunity to put in the retirement account. Talk to your credit investors. Talk to digital assets investors. If you run a business, think about getting rich off of this. Get the first license to sell digital money in Poland or the UK or France or the UAE or Japan or Brazil. Or put it on a crypto network or put it in an ETF, right? What is the thing that everybody in the human race wants more of? Money. It's the universal utilitarian product. Everybody wants more money. So I admonish all of you to go out and make some money. Either make it for yourself or make it for your customers or make it for your friends and family. And do it because it's the right thing to do, and it could never be done before. And 30 years from now, everybody will have already done it. Thank you for your time today and for your support.
Please welcome to the stage your host, Natalie Brunell.
Good afternoon, everyone, and welcome to Bitcoin for Corporations at Strategy World 2026. I'm Natalie Brunell. I host the Coin Stories podcast. We just crossed 1 million views for my Michael Saylor interview from yesterday. That's right. And I recently wrote the book, Bitcoin is for Everyone. I'm so thrilled to be your host for the next 2 days. Thank you also to our room host, BitGo. We really appreciate your support. I can't believe this is actually my 4th Bitcoin for Corporations. And an exciting announcement. Does anyone want to ask a question of Executive Chairman Michael Saylor or CEO Phong Lee? Well, you now have a chance to submit your question. Just please scan this QR code. We're going to be choosing some questions for an interactive live Q&A that will be presented tomorrow at 4:45 Pacific. We're so excited for that. And to kick this off, just look around this room. You are sitting alongside treasury company leaders, institutional investors, and some of the boldest minds in finance, all here because you understand that Bitcoin is no longer just an alternative asset. It is becoming the foundation of a new corporate capital strategy. Over the next 2 days, you'll be hearing from executives actually putting this to practice, deploying Bitcoin on their balance sheets, structuring digital credit offerings, navigating regulation, and redefining what a corporate treasury can be. This is where the future of corporate finance is being written. So let's get started with our first panel. I'd like to welcome Andrew Kang, Executive Vice President and Chief Financial Officer of Strategy, Ben Workman, Chief Investment Officer at Strive, Dylan LeClair, Head of Bitcoin Strategy at Metaplanet, and Matt Cole, Chairman and CEO of Strive. The panel is called Issuer Perspective of Investing in Digital Credit.
Thank you, Natalie, and thank you all for being here. I'm just thinking it's probably the toughest gig at the conference to follow Saylor right after his keynote, which is, you'll notice I go first on the earnings calls now just to avoid that risk. But I think we've got a great panel for you guys to kick off the remainder of the schedule. And we're going to focus today's topic on expanding a little bit more about digital credit, the innovations that are happening, sort of what we're seeing in terms of market dynamics, how we think about risk, how we think about the next stage of digital credit in the future. So I'm very glad to have our guests with us here today. We heard a little bit, obviously, we've been on the journey of the evolution of the Bitcoin treasury company. I think we also are, well informed now on the evolution of digital credit. I think it would be great. We talked a lot about what Strategy is doing. I think this is a great opportunity to see what others in the ecosystem are doing. So maybe to kick it off, maybe I'll start with Matt. It'd be great to hear from you how you think about digital credit, how you are thinking about that for Strive and some of the innovations you're thinking through.
Yeah, so when we saw Strategy launch digital credit last year, it fixed a missing link in my mind that the convertible notes did not satisfy, which is, as an investor, I love the convertible notes. So Strive is an asset management shop. We have a fixed income ETF. We own the convertible notes and the fixed income ETF. I think they're awesome investments. But as an issuer, it was pairing what I think is a extremely long duration asset and a great asset in Bitcoin with a long duration liability. And you want the longest duration liability so that way you really can zoom out and think in 5, 10, 15-year increments, which is what a corporation should do. That's when you think about fiduciary duty, there's always been a lot of criticism about companies thinking quarter to quarter or month to month and not thinking about the long term. And digital credit solved that to me. And it allowed you to think about amplified Bitcoin from a properly hedged liability. And so that was it on the company side. And on the buyer side, it also fixes that problem because now you can look at the company's balance sheet and also zoom out that you're underwriting their ability to meet those interest obligations. And you could underwrite it not from the perspective of a company with unknown future cash flows, but as a balance sheet company. And I think these are the most mispriced assets out there. I mean, I view Strategy as literally AAA grade credit. I think Strive is investment grade credit, but you can still have a win-win because of the earnings potential of Bitcoin into the future.
Great. So maybe moving on to Dylan, Metaplanet has had a tremendous amount of success raising capital in the Japanese market, developing that true narrative of the Bitcoin treasury company globally. How are you thinking about digital credit? We talked a little bit today about the evolution that a corporation can go through. Be great to hear your thoughts on what Metaplanet's thinking.
Yeah, of course. Well, excited to be here with some pioneers in the space. I think we should appreciate how nerdy everyone is in this room talking about preferred equity and capital structures. So very niche conversation, but very exciting conversation. I think on Metaplanet in May of 2024, when we pivoted in April, in May we published a white paper on kind of how we think about Bitcoin, our thesis, what our company is trying to do. And in that paper, we said we want to be perpetually long Bitcoin and perpetually short fiat currency. I think we said it a bit more buttoned up than that, but that was before preferred equity and digital credit actually was released and discovered by the strategy team. And we didn't know at the time what the evolution of that would look like. We were thinking similar to the convertible bonds or the traditional liabilities on the capital structure. And so fast forward, strategy IPOs 5 preferreds. It's very clear that this is the ultimate capital structure for a Bitcoin treasury company with a long time horizon. And so we have authorized 2 classes of prefs. The senior one being a variable rate preferred, we're calling Mars, Metaplanet adjustable rate security, and we've as well as a convertible preferred stock, we're calling Mercury, which Metaplanet convertible for return and yield. We've done a pre-IPO of that, so 150 million notional at a 4.9% face value, 5.4% effective, and our intention is to IPO 2 of those this year. Japan is Japan, so sometimes things take a little bit, but we're laser focused on that capital structure. The kind of the dual-pronged approach of common equity and preferred equity gets a lot of tools in the arsenal, as you guys have shown. So we're really excited. We're laser focused on it, and it's been a fun time educating the investors and educating the Japanese market on this new innovative strategy.
Yeah, I having been in the TradFi space historically, I know markets globally can be different dynamically, and I know the Japanese market is one where it takes a little bit of time to penetrate, but once you get that foothold, it's very durable, right? And so it sounds like you're going through some of those iterations to find out what investors want, what type of demand is out there, and it may take a little longer in the Japanese market, but I think when you guys put that out there, it'll really take off. So speaking sort of in the context of investors and sort of what market dynamics are out there, maybe I'll shift over to Ben as the CIO of Strive. How do you think about investor demand of these digital credit products? We talked a little bit today about retail, institutional, corporate. I'd love to get your thoughts on how all of those constituents should be thinking about digital credit as an investment opportunity.
Yeah, what's been really fascinating when we were going through the process of launching Sato was how wide the investor net actually was. When you're launching one of these, you never know exactly where the demand is going to come from when you're launching novel products, right? Bringing digital credit to the market is bringing yourself out of the analog credit market we've got today and bringing them something new, something more liquid, something with better yield profiles than they're used to. But that speaks to a wider range of investors. We saw a lot of institutional demand in it. We were well oversubscribed on both the IPO as well as the follow-on, but we also saw a tremendous retail demand on it, far bigger than we even thought we were going to see. And I think the reason you're seeing that is that these types of credit products, when you're pairing it on top of something that we believe to have a long-term CAGR of around 30, when you can strip off a really attractive portion of that yield and provide that cash flow and that income to these investors, it fits into a wide variety of portfolios. It's not only good for these hedge funds or these portfolio managers that have a benchmark rate that they have to provide alpha on top of. It's also good for the community that's coming into retirement. We have a huge cohort of the nation that's about to enter retirement where you start to shift the way that you deploy your assets. You're moving into that traditional 60-40 split of the portfolio that you commonly hear about, and any opportunity to average up the fixed income portion of that is something that's really meaningful to that individual's life, right? It's another trip to Disney with the grandkids or being able to travel to visit family. It makes a material difference. And I think that bringing these products into the market, it's actually been really surprising to me the amount of enthusiasm I've seen there. When it comes to a lot of the institutional investors, I think a lot of that demand is going to scale up over time. You're looking for things like track records out of these new products getting launched, and a lot of these institutional investors are going to want to see something like 3 years of those dividends getting paid so that they can feel secure with these products and go back and back test them against different market conditions. And I think as soon as we start to hit those marks, you're going to start seeing the inflows really ramp up into these credit products.
Yep. I think about the word evolution, right? Because we are defining something new. We're innovating around something that's never existed. We're changing people's minds to really understand. I know everyone has memorized the math equations that Michael just went through. We'll probably be studying them tonight. But one of the things I realize is there is a growth in understanding, right? I think about how strategy was raising capital first primarily through institutions. We knew that was a little bit of a education process as well as a closed infrastructure. We went to retail. Stretch was the largest pref that we had to retail IPO offering. And now I think part of what we're going to talk about more through the next day and a half is how corporates are thinking about investing in digital capital, digital credit. And I think there'll be some pretty cool announcements too that we'll hear about. So I guess moving to off of like what digital credit is to like sort of the current market dynamics. Maybe I'll pass this one to Matt. We are in a unique place today, a little bit of a bear market. How do you think about volatility around Bitcoin? How does that impact digital credit? How do you think about structural protections around the instruments that Strive and Strategy are putting into the market? How should an investor think and feel okay about that today?
Mm-hmm. Yeah, so I think what Ben talked about on the track record building is so important. I mean, you have this room, as Dylan calls it, we're a bunch of nerds, right? Talking about preferred equity and going deep in all these math equations and dissecting everything and understand the opportunity here. But you look at a pension, like I worked at CalPERS for 16 years. They wouldn't look at a pref until you've likely made interest payments for 3 years. And that's not when they cut you a check for $1 billion. That's when they look at you, right? And so I look at this bear market as something, we always expect bear markets in Bitcoin. We never predict when they're going to happen, kind of perpetually underwrite a 30% CAGR or whatever your CAGR assumption is. But a bear market answers, I think, the biggest unknown question of digital credit, which is, will the issuer make the interest payments through a bear market? And I mean, I can't even tell you how many times I get the question of, is Strategy going to have to sell Bitcoin? Which we know is a laughable question. I mean, we're in the midst of a bear market and you're buying Bitcoin every single week. But then you take an issuer like Strive, which by design is more amplified than Strategy. And that's another question that we have to answer, where this volatility is the gift that gives the return potential and also the opportunity for us as issuers to prove that these are investment grade credit opportunities, that when Strategy says we're going to defend 100, that you're defending 100. When we talk about introducing a cash reserve, the cash reserve is a new innovation on the prefs that weren't part of kind of version 1, but I think make a lot of sense to help handle these times of volatility. And as these things happen, the cost of capital, I think over time will come down. And it's funny, yesterday I had a conversation with Phong. We had one point of disagreement. We actually both agreed that there's going to be 30 billion plus of prefs on Strategy in the near future. And I called that linear growth and he called that exponential growth, but we both agreed it's going to 300 billion in the near future. I think that's exponential growth, but that's because of what track record building does. And so I think this time is actually a good thing and healthy for this ecosystem.
I agree. I think, I often tell the story that I joined Strategy in the summer of 22. right? And going through those types of iterations helps you understand, one, sort of the volatility of Bitcoin, but it also helps you understand how you get out of that and what happens once you get past a so-called crypto winter. One question I have, and you alluded to it, there's cost of capital, there's market dynamics, there's things like credit ratings, there's education on Bitcoin, institutional adoption progression. Maybe this one for Ben. What's the biggest opportunity for investors? Is there an arbitrage right now? Are we, what are we missing? Why should people do this now and not wait 3 years?
So our chief risk officer has a saying that he says a lot, which is risk is mispriced everywhere. And whenever you have a mispricing in the market, that's where the opportunities come out. Once people really digest what the risk is or how low the risk is relative to these instruments, those spreads are going to compress in a big way from where they are right now. Right now we're quite wide from the risk-free rate that's out there. But over time, as these gain adoption and as these build their track records and investors realize that these are more secure products, for the unique reason that we already have the assets. I think that's something a lot of people miss with credit products, but it's getting highlighted currently with all the innovation and the disruption that's happening. It seems every day there's a new AI tool getting launched into the market that wipes out the market caps of all these other companies, which starts to mean that those future cash flows from those businesses are far less certain than they used to think that they were. And a lot of these would be able to issue investment-grade credit products. But you're starting to see that in a world of disruption, that is far from a certainty anymore, right? The world is changing around us, and we can't see around the corner to see what's happening. What we're doing, though, is we're building these products on the top of capital. We have the capital. That's the core foundation of all of this. And I think that's missed in the market, how strong that is. If the cash flows go away from all these other businesses, but you're left with no strength left on the balance sheet, those investment-grade products are more junk products at that point. And so there's definitely a misunderstanding of risk out there. And I think that comes with any new product you're going to launch into a traditional market. The same way that people were resistant to music going digital and videos going digital and everything moving into the digital age, credit moving digital as well is going to take a learning curve. And it's a different model and it's a different type of capital that we think is the best form of capital in the modern world. But it's up to us, the onus is on us to help with that education effort to make sure that the rest of the people start to understand what a true risk profile looks like when you're building it on sound digital capital.
So should people buy now?
The best time to buy was yesterday. The second best time is today, right? That's the saying.
Dylan, I guess, pivoting to you, I think one of the valuable perspectives you bring is just, obviously strategy and Striver issuing in the U.S. markets. How do you think investors in Japan or anywhere else globally think about some of these embedded risks and some of the progress that needs to be made for further adoption?
Well, I'm going to answer your question in a way maybe that it wasn't asked, but I think the most interesting thing I find about Stretch, SATA, digital credit, these variable rate instruments that have a stable like price. For those that were in the Bitcoin space in 2020, 2021, 2022, or crypto more broadly, there was a few narratives and a few things that people were really, really focused on. One of them in 2021 was there was this explosion of kind of open interest in the futures market, and there was this thing called contango. And the contango was basically, people were really excited about Bitcoin. They wanted to get leverage long Bitcoin. There wasn't really many avenues to do it. And places like Deribit and Binance and all of the crypto derivatives exchanges, there was basically a 40% annualized interest rate for the Bitcoin native cost of capital. And a lot of the Bitcoiners, the Preston Pishes of the world, myself, we're saying Bitcoin's going to eat the bond market. It's really obvious. You buy Bitcoin, you short Bitcoin futures, you capture a 40% spread in basically a risk-free delta neutral way. It's going to eat the bond market. And for many reasons, one being the plumbing wasn't there, that didn't occur. But the more interesting thing I think is that in the crypto world, there was a lot of these DeFi tinkerers and engineers and financial engineers that for the longest time were trying to create a dollar or basically a synthetic dollar without counterparty, without kind of a centralized custodian like a traditional stable coin. And what most of them came up with, none of the implementations were perfect, was, well, if you have Bitcoin or Ethereum or one of the crypto assets, and you short the futures contract, you can create a synthetic dollar with a variable funding rate. And no one really found a a big TAM for that. There wasn't anything that really caught fire. There was a few implementations, but the most beautiful thing about this was that the crypto people spent so much time trying to figure this out, and then Strategy came and launched it on the NASDAQ. This is a floating rate instrument that's not a stable coin, but it's a very, very stable like price. And so with this, two of those kind of theses or questions were answered at once. One, how is the Bitcoin native cost of capital going to pull in fixed income from the bond market? And then two, this kind of age-old question in crypto of how do we kind of create this stable like instrument backed by Bitcoin collateral? And so these instruments, digital credit, did both of those things at once. This is going to be a big magnet for bond market capital. And two, all of the crypto people that spent so much time thinking about it are sort of they haven't really realized that we're doing this in the big leagues, in TradFi. So I didn't really answer your question at all, but I wanted to kind of get that across because I find it so exciting. Because this was a question a lot of people spent a lot of time talking and thinking about. And now, we're doing it in big size and, on the NASDAQ on publicly traded stock exchange.
Yeah, no, I appreciate the foundational concept of how this is working. But I'll go back to my question. Just what are the dynamics that you're seeing in a global market like Japan around some of these concepts? Are there any hurdles? Just any sort of context there, because I think, from our standpoint, we're obviously issuing preferreds in the US. We've issued a preferred in Europe. We think, in other regions and geographies. I think, it'd be great to just hear, sort of what you think about the Japanese market overall in these types of concepts.
The Japanese market is a huge fixed income market. The preferred market's very, very nascent. There's 4 listed preferreds. So there's private markets, but there's actually more perpetual bonds in Japan than there are perpetual preferreds. And so this is a market that's very, very sleepy, as Simon likes to call it. And we plan to be innovators here, similar to Strategy's experience or Saylor, the story he likes to tell about kind of grinding away with ChatGPT to figure out these instruments. No one had ever done all of the things like when we authorized the variable rate instrument. The lawyers and the regulators had never seen anything like this. So it took a lot of time to kind of explain it, say these are the mechanics, it can be done. The issuance is the next step. But the first critical step, getting it authorized, getting it approved by shareholders, that happened at December of last year.
I think if you took the narrative of you can't do this because fill in the blank, I think we probably fall short of all of the things that the Bitcoin treasury community has done over the past couple of years. And we've certainly evidenced that. Michael alluded to it. We went through 10 iterations before we got to the 11th. I was talking earlier today in our focus group. I was thinking about that first preferred we did. There was a lot of R&D. There was a lot of you can't do this. There was a lot of breaking the glass ceiling, so to speak, around some of our counterparts. But it's that focus and intention to just keep pushing. And I think if there's any example of the U.S. market, it'll eventually come to life. I guess last question on market dynamics, and I'll just throw this up for anyone. Jump ball here. 2025 was really the year of the pref, right? And I think we saw today, in particular, stretches, trading at 10x multiples of the other pref in liquidity of prefs in the market. How do you think about just secondary market liquidity? How do you think about how does that improve over time? What catalysts are there to keep that running, and how do we grow this to a larger depth?
So my view is this is actually going to be very similar to growing an asset management ETF business. And there's kind of a tried and true playbook of what success looks like there. And it's that the first 3 years is basically hand-to-hand combat. What I mean by that is you're going out there and you're earning every new investor in the space. You have no track record, you have a great idea, a differentiated product, and you're going out there and tomorrow Ben and I go to a different conference that is high net worth cash flow investors in Vegas that have probably never invested in Bitcoin. What's the concept? Digital credit, right? And And that kind of scales linearly, which is, $30 billion is my prediction for you guys. And then once you've earned the track record, then that linear but quick growth quickly becomes a hockey stick of exponential growth, because you've earned and built that liquidity profile over time as an issuer, doing what you're saying, expanding the marketplace, going out there and telling the story. I think that's exactly how this story is going to play out. And I think it is a iPhone moment, but it's also, the credit spreads say that it's early, and that's the opportunity of, why you should buy it today.
Yep.
I think it's, one of the things to note is that we really haven't seen a Bitcoin bull market in the era of preferreds, right? So, Bitcoin's kind of chopped sideways, and then, the last few months have been down. So, I don't think people are really understand what happens when, Bitcoin re-rates a lot higher, and then all of a sudden, the balance sheet of all these companies becomes, that much stronger, and it's going to be extremely reflexive. And so, I think, the performance over the last 3 months, continuing strategy buying Bitcoin every single week, issuing Stretch, issuing MSTR common stock. I mean, this is when Bitcoin returns, as it always does, and we're seeing the obituaries today. So we know how this plays out for anybody that's spent some time in the space. I'm really excited just to when these conditions flip, and when that happens, the narrative and everything else will flip with it.
Yeah, I would say one of the most underappreciated characteristics of all these products is that liquidity profile. I don't think that's very well understood. With traditional equities, if you go talk to anybody out on the street who just has a general understanding of a stock, they would tell you that demand is shown in the price. And I would say that demand is shown in the liquidity, right? It's showing that there's activity, it's showing that there's interest. And when you look at these preferred products and how they're trading in the market, or if you even look at the common equities, I mean, Strategy is one of the most liquid stocks out there. That liquidity is growing all the time. And I think that's a signal of the demand starting to flow into these. And as you start to see weaknesses in other part of the market, right now what's being highlighted is the private credit market. And people are figuring out that there is risk there, and there's a lot of liquidity risk that's there. So when you get these preferred instruments that are trading out on exchanges, and there's liquid and there's a lot of demand for them because they have these great characteristics we talked about earlier, I think that is going to start to attract eyes to these, where people are going to have to start looking, because when you see that demand profile growing through the liquidity, it starts to make you wonder, what is it I'm missing that everybody else is seeing? And I was talking to an institutional allocator here yesterday, and he goes, the problem for the prefs is likely the marketing. You've got to get out and talk to more people, because if 1% of people have found these and they learn what these are and they really evaluate what the risk, 90% of them probably already own it. It's the other 99% that still have a learning curve here that need to gain an awareness of these products. And so when you think about things like traditional screeners around these products and what draws the eyeballs of these allocators, it's going to start popping onto more and more radars. And I think that as long as we do our job on the marketing front and the education front, the capital flows are going to come in, and probably quicker than we think.
Yeah, I reflect on the comments around marketing and education. You guys mentioned that you're going to be at another conference. I think we've activated Michael and Phong to the most that they've ever been on the road in the past couple of quarters. I think what we've realized is there's a tremendous amount of just people not knowing, and you have that initial conversation of, here's the product, here's digital credit, here's what it pays you, here's how it's price protected, here's how it's perpetual, and it's almost like you see a light bulb go off, and they're like, oh wait, are you serious? Yeah, please sign me up for that. And I think we're seeing that with institutional investors. We're certainly seeing that with retail investors. I think we're seeing it more and more with corporate balance sheets. I think that ecosystem will continue to grow as you guys and Strategy and Metaplanet and others like us get out there and really tell the story. In the last few minutes, I guess I'll flip to, we've defined what digital credit is, we've defined how investors think about it, what the market dynamics are. What do you guys think is next? I think of Bitcoin as the layer one, and Michael talked about this. Stretch for us is the layer two. I think there's going to be products that are going to be built on top of Stretch, just given the intrinsic capabilities and the nature of the yield generation. Maybe you'll just go down the line and get everyone's thoughts on what's the future going forward.
the ability to innovate on digital credit is near endless. And so you've heard Michael talk about digital money, stripping down the vol, zero volatility. I'll give you an example in ETF space. Is one of the most successful new ETF categories is what's called a buffer ETF, which is taking like an S&P 500 and protecting it 10, 15% to the downside. Something like that on digital credit makes all the sense in the world. And then the flip side of that is levered digital credit. And that, I think, makes an extremely compelling case against private credit. So private credit might have like a 13, 15% yield for some of what financial advisors are buying. And it's so easy to highlight the risks of digital credit and the exit liquidity that the digital credit issuers are pushing out into the market, putting things on chain. Like, I will spare my bearish case for private credit, but if I can offer the same thing, but with digital credit, with a balance sheet company that doesn't have AI risk, but actually has something that's scarce in the world of abundance, I think that the demand for that is endless, but it requires innovation on top of that layer too.
Yeah, I mean, I'm really excited about the second and kind of third order applications and I guess wrappers, if you will, that are being built on this asset class. We had a dinner last night and spent probably 90 minutes with the table just talking about various opportunities here, whether it's domestic on a through an ETF, or whether it's on chain kind of crypto native, or whether it's foreign in a foreign currency with a a currency swap. I think there's really endless opportunity here, and having kind of seen the crypto playbook, if you will, with lending protocols and collateralization and stable coins, it's very clear there's going to be a couple category winners in a big way. And I wouldn't be surprised if next year at this conference there's 3 or 4 different companies or quasi protocols, if you will, that have over $1 billion of Stretch, SATA, and other digital credit exposure.
I think for entrepreneurs, you just need to give them the tools to build with. And so I think the work that's happening right now for us, kind of building that first layer of digital credit, is going to really open up the creativity channels. The world's getting really small, particularly when you start to think about the ability for some of these entrepreneurs to take these securities and then put tokens that they can distribute globally around them and bring some of the characteristics. But I think what was really important was to get multiple issuers into the market first, so that now you had more legitimacy around these products. You've got more people out there that are telling you about them. You've got more characteristics around the different yield profiles and whether they're convertible. And people can now structure products around that. You're giving other people an opportunity to go build something and make money for themselves. And in this world where everything's moving really fast, everyone's enabled by their silicon to come up with all the creative ways to get things done. I think that as soon as you release those tools, you prove them out, you prove that you're a good steward of maintaining your balance sheet and building a company that can endure through the bear markets, right? You're building for resiliency. I think that the winds get behind you and you're going to start to see a lot of really creative things happen over the next 12 months.
Great. Well, I thank you, gentlemen, for helping us kick off the remainder of our agenda. I think we've got a great schedule. I think we'll hear more about some of these concepts and maybe even, definitely some specific applications to some of the ideas we've talked about. So I want to thank you all and appreciate your time.
Thanks, Andrew.
have 2 exciting sessions coming up. The first is called Bank's Perspective of Investing in Digital Credit with Steve Halperin. He is the Managing Director and Head of Equity Public Markets at Moelis & Company. He will be followed by Bitcoin is Entering the Capital Markets Era, and that will be with Mike Belshie, the CEO of BitGo.
All right, thank you very much, Natalie. Hopefully that echo will decline. So Stephen Halpern from Moelis, what a journey Michael J. Saylor and the strategy team have taken us all on. We, Moelis, myself and my team have worked as the exclusive structuring advisor and a book runner on the distribution of the preferreds, which we'll talk about, and the handful of preferreds we've issued over the last year and change. Basically what happens is Michael, Phong, Andrew, and team come to us with the vision. Me and my team turn that into a security, of course working with lawyers to document it and make sure it works from a regulatory standpoint. So you might say that I'm an architect of the preferred program, but I think the reality is Saylor would call me a construction worker. My plan through this journey is to give you a tour of how digital credit broke ground in financial history, and I'm going to take you through a few stops. Those stops are: one, the structure approach to introducing digital credit into the financial markets; two, how digital credit drove growth in what was a pretty slow and sleepy preferred market outstanding; three, how that growth and issuance really expanded with each deal, the participants that were in digital credit; four, how these different structures trade and performed on their perpetual journey; and then five, what are investors telling us? We distribute these securities. What are we hearing from investors that are participating in this market? There we go. So first stop, what was the evolution of structure in digital credit that helped us find stretch, right? As Michael just talked about. First was Strike. That was a convertible preferred that had a high coupon and a high conversion premium in a perpetual package. So a long-term way of playing strategy, MSTR upside, with yield and conversion premium. We started with that because we went to a listed preferred market that was historically dominated by investment-grade banks, insurers, and real estate companies. So our best way to really access the market first was to bring a convertible security, right? Strategy had issued $9 billion of convertible securities before that. And so we had a following. And we leveraged off that following, which were in convertible investors, to bring that to market. And then expanded the innovation by doing ATMs on it so we could issue more. Second was Strife, STRF. There, we were able to lose the conversion feature. We were going to offer something more close to credit, which was high yield, long duration, and very innovative creditor protections. Michael called these covenants, penalties if you defer, fast board seats, restrictions on them if they raise money and don't pay dividends. So that helped us bring in the fixed income community, as we'll talk about. And then third came Stride. So Strife was the most senior. We wanted to offer the best credit to get fixed income investors in. We went deeper and more subordinated into non-cumulative in Stride. And that was subordinated, non-cumulative, perpetual capital with no protections. That had never really been issued before by anyone other than a bank when we broke that ground, and we were able to get it off. That then led us to Stretch, as we've talked a lot about, which is we've got all sorts of subordinated, long duration, high yielding credit out there. How do we pull in more people who don't want duration? And that was to have low duration, rate protection through variable coupons or dividends, and form a money market alternative. Stated goal is to keep it near par so that we could ATM the security. We copied some of the other protections we had in Strife, and we created what was an attractive place to park money. Fifth and finally, and so far on this journey, was STRE, which was the Euro version, designed to pull in European investors, non-dollar investors, but also play into the trend of people trying to diversify away from dollars amid dollar weakness. And that did widen the distribution and bring in a wider set of credit buyers. So as we look at our Our second stop on this journey, let's just take a second and look at how we impacted the preferred market. Preferreds have been around, since 100 years and since the railroads, but it's really been dominated by banks, which have $10–20 billion of securities out there, insurers, and REITs. Generally IG rated, generally companies that pay dividends, generally companies that can't defer because they operate in a world where confidence is essential. If you're JP Morgan and you issue preferreds, you may have a right to defer your dividends, but you're never going to, right? Because you're the highest rated bank. You want people to keep their deposits with you, and you need access to capital for the ability to continue to raise money. A little similar to strategy, but obviously, much more regulated. And so that was what the market was, and it was a small market. Our volumes, both between the initial issuance and our ability to ATM, to constantly go to market and issue more securities, really grew the entire preferred market. And while we were not the first to use ATMs on preferreds, we were the largest, and we were the first to employ it as a strategy at issuance, right? That was our stated intention from the day we issued them, and it enabled the company to really democratize demand by selling to anyone who wanted to show up in the market and buy it. Our third stop on the journey was investor adoption and expansion. As each security performed, the original issuance sizes were increased by ATMs, and the market for them broadened, right? FOMO is a real thing. You didn't buy that first deal, and it performed well. Well, I better look at the second one. Otherwise, I've got to answer to my investors, to my shareholders, to my managers as to why I didn't play it. So each deal brought in the market and got bigger. Strike, like I said, leveraged off the convertible universe. The people that were already believers in strategy already wanted access, different ways to play strategy common stock. That was mostly hedge funds and large mutual funds. It had a small slice of fixed income in it, and a small slice of crypto in that other bucket, and very little retail at the initial, in the initial deals. Second, as we went to Strife, when we went with the success of the first deal, pulling out the conversion feature, with its performance, and with our 10% yield at a discount, we were then able to pull in much more fixed income demand. And fixed income came in, and the deal got larger, right? And what happened is, the same buckets and supporters continued to support, but what you see is the fixed income bucket and the other bucket continued to grow as we performed, right? And that other bucket is things like, is mostly, is the retail component, as well as insurers and other investors. So they started to pile in, and the deals got bigger and broader. And so you can see on the right pie chart how the ultimate distribution of our initial issuances was. And as across all the deals, it really starts to broaden to be really all of the fixed income market participants, or a sample of all of the fixed income market participants. But what this doesn't capture is the ATM. And what's great about the ATM is you sell securities when people want to buy them, right? When there's demand and the securities are trading up, and you're selling them effectively to the people that want to buy them, rather than going through a book build process and selling it to who the banks want to sell it to. So that really also further democratized the issuance and enabled the strategy team to continue to grow these securities as the market wanted them. Our second to last stop on this journey, this evolution of digital credit, how are these securities trading? What have they returned relative to volatility? Think of volatility as a measure of risk. And what's the comparison of investment opportunities going forward? Now, my compliance head urged me right now to pause and tell you that nothing that I says here constitutes investment advice. I am not an investment advisor, so please keep that in mind. But as you look at the returns, some of the merits of these really do speak for themselves. Strife has been the best, but that's not surprising at the moment we're in right now. So Strife is the most senior, has the most investment protection, and was one of the first ones we issued. It's not surprising because right now we're in a risk aversion stage of the market, right? So in risk aversion, you may still want to play, but you're going to gravitate to what's the most defensive within the asset class. So it's also trading at the lowest current yield, reflecting the credit curve. STRC, as we built it, right, with variable coupons, has the lowest volatility, lowest risk, as the company has both managed the yield, right? They've raised the yield as it's traded down, and also reduced ATM issuance when it trades, when it trades below par. So by doing that, by being able to raise the coupon and lower the ATM volume, you can obviously try and keep the security around par, and that's why this has much lower risk or realized volatility in the capital structure, and has been a constant tool that you can add to, and is obviously attracting all of that money market demand. Strike, the convertible with the equity, is therefore down, right? It's a convertible security, the equity's down. It's equity sensitive, but it has dramatically outperformed the common stock with much lower risk, much lower volatility, because you've got common stock plus yield, and it's outperformed on the downside. So it's totally done what it's supposed to, and therefore it continues to track demand and trade well. And then Stride, look, Stride is the most junior non-cum security in the capital structure. We talked about the environment right now. So with risk aversion, it is going to trade the widest. It is going to perform the worst. But that's also the opportunity going forward, right? As we get through, hopefully, what is this, Bitcoin weakness that we're seeing right now, because it's offering the highest yield and the highest upside. So I think obviously as the company and Bitcoin hopefully get to the other side of this and start performing, that could be the outperformance in the future, given where it sits. The last stop on my journey is just what investors are saying about their exposure, and what are we hearing as we continue to market securities. And I love these comments about digital credit, and they're really about the 5 most important things as you think about a credit investment. One is size. 2 is duration, right? Non-callability is great to have that duration, to not have to guess what the issuer is going to do. 3 is value. This offers incredible value versus, Michael compared it to 20 different asset classes. This asset class offers incredible value at the moment versus alternatives on a pre-tax or tax-adjusted basis. 4th is adoption. It's going to continue to broaden as these securities perform. It represents every bucket now, but it's going to go deeper into those buckets as we continue to issue and perform. And then 5th is diversification, right? 10% yield, digital credit offers a real diversification against or away from other opportunities that I have to buy. So we're nowhere near the end of this road. It's going to have peaks and valleys, and I can't wait to see where Michael Saylor and the strategy team takes us on this journey next. I've got to say, as a participant, it's been a really fun ride, even if I'm just somebody who's been hammering away at their visions. Thank you very much.
Good afternoon. My name is Mike Belshie. I am CEO and founder of BitGo. We are the world's largest, I guess we call it, infrastructure provider. Sometimes people think of us as a custodian, but we do all things financial services. Let's see. Originally, it was Bitcoin entering the capital markets era. I actually changed this up last night because I thought that was a little bit boring. So one of the things about BitGo, we just had the unique experience of going through the IPO process. It's a interesting process. I think for those of us in digital assets, not just in Bitcoin, but beyond, we see so much opportunity to change things around. So I have a few lessons from that I thought I would share. It's a bit of a personal experience. Hopefully it's a little bit fun, a little bit off the beat from kind of the rest of the stuff that's been talked about at this fine conference today. All right. So let's see, first lesson. What is a private key?
This is where, you seen that internet meme where Michael Saylor goes, I saw that over and over again on the IPO roadshow process. So roadshow, right? We go through this testing the waters process, probably met with 125 largest funds in the world. Goldman led this thing. They are, of course, the experts at bringing in the $1 trillion funds, the $100 billion funds, et cetera. Remember, all of these guys have been on the sidelines for the last 4 years, basically due to regulatory issues. And it's not digital asset specific, it's not Bitcoin specific, it's the entire asset class. So as such, they haven't studied it. And by the way, guys, these guys will invest in anything. Computer chips and potato chips are all chips, right? What's the difference? So there was a lot of education. Interestingly, they did ask me, what is a private key? They dug deeper. What's it look like? Fascinating question. But one of the things that's interesting is that when you really think about it, we are still just in early days. And all of those educational questions that get asked, there's still so many people at the pinnacle of finance that don't yet know what it is that we're doing with Bitcoin. All right. So lesson number 2, the mental model that investors have about how this stuff works is completely broken. Not broken like they've got a bad model, but they don't understand what's happening in our world. They expect, and they always try, to bring things back to something that they do know about. So they think that our markets work similarly to traditional markets. And they've kind of heard, I guess, market structure. I'll talk about market structure, Bill, in a second. But they assume that there must be a network, a fabric of brokers and exchanges and custodians and banks that all come together. And they think that they know how this stuff is going to work. So, you know, we come in, we're often labeled as a custodian. We're not a custodian. We do custody. We have 7 custodial licenses around the planet. So I guess that's why people want to put you into that box. But when we started starting out with Bitcoin, we got bit in our name from the 2013 era. You know, we were trying to build technology, and then we wanted to make it so that everybody can use it at the institutional level. We needed those regulatory licenses. We did build custody. There was no market structure, so we found ourselves as an island. You know, you wanted to have liquidity, you had to take it out of the deep cold storage that we provided. You had to go put it on some rickety exchange somewhere. None of that existed. All right, back to the investors we met with on this roadshow. You know, they still actually think all of this stuff exists. So they expect that there's brokers out there. They expect there's duties of best execution. Of course, this doesn't exist. All right. Let's see. All right, Bitcoin price is down. All right, this might be a little uncomfortable. Why is the Bitcoin price down? Obviously, it's very complicated. There's people at this conference that can probably talk about it much more intelligently than I. But from the roadshow, we did actually miss a little bit. And it's not incorrectable. We can. But back to the basics of what did we promise? We promised with Bitcoin that we were going to make democratized access. We promised that we were going to take out middlemen. We promised that the rates would be lower. We promised that Bitcoin would deliver on all these things. But as an industry, you know, we've done okay. I think probably most people here, I can't see you guys, so I can't see you raise hands, but on the user interface for Bitcoin digital assets, I think most of us agree there's still a lot of room to go. It's sort of usable. Techies can use it. The younger generation can use it, but it's not as good as it could be. But also, on the financial side, we've actually replicated too much of what we had with traditional finance already. You know, one of the things that you hear if you go up and down Wall Street is that they need to trade against retail. Sometimes it gets called, you know, ripping the face off of retail. When I was on this roadshow, we talked a lot about trading, and interesting, I had Goldman on the side over here. We're talking about what's going on with how we provide access to Bitcoin in the digital world. And it turns out you go to the U.S. leading exchange. You can ask ChatGPT to do this right now. You can say, what was the take rate on retail trading in the last quarter that they publicly announced? It's 131 basis points. By the way, that's actually down from 143 basis points the quarter before. In other words, in our industry, we are ripping the face off retail even worse than Goldman Sachs rips the face off of retail. Makes them jealous. So look, all of these things, we've got to do better. We've got to continue to build out these markets. This was very much on their minds. All right. So let's see. One other thing, and there's been a lot of talk, I mean, obviously, of Bitcoin on your balance sheet, whether you're a digital asset treasury company or a corporate. Little known fact people don't know about BitGo. We were probably one of the first. We've had Bitcoin on our balance sheets. You can see it in our S1, but we've had it all the way back to 2013. We raised our Series A, and we said, hey, investors, we want to put half of this into Bitcoin. They said no, but they did let us put a quarter in, which is not too bad. So we've carried this for a long time. But interestingly, when you go to the public markets right now, the analysts and the bankers alike struggle to understand what this means. Now, part of that was due to the fact that just seen some strange looking companies. There was digital asset treasuries were kind of the wave in the summer last year. Remember, we got delayed on our IPO process because the government decided to take a little vacation in October. But, so the digital asset treasuries, they were just getting their heads around that. You had one of the public companies that went through that had a massive Bitcoin balance sheet, which rivaled their operational business. And then we just had a little bit of Bitcoin. And this became actually a confusing point. Like some of the analysts said, well, we can't give you credit for the Bitcoin at its value, towards your equity value in your company. I was like, wait, what? Why? What? You're going to value it as something less than market value? But believe it or not, this is still happening. There just haven't been that many public companies. So I was very surprised that this happened. But it was a real issue that we saw during the roadshow. All right, quantum resistance. I'm not really worried about quantum computing right now, but I cannot tell you how many times I was asked, what do you think about quantum computing? So whether you think it's an immediate threat, it's going to happen in 3 years, there's some startups super well funded, they think they're going to crack it in 3 years and crack elliptic curve. I don't think so, but it's all over all of these institutional investors. They don't really understand technology, and they're hearing the latest FUD. Now, by the way, Bitcoin has seen and endured FUD over and over again, whether you're talking about the energy consumption or the fact that it's backed by nothing, or the China exit. There's been many of these, but QR is definitely on their mind. My opinion, I don't think quantum resistance is actually something we need super fast, except for one thing. I do think we should just solve it to take it off the table. All of these guys, sooner or later, are going to be paused as long as this issue is out there. And we've got a whole bunch of folks that are saying they're going to solve quantum computing, and that FUD is just going to continue. So anyway, I was surprised by how much this was there, but it was very much front and center, kind of in their minds. All right, clarity. So the Clarity Act, it's pending market structure. If you're not familiar with it, by the way, if you ask anybody, like, what is market structure? It's like 2 words, but people have massively different interpretations of it. I know there's talks about stablecoin and interest. Really, that should be about genius, not clarity. But nonetheless, clarity comes up a lot. I do believe we need market structure. But what I was surprised to learn on the IPO Roadshow is how much those generic investors think that clarity is the thing which gives us basically that stamp of approval, that legislative approval, that this asset class is allowed to move forward. So they kept asking, like, well, this is really going to enable your business. If you look at the Clarity Act itself, it's got a little bit of clarification, which is good, but mostly it enables the CFTC to have the charter to go and solve it. It's going to take them 18 to 24 months. It's quite a ways away. Nonetheless, all of these institutional investors, very much it's on their mind. All right, OCC charter, kind of on similar point. We did just get a OCC National Bank charter. Thank you to the new Trump administration that has unlocked all of these agencies, from the SEC to the OCC to the CFTC. It's definitely gotten a lot better. They all believe this is like required. Those of us in the Bitcoin space, we're big on self-custody. All of these guys, they didn't quite get it. My surprise, as we talked to them about having a full complement of self-custody Bitcoin options, they didn't care about any of that stuff. They didn't even understand it. They didn't think it was even necessary for the future. I hope everybody here sees that, like, if we don't preserve self-custody, even though businesses will generally choose custody, ultimately we'll end up with the same banking system that we have today. That is, it'll be a small closed loop system. Individuals won't be able to participate. All right, so anyway, OCC charter. Lastly, stable coins. I think it's my last one. Stable coins. Definitely a lot easier for all of traditional finance to get their heads around. They can understand stable coins a bit. I do believe this is going to be like the gateway into digital assets at a much larger scale. all of a sudden we'll have digital both sides, both the dollar side and the Bitcoin side. So definitely saw a lot on that front. Finally, I just wanted to conclude with what I really learned. The Bitcoin principles that hopefully everybody here has been adhering to or looking forward to for so long. Look, the scarce supply, it does matter. The transparency, it does matter. We can improve the system. A lot of what I talked about here is all on the Bitcoin side. In terms of that IPO process that we did, it's terrible. It's the worst price discovery system you'll ever see. I think any of us could probably pick a better system than what they do there. But the principles of Bitcoin is what we need actually in all of the digital asset space. So anyway, that's what I learned from the IPO Roadshow. All right, thank you.
A 15-minute coffee break. So go ahead, mingle a little bit. Also check out, there's a couple of bookmarks on the tables if you want to get a copy of Bitcoin is for Everyone. Education, you keep hearing it on stage, is really, really key. I'll have to make a follow-up for digital credit is for everyone, but I don't have that written yet. Thank you guys so much. See you in 15 minutes.
If you please make your way back into the room, our program will resume in 5 minutes. Please make your way back into the room. Thank you.
Till I get up, time is barely on our side. I don't wanna waste what's left. The storms we chase are leading us, and love is all we'll ever trust. Yeah, no, I don't wanna waste what's left. And on we'll go, through the wastelands, through the highways, till my shadow turns to sun rays.
Please make your way back into the ballroom. Our program is about to resume. Again, please make your way back into the ballroom. Our program is about to resume.
Welcome back, everyone. everyone. I hope you're feeling energized and caffeinated. I'm excited to introduce our next session, which is the Equity Analyst Roundtable. The moderator is Sharish Jajodia, Corporate Treasurer of Strategy, and I'd like to welcome the speakers on stage, Lance Vitanza, Managing Director and Senior Analyst, Equity Research Group at TD Cowen, Mark Palmer, Managing Director and Senior Equity Research Analyst at Benchmark, a StoneX company, and Andrew Hart, Equity Research Analyst at BTIG. Welcome our speakers.
Hello, good afternoon, everyone. Thank you all for joining us. We are having this discussion on Equity Analyst Roundtable with our research coverage analysts, and this discussion is happening in the middle of one of the steep drawdown in Bitcoin price and in the middle of evolving capital market structures around the Bitcoin asset class. So we'll take your opinions on from the TradFi perspective. How do you see the current market backdrop? Many market participants were calling for very bullish Bitcoin prices in 2025. So what happened in your opinion, and do you view this BTC drawdown as a structural change to the asset class or just like a cyclical volatility? You want to start, Lance?
Yeah, I'll take that. Thanks.
All right.
Thank you, Sharish, and thank you for having me. It's a pleasure to be here. I'm one of those analysts who thought that we'd have a much higher Bitcoin price at the end of 2025. So, what we got instead was a real breakdown, starting last fall, a real breakdown in the historical relationship between US dollar fundamentals, precious metals, and the price of Bitcoin. And what's really surprising to me is that that took place during a period of just such pronounced progress in the pace of global Bitcoin adoption. Look, if I were out here today trying to defend Bitcoin at $150,000 in the midst of weakening fundamentals, this would be a much more difficult conversation. But the fact of the matter is, if we think back what's happened over the past year, I mean, look, I'll admit I was late to the party. I started looking at Bitcoin for the first time in 2022, and I'm a quick study, and when I looked at it, it was very clear right away that if we were starting with a blank sheet of paper, of course, the world would be better off if we'd adopted Bitcoin as the global reserve, currency rather than a fiat currency, right? But we're not starting with a clean sheet of paper, right? We're starting in a world of dollar hegemony. And so what we wrote back in 2022, 2023 was that, of course, Bitcoin has all the attributes that make it, from a technological standpoint, a superior store of value. But it's still a long shot, we thought at the time, that it would ever be adopted widely just because of the powerful forces that were sort of positioned against it. That was then. Since that time, a lot of dominoes have fallen into place, right? And a lot of these have happened, in different administrations on both sides of the political aisle, right? So just in the past, couple of years, we have seen FASB change the accounting standards to essentially make it much easier for corporations to adopt Bitcoin as a reserve asset. We have seen the SEC essentially legitimize the holding we've seen them legitimize Bitcoin as an investable asset for mass investors. We've seen, and those both happened during administrations that were not the one that's in the White House today. So fast forward, the past 12 months, we've seen certainly these trends have accelerated in the current administration. We've seen the IRS bless the idea that, of course, we shouldn't be taxing unrealized gains on Bitcoin, and so on and so forth. And that's just in the U.S. Around the world, we've seen even more things. So, just tremendous progress. I mean, when I compare the price relative to the fundamentals, relative to Bitcoin versus, let's say, gold, right? The other sort of store of value. If I compare those two, there has never been, in my opinion, Bitcoin has never looked more attractive. It's never looked cheaper to me.
Great.
Mark? Well, I think this needs to be put into perspective, because we did hit an all-time high in the price of Bitcoin just in October. This is a matter of, a handful of months. It's not a multi-year protracted drawdown or a situation as we saw in late 2022, where there were equity research analysts on the street saying crypto is dead, why are we even paying any attention to it? So this is a drawdown, which is nothing to be surprised about when it comes to Bitcoin. In fact, if you look at the extent of this drawdown, we haven't come close yet to the point at which we have seen prior drawdowns, which were 70 to 80%. Now we're in the 50s. With that said, there is a major catalyst that's on the horizon, at least potentially, which is the enactment of the Clarity Act. The idea that we not only would have the US government in the form of a more favorable SEC blessing Bitcoin, but that you would have that codified, make that part of the law, so that it would be very difficult to undo if you had the political winds change over time, is a huge thing. Now, Bitcoin is been viewed as a commodity, even when we had an administration that had an SEC which was going after every altcoin protocol out there. But this is a situation where the more adoption we see from institutional investors of crypto writ large, the better for Bitcoin. And I think that that's something that's getting lost here. Right now, if you look on Polymarket, the odds of the Clarity Act becoming law, last I looked, it was north of 80%. And that's right around the corner. So, we might be in a bit of a winter storm here right now, but you can see spring around the corner.
Yeah, I think I'd add or echo a lot of what Lance and Mark said, especially on the point of institutional adoption. So let's say this is a much more cyclical drawdown or it is cyclical, but let's compare it to maybe 2022 versus now, right? If you look around and just talk to anyone at this conference, right, there's dozens of just software businesses that are looking to add Bitcoin to their balance sheet. Then back in 2022, it was really only strategy out there, right, holding Bitcoin on their balance sheet, and now there's dozens of businesses doing that. You have, I think of a conversation I had with institutional salesperson focused on hedge funds at Coinbase last week, and he said a lot of their new customers and new funds that are coming on for them are actually traditional equity investors that want access to spot Bitcoin. I just think that's a really healthy thing for the Bitcoin ecosystem. And then on the retail side, you have, it's just easier to hold Bitcoin than it ever has been before. I guess the question though is all right, so it's cyclical, but we were at 120,000 and now we're at 60,000. To an extent, I hope, and I think that a lot of that's the Bitcoin ecosystem maturing, right? There probably was a lot of leverage in the system that needed to be flushed out a bit, right? And I think that's happened. And so we don't necessarily think all leverage is bad, right? But I think we're now at this point where it's been a learning process is the wrong word, but it's been a maturing moment for Bitcoin. And, I think we feel really confident that when you look at it right now at 60,000, it's a great asset that you can get into at a really attractive price.
Great. So the common theme I hear is there are a ton of positive catalysts, institutional and macro. It's just the price. Price does its own thing and price will follow eventually. So let's shift to Strategy's capital structure. Strategy has been doing a lot of senior convertible notes back in the days. 2 years ago, it was the year of convertible issuances. We did every quarter, back to back, a lot of convertible issuances. Since then, last year was the year of preferred equity issuance. And it was a very sleepy, old kind of market that we tapped into and suddenly put life into it. How do you see Strategy's shift from converts to preferred equity model? And is it just simply shifting the risk of debt maturity to the dividend servicing? Or how do you see the tail risk reducing because of the preferred equity model? You want to begin?
Yeah.
Yeah, Andrew, you want to go?
Yeah, I'm happy to begin. I guess it's interesting you called last year the year of preferreds, and I'd say to everyone in the audience, when Strategy says they're going to do something in the capital markets, they're going to do it. So if we ran 3 years ago or so, it was the year of the ATM, and then they were the first to bring the convertible debt market, right? And then last year, obviously, they really pushed on preferreds, and I think you'll do that again. I'm sure we'll get into it more, and the question probably is, okay, you no longer have this maturity risk, but you have the dividend obligation. I know it's something I think we'll probably talk about more, but it's MicroStrategy now has 2 years of cash coverage on that. And if you think about their dividend coverage on it, it's 5 decades, right? And so I'd say the shift has totally gone to a dividend obligation, which we think is totally fine. In this market, you'd probably have it rather be that than a maturity obligation. But what I really just would say is, like, you guys move quick and get it done, and I think that's probably been the most impressive thing when we look back at the past year.
Yeah, I think one of the things that the market has not yet grasped with regard to the approach that Strategy is taking with its capital structure is the fact that it has evolved from traditional instruments that have flaws. And when I say that, I mean senior secured debt that has debt covenants. You have convertible debt that has maturity walls. The nice thing, the great thing about perpetual preferred stock is it is effectively permanent capital. Yes, you have to pay out on the dividends, but once that's in place, I think Michael Saylor said, it could be in place for 100 years. And when you are in the business of accumulating a volatile commodity like Bitcoin, having permanent capital is incredibly valuable. And as someone who's covered this company going back 5.5 years now, the trolls on social media will grab onto anything they can in terms of the potential for a margin call or a tripped covenant or anything else along those lines. They'll distort whatever that is to the nth degree. But if you take that out of the equation and your entire capital structure is comprised of perpetual preferred stock, which is the direction in which Strategy is going, you take that off the table altogether. And the narrative shifts to one in which the focus is on where are we going to go in the long term.
Yeah, I agree. I mean, this is really all about matching the duration of the liabilities with the duration of the asset, right? If you're issuing in the convertible bond market, generally speaking, you're talking about maybe a 5-year maturity. And if you want to buy your coupon down to, something close to zero, you might have to put in a put option at 3 years or thereabouts. So let's say that you've got, capital that's, potentially out there for 3 to 5 years. If you issue a perpetual preferred, and let's say it's at a 10% dividend, I could raise $1 billion of capital, and then maybe I've got 100, maybe I've got 120 million of interest of dividend obligations, and the effective maturity of that is more like 10 years, right? So, for a long-term asset, I mean, Bitcoin is the ultimate long-term asset, right? So why would I want to buy the ultimate long-term asset with short-term liabilities, right? We've seen what can happen when companies do that. You can get away with it for a period of time, but there usually comes a reckoning. So I applaud the move. I think, to be honest, it took me a minute to catch on, but once I got it, I really think that it just makes all the sense in the world.
Great. So I had a conversation with one of the large convertible holders recently, and they gave me a call, and they said initially when we started to talk about the preferred equity market, that we're going to shift and launch our first preferred equity, and the bankers might have pitched to the convert investor, and the investor said, is Strategy completely out of their mind? And fast forward to today, they say they're very pleasantly surprised with what we have been able to achieve with our preferred equities. And today we heard Michael talk about Stretch, and Stretch is currently being positioned as a premier digital credit instrument. So to double click on that point, do you see that as just an additional funding tool, or does Stretch STRC has the potential to become a standalone asset class where people can build layers and additional products on top of Stretch? Mark?
Well, I think if you look at Stretch and the role that it plays for Strategy, it is the anchor now. And what's impressive is that we have seen a very rapid evolution, not going back years, but literally months in terms of the learning curve that management has gone up. Michael Saylor said this today during his talk, that the company kept going further and further out to figure out exactly what the market would respond to, and then they found it, and that was Stretch. And now that that has been discovered, it's all about educating the market about Stretch and its benefits. I have heard this now a number of different times where those who are owning Stretch fully appreciate the benefits of it. whether that be the collateralization, whether that be the tax treatment. And they keep saying, well, it's just a matter of getting out and letting more investors and more new groups of investors understand the benefits of it, and that's when it's going to take off. Well, that's not something that happens overnight. I mean, if Strategy invented digital credit in this fashion, this happened in the last couple of years. And so Bitcoin itself, is really in its infancy at this point. Digital credit is, barely arrived. So yes, it's going to take a little bit of time for that to occur. But if you look at the liquidity around the instrument in particular, it's very impressive how quickly the market has picked up on this.
Yeah, it's traded over 120 million on an average daily trading volume over the last 30 days, which is great for a product with 3.5 billion notional outstanding.
Yeah, I would just add to it too. Like Michael showed the slide today comparing digital credit and stretch, right, to all the other asset classes that it wants to displace, right? But I do think there's an important thing, like where I cover the common equity, right? And stretch makes the ability to buy Bitcoin. Bitcoin's the ability that drives the common equity, right? I think there's a really important flywheel that gets created there. And so to an extent, in my view at least, it's a bit of the eye of the beholder. I think stretch is an incredible asset for that pocket of investors, right? And MicroStrategy is the amplified Bitcoin and amplified exposure to Bitcoin, right? But they all work together. And the way, like, I'll talk to investors a lot of time is like MicroStrategy is building the Bitcoin yield curve or the Bitcoin risk curve, right? And I think stretch is the premier instrument in there, right? But stretch isn't the only preferred, right? There's some that have more volatility aspects and can capture more upside and downside, with MicroStrategy being the most volatile and stretch being, relatively less. So yeah, I do think it's becoming its own instrument in and of itself, asset class in and of itself. But the way I always talk about it is MicroStrategy is building the Bitcoin yield curve.
I might answer the question a little bit differently in that I think that what Strategy has done so well is that they have designed an array of instruments that appeal to a variety of different investors, right? So, if you're a high yield asset manager, right, the Stride, the junior most preferred that you have, offers some very interesting, attributes there. And gives you, a degree of exposure to Bitcoin volatility that, while less than the common, because you don't have as much dividend protection as some of the senior instruments, does give you more potential upside exposure to a rally in Bitcoin, right? If, on the other hand, I am a high-grade manager, right, and I want something that has relatively low volatility, I don't want to come into work one day and see my position marked down 10 points, right? Then I can be in the senior-most part of the capital structure, and so on, right? I view stretch as being the most retail-oriented, right, for the person who really doesn't want to see the value, they don't want to see the value of their investment change from day to day, right? And they want to have a monthly cash flow stream as opposed to quarterly. So, I personally, I know that the company is making a big push on stretch, which I think is great, but I wouldn't want to do that at the expense of the other instruments. I think that each instrument appeals to, from my standpoint, the way that I present the various instruments to the different investors is let's talk about your risk tolerance. Let's talk about your reward expectations, and then let's find the right investment tool for you to achieve those goals.
Yeah, makes sense. And when we were ramping up the preferred equity exposure, the current dividend payments amount to around $900 million annually. So initially, the great investors were getting nervous around, how are we going to pay the dividends? And it was a radical business model to issue equity to pay down the dividends. Now, Strategy has USD reserve of over $2.25 billion, which is equivalent to more than 2 years worth of preferred equity dividends in reserve. So in your conversations with the investor audience, do you see this cash reserve meaningfully change the probability distribution of downside outcomes for MSTR? And are people more comfortable around the preferred equity with the USD reserve? And is 2 years the right amount, or do you have any views on that? Hence?
So it's absolutely changed the discussion, right? Certainly, I think it was a watershed moment for the company. I think that, Personally, I think that the $2.25 billion that you have to, I think that that's a very appropriate amount. I don't think that the company needs to do more. I would be fine if the company announced tomorrow that it wanted to get closer to the 3-year end of the range that it's given. That wouldn't be bad news, but I don't think it's necessary. I think that as long as the company maintains the 2+ year reserve, and rather than just drawing down on that reserve, seeks to pay the ongoing dividends out of additional equity issuances and only using the reserve if there is, a situation maybe where perhaps one that we're in today where the price of Bitcoin is down 50%, it might make sense to draw on the reserve. But generally speaking, I think that the size is appropriate. I would also say, I think that it's always good to have options, right? And the reserve, we're focused so much on dividends, but you could also potentially, another option is to use that reserve to handle potentially a put of the convertible bond that is puttable at the end of next year. It's just an option. It's good to have options, right? Maybe that option will never need to be, even addressed, but it might. And in my experience, companies that do well, generally speaking, are the companies that avail themselves of the options that the capital markets provide, taking the money when it's available, taking the money, even if you think it's expensive, taking the money when you don't necessarily need it. It's usually those companies that wind up, living through the cycle, being there for the long term. Capital gets really expensive when you need it. So better to have the reserve, I think. And I think there's no question that the investors, it's changed the perception of the company dramatically.
Well, I was speaking before about the fact that the detractors of strategy will grab onto anything they can, and this is a recent example where it's, if you're going to have all these dividends, then how are you going to be able to address them? And frankly, this is another example of the company seeing a concern in the market or a criticism in the market and addressing it directly, saying, we're going to learn from our lived experience and adapt our approach accordingly. Which from an investor psychology standpoint makes a tremendous amount of sense, as opposed to being obstinate and saying, well, we don't need to do that or what have you. Sometimes you need to listen to the market, and that's exactly what the management team has done.
Yeah, I don't think more than 2 years is needed, right? Like you would have to think that you're in a bear cycle for more than 2 years, and if you have 3-4 years of fiat on your balance sheet, it's kind of the opposite of what strategy stands for, right? So I'd be surprised if you go there. And I mentioned this earlier, right? But I think credit investors will, at some point, start to underwrite and appreciate that there's 2 years of fiat coverage, right? But there's decades of Bitcoin coverage. And I think that's a really important thing to keep in mind.
Great. I want to switch the tone a little bit now, and I want to get your perspective on what is the most realistic bearish case on Bitcoin price and Bitcoin adoption, in your opinion, and how does that impact MSTR? Andrew?
I'd like to say we're in it right now.
Okay.
I think a potential bear case, and like I talked about institutional adoption earlier, is right if volatility of Bitcoin is always kind of at a level where institutions don't feel that they can stomach it, right? So if you want, if there might be a corporate that wants to have Bitcoin as their treasury reserve strategy and their treasury reserve asset, but if Bitcoin's moving 5-10% on any given day, whether we're at 60,000 or 120,000, I think that will make it challenging for certain types of institutions to adopt it as their reserve asset. And so I think that's a bit of a potential bear case you could think about, is just slower adoption from the institutional side because there's just too much volatility for them to stomach.
The reality is that Bitcoin, remains a volatile asset, and it is also, to a large extent, influenced by what's going on in the macro. And we've seen this before. If you look at the second week of March in 2020, when the COVID-19 pandemic broke out, we saw Bitcoin, plunge overnight, just in response to what was going on in the macro. It wasn't as if COVID-19 pandemic was influencing what was going on with Bitcoin in particular. it simply reflected the fact that Bitcoin is going to be influenced by macro factors to a large extent, given its volatility and its nature as a risk asset. So where could we go from here? As I said before, we haven't gone to the full 70 or 80% downdraft that we had seen 3 times previous to this historically. Could we go there again? Yes, we could. What would drive that? Most likely, it's just going to be macro factors. And frankly, if that's going to be occurring, then other risk assets are going to be plunging alongside of it. But I think what really matters now is the fact that Bitcoin has been a part of the institutional spectrum of potential assets to invest in for some time. And as I said, we are on the verge now of having a full regulatory buy-in by the United States as it pertains to crypto writ large, Bitcoin being an enormous part of that. And so in the past, again, it's only a few years ago that we were hearing people saying crypto is dead because we had one rogue entity that blew up, and people were writing it off. Well, I think that the resilience of Bitcoin, the resilience of crypto writ large, has been demonstrated since then. The interest of institutions has been demonstrated, and this is why I look at this as being more of a garden variety downturn than anything structural or anything more than really a reflection of what's going on in the macro.
So I see Bitcoin primarily as digital gold. Okay, so for me, the primary reason that I'm so excited about Bitcoin is not because I think it's going to go to X price. I mean, that's great, right? But it's really because I see it as a better way to store and transfer value across time and space over long periods of time and over great distances. So when I think about the sort of the bear case around adoption, it's really more about apathy. I think that people in this, people that I talk to, so many of them have just become, accustomed to the idea that the value of their currency is going to go down, 90% over the course of their lifetime. And there just doesn't seem to be any urgency to address that. They've almost just they're taking it for granted. I mean, and by the way, when I was a kid, candy bar cost 25 cents. Today, that same candy bar, it's not any bigger, it's not any better, it costs $2.50, right? So my life's not over yet, and yet the value of my dollars have gone down 90% from when I was a kid. Where's the outrage, right? There is none. So, apathy to me means that for all of its superior technical attributes, maybe we just see the pace of adoption of Bitcoin to be very slow, meaning that the price goes up and people make some money. But, in terms of sort of the revolutionary aspects of it, really sort of building a better form of money, it's that apathy, I think, that's the only real risk that I see.
Great, excellent. So we are going to go through an interesting exercise, a lightning round, of questions where you have to reply in one word or one sentence for my questions. And we can go in the order from Lance to Andrew. And keep it brief. So what do you think about MSTR's structural leverage? Is it prudent or aggressive?
Starting with me?
Starting with Lance.
It's prudent and aggressive. And I'll be really quick, but it's prudent because the company is able to withstand even a prolonged downturn. Bitcoin could go to zero for several years and the company would be able to survive. I'm not saying it would be fun, but the company would live to fight another day if Bitcoin came back in a few years, right? It's aggressive because if and when Bitcoin does what we think it will do, then the stakeholders make a ton of money.
I would say prudent within the context of the company's capital structure, which was designed specifically to be able to absorb the volatility associated with Bitcoin.
I'd say something I've heard you say many times, intelligent leverage.
Great. And we're moving towards amplification than just leverage, because once the converts go away, the leverage goes away. Mm-hmm. Next question, MSTR's MNAV in 3 years' time. Higher or lower from where we are?
Higher.
Yes,
Higher because I believe there's going to be a shakeout, and that's going to bring a lot of the capital that has gone to other Bitcoin treasury strategy companies back to the largest and the one that's been the most effective.
Higher.
So we have a consensus here, going higher. MSTR's long-term BTC yield, a single digit or double digit?
So, okay, so long term, right? So I would say when I think about long term, and you and I might have different definitions of that, I would say mid to high single digits.
Okay, Mark?
I would go a little bit higher simply because of the nature of Bitcoin itself and the growth that we have seen in not only adoption of Bitcoin, but its price. You know, I think double digits is definitely feasible.
Yeah, I think mid-teens, our price target's based off of 15% Bitcoin yield. And I mean, we did more than 22% last year. And I think 15 is a reasonable run rate.
Excellent. If we see the digital credit adoption expand rapidly, then the potential is pretty high. And Bitcoin price at the end of 2026?
177.
177,000?
177,000.
That's a nice number, okay. Precise.
We're in print with that number. We've been in print with that number for a reasonable period of time.
Mark?
Not new.
Yeah, this feels like the price is right. 225,000 is our assumption.
Okay.
And remember, we do have the big catalyst coming up with the Clarity Act, so that's a big part of that.
That's great.
Yeah, I don't have a crystal ball. I'll give more of a qualitative answer. We think it's higher, right? We think it's a 30% ARR long-term asset.
Okay, so we have a consensus higher also from here. And the last question here, keeping the time in mind, is MSTR, out of the three options I'll give you, credit platform, equity amplifier, or synthetic ETF?
Yes, all of the above.
I would agree. It is all the above. We are moving more toward being a credit platform all the time, and that's for the better.
I think it's the first two. It depends on the eye of the beholder as well. I don't view it too much as a synthetic ETF at all, but I think it is a credit platform, and it is a equity amplifier because of that.
Excellent. Okay, on that note, I will wrap it up here, and thank you all for your support and insights. Thank you.
Thanks.
Thanks, Sri.
Introduce our next speaker. He comes from my second favorite country in the world, Italy. My first is America, of course. Manuel Andriani is the head of prime sales at Anchorage Digital, and he'll be speaking about operationalizing Bitcoin treasuries, and he has a very special announcement. So welcome, Manuel.
All right. Thanks everyone for having me. I'm Manuel Andriani. I lead the prime sales business at Anchorage, and today we're going to talk about operationalizing Bitcoin. A little bit about myself. I've been at Anchorage for about 5 years. Before that, I used to be in traditional finance, a mix of buy side and sell side. Credit Suisse at Deutsche Bank Prime Brokerage, as well as AQR, a quantitative hedge fund, where I was part of the treasury and portfolio finance team. For all of you, even large hedge funds that like AQR, they have 220 billion in assets under management, need to have a focused team, obviously, to manage the cash, as well as the prime brokerage relationships from a financing perspective. So today, with that background, obviously, and also the crypto background at Anchorage, I'm going to talk to you guys. I'm also going to wear the Bitcoiner hat today while I share this with you. Let's talk about Anchorage Digital. Founded in 2017. We are, when I joined, we were about 70 people. Right now, we are over 700. The most recent valuation is 4.2 billion. There was a recent investment from Tether, given the partnership that we have as a stablecoin issuer of USAT, the dollar version of USDT. And we have been growing. We are also very well known to be the home of the first federally chartered crypto bank, Anchorage Digital Bank. Importantly, how we've been thinking about the strategy is we have built the foundation from a custody perspective first, and then from a tech perspective, we have a very unique way to custody the private keys, and then we have created the most regulated, in particular in the US, but also offshore like in Singapore, the most regulated way to deliver our technology through effectively regulated licenses. The why for Bitcoin treasuries. I think I'm not going to spend too much time on this. Obviously, there is $2+ trillion in corporate treasury cash sitting idle, earning not that much or not attractive yield. And so there's definitely a why, but I think today we're going to spend most of the time talking about how can we operationalize holding Bitcoin, which is very important. I am going to start with a story. So that is myself playing soccer. You hear an accent. So I'm originally from Italy. I was born there and grew up there, and I played soccer throughout my youth, and then moved to the States on an athletic scholarship. I played at St. Thomas University. Why do I say that? Because as part of my youth and soccer career, I grew up in this youth academy in Rome, where literally every single team from the age of 10 to 19 years old, that we use the same formation. It's pretty unique to find that, meaning there was no fluctuation based on coaches, views or standards. The soccer academy was like, this is the way to do it. There is a specific formation, 3-5-2. Everyone needs to play that way. There's a system there, and everyone needs to know what they're doing and trust the system. I think that's very important because it's going to be a key component of operationalizing properly Bitcoin, right? There is always a way to perform at best. And I think a small story there that definitely capture that argument, in particular under pressure. We won 2 Italian championships, one when I was 17 and the other one when I was 18. I remember the last final before we won, where we were down 2-0 in the first half, and everyone was a little bit, panicking. But then I remember the coach in the locker room saying, we have prepped with this. You guys grew up with the same formation, the same model. You know what you're doing. Just stick to it, and it will get better. As long as you trust the preparation and you trust the model, you're gonna be fine. We came back and we actually won 4-2 and we won the Italian championship. So that's really to share like a personal story that connects with the way I feel like treasuries should operationalize Bitcoin, to stick to the system and trust the preparation. There are going to be moments of stress, in particular when Bitcoin goes up and down, right, with a lot of volatility. And obviously there are other ways to potentially not absorb that, but which we can talk more about later. But definitely stick to the system and trust the preparation. Step by step. Here there are 7 steps that we're going to go through today as part of operationalizing Bitcoin that are going to be critical. Let's start with the first one, which is due diligence. The work before the work determines everything that follows. That's very important. In particular, given also my my experience at AQR, right? What was critical is definitely to create the right set of partners to work with. And before doing that, there is a research in the market that needs to be done. That research should have two folds, I would say. One is obviously public information research, and the other one is being able to talk to industry experts and other stakeholders in the ecosystem to get some feedback, right? We're a lot of companies out there, but it's a small world, and reputation matters a lot. So you'll get very valuable information out there. Then with that, build a short list. Obviously, you cannot due diligence everyone in particular because the due diligence process is quite onerous if done properly. So building a short list of the partners you want to work with from a custody, trading, staking perspective is very important. And then start the deep due diligence. I think from an Anchorage perspective, we've seen some due diligences, last several months, I would say, and others just a few weeks. But in general, I would say the average is about a month. And definitely going beyond the pitch deck is important. And analyzing the regulatory framework that the counterparty operates under, the security, the legal risks, the operational risks. So there's a lot there, and if done properly, it takes a lot of resources and a lot of time, but it's very critical. And then I'm going to say something, not very salesy of me, even if I'm the head of Prime Sales. But as I said, I'm talking as a Bitcoiner as well today. I think it's important to have redundancy. Picking just one counterparty for everything creates too much concentration risk. Ideally, you're going to be able to find platform like Anchorage that offer trading, custody, settlement, all in one shop. But if not, it's important to have multiple options, at least two, if not more. Definitely, that is important. Once the due diligence is done and you have found two or so partners to partner with, then the next step is acquisition, right? How to buy. Let's start with approved counterparties, as I said, and then the other one is now it's time to trade. Let's be clear at this point, Bitcoin is a global macro asset, non-emerging asset. The liquidity of it is incredible if you compare it in particular to the most liquid stocks in the S&P 500 like Apple and Nvidia. So the depth of the market is there. And I would say every counterparty in particular at the highest standard like Anchorage and others will give you access to deep liquidity. Now, what are the differentiators there though? I think it's important to have a multi-threaded access to that deep liquidity. What I mean by that, if a counterparty has just access to a centralized exchange, that's probably not enough. If only access to a US centralized exchange, that's probably not enough. So that trading counterparty ideally has the ability to get access to offshore exchanges, onshore exchanges, as well as OTC flow. I mentioned the over-the-counter flow because there are times where some of the over-the-counter counterparties, trading counterparties might have access that, a multi-threaded access to liquidity desk can definitely take advantage of. And sometimes the pricing, based on in particular in large sizes, can be better than centralized exchanges. In terms of the way to trade it, obviously TWAP is still the most common used strategy, but the ability to have a very strong algo and the smart order router that is able to standardize the different pricing feed, pick the best price. And also another important point, anonymize the trading flow is very important. Why do I say anonymize? Because obviously, the blockchain is out there, the flows are out there. So the ability to have someone that anonymizes that flow for you, I think is definitely a value added. And then going back to probably a recurring theme here, as a treasurer, as a corporation, treat it like cash, right? Try to not create a different process to what you're already familiar with as much as possible, as long as you find the counterparties that allow you to do that. Then once you buy the Bitcoin, now you need to use a secure custody solution, obviously, right? The key component here to understand is, you might have heard this phrase before, the keys are the assets here. The private keys are the asset. So the ability to find the right custodian that has the right tech and the right security model is critical. Some of the features of that critical security infrastructure is no single parties can control access, right? Having quorum-based decisions and movements and approvals is going to be very important. The keys must be access controlled. In particular, for example, at Anchorage, we use a iOS app to collect biometric information that allow the authentication of a user that is part of a quorum. So that allows for obviously a great user experience, but also, I would say some type of, increased speed in authentication. And then obviously redundancy matters a lot. So redundancy in terms of, does the custodian have multiple geolocations around the world and backup processes to support your activity? I think I want to share an anecdote here that is very important. And a lot of the clients that use Anchorage from an institutional perspective appreciate it. Anchorage started as a custodian and then built on top of custody a lot of other services like trading, financing, staking. And I think that has proven to be the best model to really succeed and scale. You might have seen other institutional players that have started with an asset management platform or with a trading platform, and they've tried to build a custody solution and they have failed. So that is demonstrates how hard it is to build a good custody business. And I think Anchorage is an example of where your custody is the foundation and then we have built on top. Treasury workflow integration. Here now, you have found the right partners, bought Bitcoin. There's, a custody solution that can hold the Bitcoin. I think now it's as I said, it's like treat it as cash. Treat it as other assets that you have is important. And so a workflow integration is critical there. Having like role-based access, for example. What I mean by that is we have a lot of our institutions that have read-only users. They have super users that can do everything, that approve withdrawals, that can approve changing in the quorums and things like that. Or we have like middle level, I would say, access. But role-based access is very important because there are obviously different functions and different players. Integrated settlement. I think I alluded to it before. Ideally, simplicity is the ultimate sophistication, as Leonardo da Vinci used to say, in the sense that if you can find a partner that has both the custody as well as the trading as well as the settlement infrastructure, you have everything in one place from a usability perspective, user experience, coverage model. I think it's definitely going to be of value added versus having a trading only counterpart and using a custodian. Now you need to use two different UIs, two different platforms. It gets more complicated, doable, but definitely gets more complicated. And then importantly, in order to, integrating in the workflow, you need to have real-time dashboard. So user experience, I go back to that point, having a UI, having the ability, for example, to access the information via APIs needed, I think it's very important. Settlement and liquidity management. We go back to what I've mentioned a few times already, which is having a custodian that also has trading capabilities is very important because it allows for a smoother settlement. Another thing that we have noticed is that in order to trade, in particular over the weekend, whenever there is no US access, US wire windows and dollar access, a lot of our clients are using stable coins. So something to think about from a liquidity management is to keep a buffer in stable coins so that it can be used to trade. I think having siloed workflows, as I mentioned, is like integrating Bitcoin as much as possible with the current infrastructure is critical. And so the settlement infrastructure really exists to compress and secure the entire workflow. That is something extremely important to keep in mind. Now, once you have traded, custodied, settled, created, obviously the right monitoring, as I said, via API, UI, now what can you do more with Bitcoin? One example, obviously, is layering yield on top. Two examples here is lending and OTC options. I would like to speak a little bit more about OTC options today. I think you've heard a lot probably around lending. Why is that the case? Because the OTC option landscape has changed quite a bit. In particular, like a 1 billion notional trade a few years ago, 3 years ago, used to be pretty big. Right now, it's not. So there's been definitely a liquidity increase and the depth of the market is higher to allow for a lot of OTC options. In particular, wearing the Bitcoiner hat, if a counterparty is able to give you cash settle options where if you get elected, you don't need to sell your Bitcoin. I think it's very important, and that's a product, in particular at Anchorage, that has been extremely successful. At Days, our OTC option desk is the largest seller of Gamma in the market. So that is, again, a testament of how much, in particular, this business is yield layering, selling volatility has been a very successful way to generate yield. Importantly here, last but not least, audit and compliance, right? I wanted to say it's important. It's less sexier than other things that we've been talking about, definitely, but it is important. Internal controls should mirror traditional finance, right? Again, don't create ideally, if you find the partners that are not gonna require you to create completely different processes, it's the key. And I think Anchorage has been able to achieve that with a lot of the institutional counterparties that we have. Approvals and dual sign-offs, automated reconciliation. I think that's an important one that a lot of the clients struggle with, but if you have the right partner with API access and automated reporting, it's definitely gonna improve all that friction. And then policy-based alerts, so real-time alerts and based on specific thresholds, I think is important. So those are the 7 steps. And I think just to confirm what we have seen in the field, I think it's hard to time the market. We all know that, in particular, given the volatility of Bitcoin as an asset class. I think the most important thing is to have better operations and have better controls and stick to the system and really focus on that versus trying to time the market or have better conviction than others. I think that's what we have seen. Like the most successful corporate treasury companies out there are really the ones that focus a lot on the operations and on the system that I've been talking about. The right infrastructure accelerates adoption. This is where someone like Anchorage Digital really comes in. What we do is we feel the burden of what we do in the sense that we know that it's extremely important because our institutional product really needs to be tailored to our institutional clients in such a way that the process that I've discussed and all the friction that could arise with it are minimized. So we truly feel like it's important for us to continue to be a partner for a lot of the corporate treasuries and DAOs out there and try and keep improving with them. We really value the relationship, we really value feedback from them, and we try to iterate. But we feel the burden of being the best in class from an institutional perspective, and we'll keep doing that. I think one important point that proves that, in particular in a situation right now where as a corporate treasury company ourselves, we might not be, going back to the timing of the market, we might not be as comfortable with the volatility of Bitcoin. We, with the partnership with Strategy, we have found the right product that fits our needs. And it also is able to fit the process and the standards we have, which is Stretch. So I'm very happy to announce that Anchorage Digital now holds Stretch on its balance sheet. And I think, again, thank you. I think Nathan, our co-founder and CEO, was very adamant to definitely announce this today, in particular because sometimes you're in the back end, you don't know Anchorage is really working for a lot of the players out there, but the reality is that we don't just build the infrastructure, right? We use it ourselves, and that's how we really get better. To summarize, again, all that we have discussed today, key takeaways, right? Treat Bitcoin like cash, not a speculation. Test your workflows and scale responsibly. Play the long game. I think we're all here really to play the long one, not the short one. And in that case, don't wait for price to change or market hype to dictate adoption. You know that there are partners out there that can help you boost that adoption, like Anchorage. So please, leverage us as much as possible and others in the ecosystem because we really feel like we're doing the best for institutional adoption of Bitcoin. And then build the foundation and operationalize your treasury from the ground up, right? Stick to the system and trust your preparation. With that, I want to thank you all and appreciate your time.
Our next speaker is Peter Haynes. He is the Managing Director, Index Products and Market Structure Research at TD Securities. His session is called The Importance of Index Inclusion for Digital Asset Treasury Companies. Welcome, Peter.
Because I had a meeting with him one-on-one, and he literally was the one telling me, you know what's so funny? I'm going to keep this.
Bitcoin, I'm the one, the gentleman said earlier, who doesn't understand what private keys are. I would need that same lesson that they had to give on the roadshow for the IPO for BitGo. But again, very pleased to be here. Thank you very much. I've been with TD for 31 years, and my life has been focused on index and market structure issues. So I'm going to talk a little bit about index issues, first of all. And you're saying to yourself, well, why are we talking about index issues as digital asset treasury companies? And that's because I could have been up here talking about the fourth funeral. We heard the presentation earlier today from Phong about 3 funerals and a wedding. And thankfully, I'm not up here talking about a funeral which might have been a digital asset treasury companies being removed from popular benchmarks, because that was an issue that many of you in the room will be familiar with, was a topic in late 2025. So I want to talk a little bit about how we got to where we are, why benchmarks are important, and then I'll finish up with a little bit about market structure, which we've heard a little bit about today. I have a different view on this, on the term than maybe others will, and I'll give you my 2 cents on that. So first of all, let's talk about digital asset treasury companies and why indexing is important. Well, again, I think by now most people in the room will know that if you get added to a popular benchmark, large index funds, Vanguard, State Street, BlackRock, and others, are likely going to have tracking vehicles that will then need to own the names that are in benchmarks. Now, this is an area that has grown in popularity to the point where some people think we may be at peak indexing. What is that? Is that 50% of the shares in the market are held by index funds? Maybe. Is that a limit? No. And we're continuing to see growth. But when we think about why index inclusion is important, I'll just tell you a quick story that happened a couple of weeks ago, and that was with respect to Indonesia. And it also had to do with an index provider by the name of MSCI, which first created some disruption in the Bitcoin space, or the DATCO space. And so what happened with Indonesia was one day, this is a country that's on the come right now. It's an emerging market where the market capitalization of the entire country was approaching $1 trillion. And then one day, MSCI announced after the close that they were considering moving Indonesia from what is known as an emerging market, second level status, below developed, to frontier, which is the third level status. The next day, the Indonesian market traded limit down. Their limit is to move 8% in one day. Opened up the next day, was limit down again, and has only recently started to recover. Why was that? MSCI was concerned, because some of their users were concerned, that companies in Indonesia did not have proper disclosure of who their shareholders were, in particular, cross-holdings, large control blocks, which are important to the technology around how indices are designed. So that's an example of why indices are important. Within the span of 24 hours, an index provider had an impact on an individual market to the tune of about $150 billion. Now, again, index providers have become very important. They've done so without a lot of regulation, and that is an issue that is brought up regularly, and that is who regulates the index providers. The answer is no, nobody, unfortunately, and that's because it's a global business and it tends to cross borders, and no one really feels like they own it, and it's a concern of mine that we don't necessarily have a regulator, one regulator, that is the cop on the beat, so to speak, with respect to index issues. So when I think about broad benchmarks, one of the biggest changes I've seen in my career is that when I started out, if you thought about investing in globally, you thought about buying individual markets in their local benchmark. In France, that would be the CAC 40. In Germany, would be the DAX. In London, it would be the FTSE, Nikkei in Japan. You would build your global portfolio by owning the individual countries. That world has changed completely. Nobody buys an individual market anymore. They might use derivatives to gain synthetic exposure to move in and out of a market, but they're not going to hold a core portfolio based on the local market. That's global benchmarks. On the other hand, local investors really care about their local markets. So we have this divergence, so to speak, between index providers focusing on domestic markets on the one hand and what stocks belong in an individual country. And then on the other hand, you have global indexers focused on just making sure a company is properly in a benchmark and is in some domicile, likely the one where it's incorporated. So this divergence has been something that's caused problems for index providers. For instance, when two global companies merge, Rio Tinto and Glencore, rumored merger, is that going to be an Australian company or is it going to be a UK company? So these are the issues that have a lot of impact with respect to benchmarks. When you think about the broad-based indices in the United States, some of the familiar names that come to mind are names in which MicroStrategy, I'm using this as an example to give you a sense of how big indexing is with respect to MicroStrategy. If you can read the numbers on that slide, 27.1% of the shares of MicroStrategy are held by index funds. When we go down the line here, CRISP is at the top of the list. CRISP is an index provider that was recently bought by Morningstar, but their primary client is Vanguard. So when you see CRISP indices, that's likely Vanguard that owns it. Underneath that, you have MSCI, you have S&P, in the case of the completion benchmark. That's any stock that's not in the 500, that's in the total market in the US. You have Russell 1000, NASDAQ 100, and several other more niche type names. If you get into a really niche sector, you'll see that indexing could be as high as 50% for, say, gold stocks or copper companies or uranium and nuclear companies. At the end of the day, that 27% number for MicroStrategy is lower than it would be for companies of similar size. And the main reason for that is because MicroStrategy is not a member of the S&P 500, which is the large cap benchmark in the US. If it was, MicroStrategy's index holdings would be closer to 40%. But again, we ran into an issue here where the index community started to question, and it started, I think, from the users, question the index providers on whether or not digital asset treasury companies belonged in benchmarks that are supposed to reflect operating companies. And so this became a debate, as you know, and many of you in this room are aware of. There was a complaint, as I say, from the index community. And where it started was in September when Metaplanet went to, I think it was a $700 or $800 million equity offering, where their planned proceeds were to entirely buy digital assets. When that issue came, that's seemed to be the tipping point for the index community, or at least for MSCI. And MSCI put out a notice saying that they were halting any weighting changes or adjustments for digital asset treasury companies until they studied this issue further, and they're thinking about potentially removing digital asset treasury companies if they deem them to be not operating companies. So that started a process which went along throughout the fall. MSCI published a list of names which they recently updated. And then the other index providers, FTSE and S&P, through their advisory panels. I'm on the advisory panel for each of FTSE and S&P in the US and Canada. And both of those index providers started to study this issue. And in the case of S&P in the fall, this was a point in time when MicroStrategy was considered by the index analysts as one of the top candidates for the S&P 500. But at the meeting that occurred in October, when arguably the index community, of which I'm part of, debated whether or not to include these names, or were discussing whether or not these names should be eligible for popular benchmarks, generally speaking, the crowd in that room said no. No, these are not operating companies if they're holding Bitcoin on their balance sheet and Bitcoin represents the majority of their assets. They're not operating companies. That was, again, don't shoot messenger here. I'm simply trying to relate to you how the index community was thinking at that time. So shortly thereafter, when MSCI was going through its consultation, the companies in the industry did what they should do, which was went on a listening tour and an education tour. And that included the executives of MicroStrategy, and letters were written by Strive, by Mara, by MicroStrategy that were sent to MSCI, and I think in each case were made public. I cannot tell you how important it was that the companies in the industry came out and explained to the index community, of which I'm part of, what is a digital asset treasury company. And now we understand a little bit better. They're not all the same things. It's not the first time that index providers have considered Xing out a group or a certain type of security. And you can see in the history here, the one I want to point to is multi-voting shares. Back in 2017, all the index providers decided we're getting rid of multi-voting shares. And it all came about when Snap went public in June of 2017. And at that point in time, it was the first issue in the United States where 0 shares that would be in the public hands, the percentage of votes would be 0 for those shares. They're true non-voting shares. So the index community put a halt on that. It took them 6 years to reverse that decision. Luckily, that has not yet happened to the DATCO community, because where we're at right now, as I mentioned, Strategy and others wrote letters, is we are in a holding pattern. And that's because MSCI, and many of you would have read this January 15th date was the most important date for Bitcoin. And I was kind of thinking as an index person, it's not going to be the most important date for Bitcoin because we don't know what MSCI is going to do. And at the end of the day, they made their announcement, I think on January 6th, that they were pausing. They had decided that they needed to get more information. At the end of the day, there are a bunch of issues with respect to how the index providers were thinking about potentially determining which stocks belonged in the index and which didn't. And many of you would have heard about this 50% asset hurdle. If a company owned more than 50% of digital assets on its balance sheet, then it would be ineligible for the index. And that, of course, introduces accounting games. FTSE suggested 35%. Once again, it was unworkable. There were lots of other good reasons mentioned, not the least of which came from the strategy letter. And Mara, I think, said the same thing. And that is that these companies are operating companies. We've heard all day today about the underlying enterprise software business that Strategy runs. And Mara will argue they're like a gold mining company in that they are actually in the mining and the infrastructure space. And so each of these companies wrote their letters explaining that they're not homogenous, they're not, all the companies in the industry are not the same. And I think that was very important because it allowed the index community, first of all, to be educated, and second of all, to take a step back and realize we've got to get this right. So how I think this is going to play out, and I don't know this for sure, is that we're just going to go into a quiet period. We're waiting for MSCI to come back and tell us whether or not they plan to eventually remove DATCOs from the index. My guess is they won't. And why is that? Because as they look further into the definition of an operating company, it could be argued there's several companies in the index today that fit the same mold if you want to go into that debate. I start with the private equity firms. Then I think about Berkshire. I've asked everyone I can talk to, how did Berkshire get in the index in 2010? And no one seems to have an answer of why people weren't questioning, why we're essentially putting in a fund company into an index. But they did, and now it's one of the 10 biggest companies in the S&P 500. So in my opinion, this issue is going to just fester. It's too complicated. It's a rabbit hole. If you exclude DATCOs or certain DATCOs, why are you not excluding the companies I just mentioned or REITs and other things that people want to debate? So that's how I think this is going to play out. And I don't have a timeline. Haven't heard anything more from FTSE. Haven't heard anything more from S&P. FTSE does have an advisory meeting in March, so maybe that'll be brought up again. But in the case of MSCI, we're waiting for MSCI to come back and tell us more and make a decision ultimately whether this is just going to go to the sidelines or they'll actually take action. My opinion is they won't because, again, it's a rabbit hole. So as I mentioned, S&P and FTSE, we're in a holding pattern on each of those index providers. At the end of the day, I think we're in a holding period, and I'm of the view that these companies will not ultimately be removed. And again, I want to credit the DATCO industry and each of the issuers that's part of that industry. And here's the list that MSCI published again last week. And you can see from this list, this is the DATCO community, but not all DATCOs are the same, as we know. There's one DATCO in the S&P 1500, that's Mara. It's a small cap name in the S&P 600. And again, very different company than some of the others that are discussed in that space. So that's the part I wanted to discuss with respect to indices and the future of DATCOs in various benchmarks. I want to finish up just spending a quick minute here on some of the other issues that we're thinking about in the index community that you think about in this room. And I'm going to start with tokenization. When the gentleman earlier from BitGo was talking about market structure, I think of market structure from the perspective of how stocks trade. When he mentioned the term best execution, this is the key issue that we're dealing with respect to tokenization. If equity securities are able to trade in traditional finance, TradFi as we're calling it, on the New York Stock Exchange, NASDAQ, CBOE, or anywhere else, and then also trading on Coinbase and Kraken and other marketplaces, and at the end of the day, the underlying risk is the same, then we need to have the same set of rules in the DeFi world that we have in the TradFi world, and we need to converge. And that's the issue that we're thinking about. For instance, Our obligation as a broker is always to get clients the best price. Well, if the best price is in a DeFi world, is that going to be part of what is known as the order protection rule? That's a rule we expect the regulators to scrap, but those are the types of debates that we're having in market structure land. Next issue real quick here, SpaceX. If Elon decides in the IPO to include tokenized SpaceX shares for a portion of that IPO, then that is game on for the token game, because we'll have to all figure out how are these tokens going to be traded. New York Stock Exchange is launching a tokenized ATS. The others will do the same, I'm sure. But at the end of the day, the TradFi world can't handle the tokenized equity trading at this stage. So that would be a game on, and who knows if it's going to happen. SpaceX IPO, game changer. All the index providers have to change their rules to accept a company that's going to be over $1 trillion or 1.5 trillion in value, of which maybe 900 billion of that could be in the public hands after you take away the Musk control block. Again, we're waiting to see the details on that sometime later this year. Largest IPO in history, and obviously going to be one of the largest companies, and yet it may not qualify for the S&P 500 ever, because it has a rule that says you have to be profitable. Well, if SpaceX is not profitable, then it'll never be included in the index, and we think that rule needs to change, because we can't have $2 trillion companies that represent an important part of the investable universe of the US market, not in the proper benchmarks. And then finally, 24/7 trading. You may have read yesterday, I believe Coinbase announced that it's moving to 24/5 trading for equities in the United States, following other market participants like Robinhood and Schwab. And I think that's a big development, is the convergence of the crypto market and 24/7 trading into the traditional market structure that we're used to in trading stocks, including MSTR and MAR and every other one. So I'm going to stop there. Again, I'll be around, so if anyone has any follow-up questions on the Index Nerd, come and talk to me. But I appreciate the invitation to speak here today, and wish you the best of the rest of the conference. Thank you.
Sessions coming up for you. The first will be with Jeff Walton, the Chief Risk Officer for Strive. That'll be titled Digital Risk, followed by Redefining Corporate Treasury, Prevalon Energy's STRC Adoption with Benjamin Honeywell, Chief Financial Officer at Prevalon Energy. But first up, please welcome Jeff Walton.
Back. We're here. Excited to be here. Okay, who's completely fried? It's 4:45. Are you ready to learn? We've got some exciting topics here. We're going to talk more about regulation. We're going to have some fun. We're going to get into digital risk. So let's jump into it. Digital risk and the risk rating gap. And I believe this is really the single most important regulatory variable for future institutional adoption of Bitcoin. So let's unpack it a little bit. So Basel III, you've probably heard this a couple times now, which is post-2009 banking regulatory reform. So after the 2007-2008 financial crisis, the G20 came together and they talked about how can we improve our capital markets? How can we improve capital quality? How can we improve liquidity? How can we remove excess leverage and make sure that whatever just happened doesn't happen again? So they came up with the Basel III standards, which is the risk weightings that you see on the screen here today. So let's walk through them. We've got Basel III risk weights. Gold, 0%. Government bonds, 0 to 20%. Mortgages, which almost took down the entire global financial system in 2008, 35 to 100%. Corporate loans, 20 to 100, public equity, 250, and Bitcoin with 1,250%. So Bitcoin is 5 times more risky in the regulatory eyes than public equity. That's interesting. So what's the purpose of the risk weightings, right? Not all assets are created equal, so there's got to be some framework to protect the capital on a bank's balance sheet, so there isn't excess leverage in the system, so there's no collapse into the future. So what does that do? Like, what does this look like? Right? So here's some risk weighting regulation incentives. So this is a pro forma balance sheet. We're going to just assume this is a bank that's holding some assets. So these assets, you've got cash, 10 million, treasuries, 30 million, mortgages, 40 million, corporate loans, 15 million, and Bitcoin at 5 million. And you see the furthest column over to the right, the risk-weighted value, 0 for cash, 0 for treasuries, 20 million for mortgages, 15 million for corporate loans, and 62.5 million for Bitcoin. So if you've got a $100 million balance sheet and this is your risk weighting, you'd have to hold $97.5 million against that $100 million. Now, if you pull Bitcoin, if you pull that entire line item out, you now have $35 million of risk-weighted value against $95 million of capital. So a 5% allocation to Bitcoin currently would triple the capital requirements that a bank needs to hold. So as you can see, there's no way that a bank would hold Bitcoin on their balance sheet because they can't lend against it, and they would have to hold excess capital against the instrument on the balance sheet. So does this make sense? Let's do a structural comparison of the US dollar, gold, Bitcoin, and public equities. So let's just run down a few of these. Supply control, right? We know that there's 21 million Bitcoin. How many US dollars are there? Unknown. Gold, unknown supply. You know, you can mine it on asteroids into the future. Potentially we're able to make more of it via chemistry in the future with AI. Public equities, obviously, they're paper contracts they can dilute. Monetary policy, fixed with Bitcoin. Transparent, Bitcoin, you can see every single transaction that happens on the ledger, incredibly transparent. Settlement happens instantly with Bitcoin. Custody and risk, it's a bearer asset. You can actually hold it. Gold gets a gold yellow star here. Debasement, Bitcoin can't be debased. Sovereign risk, there's no debt associated with Bitcoin, right? The US dollar has got $38 trillion of debt associated with it. And then you compare all of these things and you look at the risk weighting on the bottom. And that starts to bring up some questions, right? Does that make sense? How do we think about that? It's a bit odd. So what's the problem? What's the fundamental problem? Bitcoin is lumped together with all of crypto. And I'm sure, as everybody knows in this room, Bitcoin, not crypto, right? Bitcoin is an asset without an issuer, whereas all of the other coins in the entire crypto ecosystem have fundamentally different designs, and they have people that are controlling the particular instruments. So there's a ton of education that needs to be done on the differences between Bitcoin and crypto, but then also talking about the risk profile as we walked on the last slide. So how do we start to think about this? Just gonna have you watch the GIF here for a moment. These are from Check on Chain, and this is 30 different charts out of the 2,000 charts that he has on his website, looking at every single component of Bitcoin over its timeline. You could look at different wallet transactions, you could look at how long Bitcoin has been held, you could see how it moves. And this is just one analyst in the world of the thousands of analysts that can be looking, and thousands of analysts and AI agents that can be analyzing the transparent data 24/7, 365. So why is this important? Bitcoin is just incredibly observable. And there's, in my opinion, that observability allows you to calculate that risk much easier than anything else in the market. And right now, that transparency is being punitive. The regulatory environment is punitive against the transparency. So it is volatile, yes, but it is incredibly observable, fully auditable, and unmatched amount of data. So let's talk about the digital credit frontier, because this is a function of this, right? We've got the capital environment is very punitive against Bitcoin. So how do we start to think about this from a digital credit standpoint? So we've got two components here. Now, with traditional credit, you've got quarterly reporting, 90-day lag. You've got opaque assets that are sitting on the balance sheet. The balance sheet statements that come out every quarter. They're backward looking. The businesses are only open during business hours. You can't call anybody and see, what's going on with the company. So every time you get a quarterly report, you have to re-rate the entire balance sheet. You have to re-rate the entire company. You have to re-rate the entire risk profile of the instrument. And during that time horizon, each quarter, it's trading off of asymmetric information. So that makes these instruments just inherently illiquid because you have a lack of information on the actual risk of that instrument. Now enter digital credit. Incredible innovation where you have real-time Bitcoin price, so zero lag on any of the data or the information you have. You have 100% transparent collateral. So every transaction that happens, as you saw on the last slide, you can see it. You can see how the monetary system is moving and changing and evolving. And you could continuously monitor this. You could look at the NAV coverage, right? I think Strategy's they've got a website that's updated every 10 seconds or 15 seconds where you can see the capital on the balance sheet, how much leverage on the balance sheet, what's the relative risk profile, how do the instruments fit next to each other, and all this stuff can be calculated 24/7, 365. You could wake up at 3 o'clock in the morning on Sunday and calculate the risk of the instrument that you hold and make a decision based on that information when the markets are open. And that's that's never existed in the history of capital markets before. And that is an interesting component of these instruments and will result in increased liquidity in these things because the risk profile is fully observable 24/7, 365. So how do we start to think about the risk profile of these things? And I've got an insurance background. I talk about insurance all the time. I'm a total risk nerd. And I see this in a couple different ways. So you can look at a backward-looking view, an experience rating, and then you could look at an exposure view looking at a forward rating. So how do we start to wrap our heads around this? And what's the frontier? What's the tip of the spear in the risk world? So let's think about experience rating. I've got some cool, sparkly, colorful graphs here. And on the left-hand side, this is looking at a digital credit balance sheet as if it were to start every single month. So what would that balance sheet look like over time in past history if it were to start on a different month every month going back for the last 10 years? And you could go see the performance of that balance sheet. Like how would the collateral in that balance sheet perform over time? And you can start to analyze that data and information, right? This is a very observable asset where you can create entire profiles of data and information that can be analyzed. And over on the right-hand side, this is taking a balance sheet at a point in time, amplified Bitcoin model, and applying it over history and comparing it to what if I only had a spot model? What if I had an amplified Bitcoin model and I've got a spot Bitcoin model, and what's the discrepancies between the two? And based on past cycles, past bear market cycles, different points in time, how would the balance sheet have performed? Would there be a point in time where there was not enough capital on the balance sheet to pay out the dividends into the future? Would there be a point in time where I would be concerned about the credit quality of the instrument that I hold? And that's interesting. You can do this analysis. You can run this data and information. And I mean, based on the keynote this morning, apparently agents can start to pull together the visuals and make decisions on this information. But this is just one view, right? I'm sure many people in the audience can start to think of different ways to backtest this information and create different risk curves and identify different probabilities of loss at different points along the risk curve. So that brings us to the forward-looking view, an exposure analysis. So how do we price risk forward, right? Like we can look backwards. Now let's think about this into the future. So into the future, what you see on the screen here, this is a occurrence exceedance probability curve. And there's 4 different probabilistic models on the screen right now. And these 4 different probabilistic models have different assumptions that go into them. So they take all of the data from past Bitcoin cycles and Bitcoin history, different volatilities, different jump diffusions, so like different regimes, when there's bear market regimes and bull market regimes, and you could take that information and extrapolate it into different probabilistic simulations, and you can run 10,000 simulations, 20,000 simulations, 100,000 simulations to get an occurrence exceedance probability to understand the probabilistic downside over a period of time. I think this is incredibly interesting. You can calculate what the probability of loss, or the probability that at the end of a certain period of time, how much capital is on the balance sheet with X% probability. So what's the 1% downside? What's the 0.5% downside? What's the 1 in a 100-year loss that I could have? You cannot do this with traditional credit. This is very difficult to do with traditional credit because it's not observable. You don't have an understanding of the future of the business. So this is just a numerical view of this. So this is what an occurrence exceedance probability table looks like. I used to deal with these all the time in my reinsurance life. But so you could see it at a 1% downside. You could look at the probability of collateral coverage at the 1% downside. But you can also look at the upside of the curve. What does my balance sheet look like on the upside? What does it look like at the mean? What is the variance in that model? What is the standard deviation in that model? You can compare all the different probabilistic models next to each other. You can start to take conservative views of risk. Maybe I need to leverage up my balance sheet higher because I have very low probability of risk. Maybe this helps me frame and conceptualize the risk profile of my entire balance sheet and help inform decision making. So I think this is really the frontier of where the risk analysis of this industry goes. And again, this is just one example of an ex-reinsurance broker that used to work with actuaries all the time trying to rebuild a risk model in the new frontier of digital credit. So what's the takeaway, right? The takeaway is that the tools exist, the data exists, we need to build the framework. And I encourage everybody to think about how can we start to think about the risk profile of these things and communicating them. Because one of the biggest takeaways I get from most people is like, how risky are these things? Do I want to hold them? How does it make my portfolio better? And being able to communicate that on an institutional level, wearing a suit, walking in the door, talking about occurrence exceedance probabilities, probabilistic models, speaking their language, I think that goes a long way. So we can observe all this information 24/7, 365. There's historical risk tools built in the insurance industry and the traditional credit industry. We can use those and apply them in a new way with a completely transparent balance sheet. And ultimately, that should lead to regulatory evolution. These things are incredibly transparent, and you can calculate the risk 24/7, 365. So we have better visibility into Bitcoin-backed preferreds than anything in the traditional market. And if the US wants to be a leader in Bitcoin, there needs to be some reform at the regulatory level, allowing Bitcoin to be treated as an asset with less risk than it's currently being treated at. So that's all I've got. Thank you very much. Appreciate it.
Hello, everyone. My name is Ben Honeywell. I'm one of the co-founders and currently the CFO of Prevalon Energy. I was orange-pilled in 2020, graduated to a Bitcoin maxi, and I'm excited to be here today to share my experience with you, to share with you how my personal journey has finally merged with my professional journey. Now, a disclaimer to start with, amongst the guys in the office, we all have defined roles. And there's a running joke that says, if I'm ever on stage or on YouTube, mistakes are being made. The reason they say that is because I'm only passionately talking about Bitcoin or strategy or treasury. So Manesh, Alejandro. So who are we? Prevalon Energy, we are an infrastructure builder. Our products support the health and stability of the power grid. you're familiar with Bitcoin mining and how it's a demand-side support function, whereas whenever the grid is strained, you can have the Bitcoin miner shut off and reduce the load. Well, our product, the Battery Energy Storage System, or BESS, is a supply-side support. We don't generate electricity, but we do store it so that in the event that the grid is strained, we can actually inject energy onto the grid. We're also in the forefront of the off-grid AI data center build-out. Our HPS product is somewhat like a multi-gigawatt shock absorber, if you will, that protects the generation assets and the compute assets of a data center. So our projects on both the utility side and the AI data center side are hundreds of millions of dollars each. So our treasury activities are definitely material. Which brings me to the treasurer's dilemma. So our treasury mandate is preservation of capital first. Yield is secondary. We're a young company and growing quickly. So our profits and cash have to stay in the business. As we make those profits, we roll those forward. And we need a place to store them until we have the opportunity to deploy them. And our time horizon for our treasury investments are tiered, but usually no longer than 12 months. And I think you already know that to be a Bitcoin investor, you need a longer time horizon, 4 years or greater. So in its native form, Bitcoin simply does not fit our treasury needs. Now, I say that with a bit of consternation because I am a big Bitcoin fan and I have been looking for a long time how Bitcoin fits into our business. But native Bitcoin just doesn't work in its unrefined state. But that takes me to our next slide here. Looks to be stuck here. There we go. So in 2025, Strategy began refining digital capital into digital credit. First it was Strike, then Strife, then Stride, all interesting products that I was very intrigued with personally. But then Stretch rolled out, or STRC rolled out in July of 2025, and that was an absolute game changer. Stretch was designed for capital preservation and with a yield to boot, and what a yield it does have. At 11.25% annual yield on par, it creates a self-healing floor on the price. That, coupled with the ATM issuance above $100 a share, which puts a ceiling on price, this locks STRC into a very narrow trading band. STRC's position in the capital stack, along with the cumulative dividends that are payable in cash only, it provides ample investor protections. So that has made Stretch a very attractive treasury asset indeed. The elevated cash income and dramatically reduced downside makes Stretch a defensive BTC exposure. It does have temporary drops of 5 to 10% that we've seen in the last 6 months since its launch, but it recovers quickly. And if you observe, you'll see that the drops are more shallow and the recovery is much quicker. If your time horizon is greater than a month and you are looking for treasury assets that do have a greater than money market type yield, then Stretch will work for you. The cash reserve that Strategy has put in place more than adequately demonstrates solid coverage. $2.25 billion and a massive Bitcoin reserve behind that means the dividends will be paid. I speculate that the cash reserve that got so much gruff in the media when it did come out also checks a box with the rating agencies. As we know, Strategy did recently get a rating of a B-. So as that improves in the coming year or two, then Stretch will be a beneficiary of that. Well, convincing my partners to buy Bitcoin was like convincing my friends and family to buy Bitcoin. It took years and years, and most of them just simply didn't do it. When I was talking about MSTR and the common stock, that normally took months of discussion, but most of them still don't own it. Explaining STRC takes a few minutes, and almost everyone that I've explained it to has picked it up. What's nice about Stretch is the rails are already in place in TradFi. The execution is not difficult. So we presently have an 8-figure position in STRC on our balance sheet as a treasury asset. It is not a buy and hold position. We are in and out, and we store our capital in Stretch until time for deployment. Our STRC investments are facilitated by PNC Bank via self-directed trades. Now, TD Bank offers block trades for any size purchase. I can't say that from experience because we did ours separately with the self-directed trades, but you have the ability to make much larger trades if you're looking for 20 million, 100 million, or $1 billion. As our business continues to grow, we see the Stretch allocation remaining constant in our treasury. So as our reserves grow, so will our position in STRC. I see a 9-figure position for Stretch in our future. So what kind of strategy or Bitcoin get-together would it be without a price prediction? So in 2017, I met the CEO of the Federal Reserve branch of Atlanta. Once I got over the fact that that branch is not located in Georgia, I was able to get to meet Mr. Raphael and discover that he has a very warm and welcoming personality. He's Harvard educated with majors in econ and psych, and his PhD in economics is from Stanford. Pretty safe to say he knows more about economics than I ever will. As an icebreaker, I asked him, what do you call an economist with a prediction? Wrong. I've updated that joke after last year's experience in 2025. And that is, what do you call a Bitcoin maxi with a Bitcoin price prediction? Exactly. So I'm going to go out on a limb, though, and I will give a price prediction or a price estimate today. $100. STRC will be $100 next week. Next month, STRC will be $100. And next quarter, and next year. So we were given a wonderful gift here recently that was not even in the original design philosophy of strategy in the form of the tax treatment, return of capital. I spent probably the last half of last year wondering whether it would be qualified dividend income, non-qualified, would it be regular income? Who knew? I would have never guessed ROC, or return of capital. But the dividends being treated as tax-deferred capital gains is a wonderful flexibility to have. And the timing that you hold the underlying shares dictates if it's either a long or short-term capital gain. That provides new flexibility in the Treasury that is an added benefit. But more importantly, it actually incentivizes investors to hold Stretch more than a year. When Stretch first came out, I was wondering, would we see people trying to maneuver back and forth between it and some of the other investments around the ex-dividend date? And I think you do see a little bit of that. But if you have any material amounts of money, then you're heavily incentivized to hold it for the long term. So the smaller investors moving in and out don't necessarily damage STRC. So I believe the ROC structure actually reinforces the stability. Thank you, U.S. government. And also, what kind of strategy or Bitcoin get-together would it be without talking about FUD? You know, fear, uncertainty, and doubt. In the bull market, we're genius visionaries, or what they call him, the Bitcoin alchemist. I love that one. But in the bear market, we're the ones that bet on the wrong horse. We're the ones who lost it all, sometimes from the same outlets. I'm not going to mention the Wall Street Journal at all. But I remind myself that we must engage the FUD. We need to talk to the people that are having these concerns. I would say with the exception of the AI-generated FUD. But we're not correct all the time. We should always be looking for holes in our thesis and situations that does require our attention. So to get outside of my sphere of influence, I engage the public via online forums such as Crypto Enjoyers. They have a YouTube channel also that pops up every week, and I can admit that I'm not one of the favorite 10 people on that forum. However, in that forum, I get to meet all levels of understanding. So from all over the United States, all over the world, there are people in that forum that have vastly different understanding of Bitcoin, finance, strategy, and the markets. And recently our discussions turned to STRC, and that has been some of the simplest FUD to disperse and address that I've ever come across. What I normally see is the most usual response is, I just can't do it because it just can't be that good. Hard to really argue with that, to each his own. But if you can comprehend, and I do mean comprehend and not believe, that Bitcoin will appreciate more than a few hundred basis points annually, then you can also comprehend that MSTR and STRC ATM issuance can continue in perpetuity. So in conclusion, we know Bitcoin is pristine digital capital. The strategy refinery is converting digital capital into digital credit, each with its own purpose. STRF for income investors, STRD for yield hunters, STRK for those MSTR investors seeking a softer ride and can't manage to stay welded into your seat on the roller coaster of price that accompanies the common stock. But STRC will be the premier investment for the modern treasury. STRC will change the world. Thank you.
Two more exciting sessions coming up. The first is going to be new market structures using STRC and Bitcoin linked products, featuring Henry Bombi of Hope and James Priday, the CEO of P1 Investment Services Limited. After that, we are going to be hearing from Dan Hillary, the head of treasury at Buck, about new market structures using STRC and Bitcoin-linked products. But first up, please welcome Henry and James.
Hi, everybody. Thank you very much for being here, and thank you to Strategy for inviting us to give us the opportunity to talk about our core mission at Hope, which is to make money valuable again. So, as many of you know, that a Bitcoin isn't here. Money doesn't hold its value very well. It's no longer a store of value. It no longer holds its purchasing power. If you hold $100 for a year, for 5 years, for 10 years, you can't buy the same things that you could in that period. And so what we're trying to do is address this problem. It's a promise that Bitcoin that gave me when I first became a Bitcoiner. And when the Stretch product was announced, I first realized actually now we have the means and the technology and the financial engineering that's going to enable us to do just that. And that journey led me to an introduction with James, who together we have built a product within money market funds. James.
Perfect. So just to let you know a little bit about P1, obviously Henry brought this idea to us and we worked with him on the creation of this product. So P1, so we operate an investment management business in the UK, and we also operate an investment platform. So we have both the ability to manage money for retail clients working with financial advisors and to provide a vehicle for other investment managers to run money on our investment platform. We did launch a digital asset portfolio in 2022, which is still going now. We've always tried to bring Bitcoin to traditional finance in the UK, so we've tried to support the Bitcoin ecosystem for quite a while. So we supported the first Bitcoin conference in the UK, which is based in Edinburgh in 2022, I think it was. So we've always been looking at angles about how we can take Bitcoin to traditional finance. So effectively take it to where people already are, rather than try to bring them too far into this new world of Bitcoin. And Hope and this new product that's being launched is one of the ways we're looking to do that.
So what have we built and what are we looking to go for in the future? So the simplest way to describe it is a money market plus fund. Effectively what we do across multiple currencies, starting with the pound, the US dollar, and the euro, is we take a typical money market fund, 90% money market fund, and we add a 10% stretch uplift to that. And that gives us the ability for not very much volatility increase a significant yield. As Michael mentioned in the keynote earlier, in a euro product, you can get up to kind of a 50% yield increase with not much increase in volatility. And so what we do then is we're going to package that up into an ETF. We can list that on multiple stock markets around the world, and we're referring to them as currency stocks. So as James mentioned, we're meeting people where they are today. People buy stocks, especially in the UK. It's a very low risk profile that people take. They typically use their savings accounts for their money, whereas what we're looking to do is be that bridge for people that want to take a tiny bit more risk but have a yield that delivers much more than a bank account. So we obviously are a mass market product. We need to go and explain this to people what Stretch is, but typically people don't understand all that well what Bitcoin is. They certainly, probably in the UK, have not heard of strategy, and they definitely do not understand pref shares to the level of Stretch. And so we need to break this down into something that's really simple for people to understand. On our website to do that, our first step is we built this calculator which effectively shows the cash coverage, and you can play with the Bitcoin price, the CAGR of Bitcoin, and the Stretch dividend to understand how that dynamic works. The other thing that we need to do when we're explaining to a mass market is simplify the problem of money, that it's no longer a store of value. And so how we describe it is just like your phone. All day it's losing power, your money is just the same. And so what do you do when your phone runs out of power? You put it on charge when you're no longer using it. We believe that our Hope product will be a currency stock that people can use to do the exact same thing. So as settlement periods come down from 2 days to 1 day to instantaneous through technology over time, we believe that more people will be able to spend time in yielding products like ours. So we're building where money waits. There's obviously a significant amount of money, 7.9 trillion, close to 8 trillion in money market funds, 8.5 trillion in corporates around the world. And this is the kind of market landscape that we have in the UK that we're up against. So significantly better yield for currently 1.8% annualized volatility. And that's including the last 5 months since launch, where there's obviously been significant volatility in Stretch, starting at $90 and revisiting it 3 or 4 times in that period. So we expect our annualized volatility to go down. We believe the next evolution of money isn't replacing fiat, but upgrading what sits behind it. And so in terms of what a Bitcoin-backed money would look like, in our eyes, we've got obviously Bitcoin as a value backstop. Stretch is a volatility dampener that unlocks the ability to then build on top of that, strip away that final 5%. As we all know, Bitcoin is too volatile to use as short-term money, but this green line here is interesting. It's a linear regression fit. And Stretch, in our eyes, is that green line. It's stable and offers the ability for people like us to build fantastic financial products that will hopefully change people's lives. James, you want to talk a bit about this slide?
Yeah, absolutely. So I think this is a really important thing to understand. If you can strip 95% of Bitcoin volatility away and you can still get a third of the potential upside, that is a significant risk-reward profile that fits into a lot of even more cautious investors' risk profiles. So it means that the potential distribution, the potential asset flows could be significantly higher in traditional finance. So Stretch is bringing a lot to the potential flows of assets that go into Bitcoin or Bitcoin-related products.
Nice. I'm just going to fire through one thing here. So I don't think this is talked about enough in terms of one of the main value adds I think that Stretch has. So many assets, when you increase adoption, they actually become more volatile, but Stretch is almost the opposite. The more adoption, the more stable it becomes. More money into Bitcoin, you can get a blow off top. More money into Stretch, it actually becomes more stable. So you can put more and more money on top of Stretch. It's its most stable form. And so you could put $100 billion into Stretch over the next 10 years. All of that money flows into the Bitcoin ecosystem. And so what we're looking to do is to not move money that's already in the Bitcoin ecosystem around. We're looking to find new ways and new pipes and new funnels of money from existing cash balances and bring that into the Bitcoin ecosystem that otherwise wouldn't be there. So what does our product actually look like? What's in it? What's our first version? I'll let James talk a little bit about that.
Yeah, so we went about this and we effectively applied the the KISS principle, i.e. keep it simple, stupid. So we had an existing money market portfolio, so just a bit of diversification around holding some money markets that financial advisors in the UK can buy for their clients as a place either just to sit some cash for a while, or those very cautious investors to hold, say, pension money that they need to take an income from. So we took our existing money market portfolio, which has been running for, I think, about 4 or 5 years now, and we just looked to have a relatively small allocation to stretch and to see what that does. And that's where we came up with the P1 Hope Money Market Plus portfolio. So the whole thing about it is to try to get a yield premium without adding very much volatility at all. So on this graph here, it does look like the P1 Hope Money Market Plus has a lot more volatility, but of course, our core P1 money market portfolio that's been running for a long period of time has effectively zero, or near zero volatility. If we go on to the next slide, Henry. Obviously, we expect that actually stretch is going to become less volatile over time. So the green area there is what we expect stretch to more, our volatility to reduce over time with stretch adoption, which I think is really important because volatility reduction while also giving a yield premium is exactly what we're looking for.
Yeah, this section that's highlighted here is when, for the longest period, stretch traded at par. And so as that happens more, we expect that kind of period, and it will extend out into potentially something like this over a 3-year period.
Yeah, so this is just projecting out. So this is just zooming out to try to show you how actually, even with the volatility that stretch has experienced so far and the impact it's made on our portfolio, if you zoom out, you can actually see that the volatility isn't very much at all. And the yield premium you're getting for taking on that little bit of volatility is about 20-25% yield premium. So it's well worth it for that tiny bit of volatility you're taking. In terms of the UK market, investors are generally very cautious relative to the US market. So they generally are down the risk spectrum. So they're looking at more fixed income assets. They're looking at more money market funds and high yielding dividend paying stocks. This fits really well into what the average UK investor may be looking for. So we see this as something that could attract significant asset flows over time once people can understand the product.
All right, thank you very much.
Thanks.
Everyone, my name is Dan Hillary. Thanks for being here. This is awesome. I run the treasury at Buck, which is the world's first savings coin. We're really trying to bring savings technology to everyone in the world, really anyone with access to the internet. I'm also one of the founding members of True North, which is the first kind of investment grade podcast focused on MSTR, focused on Bitcoin, securitization, and digital credit. All right, so I'm going to go over what I believe to be the most important part of the entire capital markets, specifically the securitization of Bitcoin, focusing on the frontier, which I believe to be STRC, and kind of layer 4 securitization, which is Buck. So Bitcoin's being securitized pretty much 10 times faster than any commodity in history, right? With gold, we saw the GLD ETF launch in 2004, which brought custody to people who didn't want to physically hold gold and didn't want to settle in gold via futures contracts. We saw the same thing with oil futures. They brought kind of price exposure from localized markets in oil to a global market. We saw this with mortgage-backed securities as well. This market wasn't very liquid until the securitization of that market. We're seeing this with Bitcoin. So it started in 2009. Obviously, the Bitcoin Genesis block was mined. And for the next 8 years, you really couldn't get price exposure to Bitcoin unless you were directly holding the asset, right? This is raw digital exposure. Or you had a custodian or a trusted third party who held the asset. But you couldn't get kind of cash secured price exposure. It was in 2017 that the CBOE and CME Bitcoin futures launched. This was a massive game changer for institutions and just private investors, right? You could now get price exposure to Bitcoin, long, short, hedged, leverage, just directly with your prime broker, the same way you trade a SPY futures or a Treasuries futures contract. Then in 2020, for the first time, MSTR announced their first purchase 21,454 Bitcoin. And this was a big, big shift in kind of NASDAQ-listed Bitcoin exposure. Prior, there was some forms of operational exposure, so you could buy a couple publicly traded miners, but this was the first time we saw NASDAQ pure, sort of unchanged Bitcoin exposure. Then in 2024, this rounded out the layer 2 securitization. I'll talk about this later, kind of the layers of capital that have been built underneath STRC, but it was the spot Bitcoin ETFs that initially were cash creates and redeems, that then in July of 25 switched to in-kind creates and redeems. And this rounded out the NASDAQ-listed public markets exposure to Bitcoin without physical delivery or custody. And then this is the kind of the tipping point. So I think STRC is the single most important security in all of the Bitcoin market, and I'll explain why in a second. And it was STRC that allowed us to launch Buck, which is a savings coin backed specifically by STRC, bringing STRC exposure to the world. So just to recap, obviously layer 1 securitization is the raw capital, that's the Bitcoin. That market is mature. Layer 2 is any sort of price exposure with an in-kind create and redeem. It's kind of direct price exposure with a pseudo claim on the underlying asset. That market's completely mature with the spot Bitcoin ETFs. Now I think all the opportunity here for builders lies in layer 3 and layer 4. So layer 3 is any form of derivative price exposure. So you don't have a direct claim on the underlying. Think MSTR, STRC, and even the most recent structured notes offered by Morgan Stanley and JP Morgan, which give kind of structured exposure to funds which have a mandate. These raised $700 million in the past 3 months. Then layer 4. So this, I think, is the frontier. This market's still nascent, and it's being built out in real time. And I believe at Buck, this is exactly what we're doing. We're taking it to people around the world. This was a quote by Hal Finney on a Bitcoin talk forum in 2010. And he wrote, "I believe this will be the ultimate fate of Bitcoin, to be high-powered money that serves as a reserve currency for banks that issue their own digital cash. Most Bitcoin transactions will occur between banks to settle net transfers." Mind you, this was 2010. And just last year in 2025, Michael Saylor wrote, or he said on a podcast, he said, "The idea of digital money is 8 or 7% with zero volatility. In the English language, there's a word for what everybody in the world wants for universal utility. That word is money." And this quote was the direct inspiration for Buck. So Buck is the world's first savings coin. We call it a savings coin because you can think of stable coins as your checking account and Buck, the savings coin, as your savings account. We're bringing high yield savings to everyone in the world. A lot of people in this room may not be familiar with the stablecoin market, but it's absolutely massive. It's a $300 billion market growing at 40% year over year. 80% of the market is made up of USDT and USDC, and these are stablecoins backed by US Treasuries, and they don't pay yield to holders, right? So although you have the stable backing of the US dollar, you're being debased in real time. Buck flips this on its head, right? We're backed by STRC and a small volatility buffer of USDC, which I'll get into in a little bit. We offer a 10% yield stream to holders, and our total market cap is $2 million. So there's quite a bit of a discrepancy and a massive total addressable market for something like Buck. So why Buck? I get a lot of questions like, is Buck different from STRC? And yes, they serve 2 completely different markets, right? We offer the 4 billion internet users that can't easily access a US brokerage account, high yield savings powered by Stretch. There's also a lot of decentralized finance protocols that benefit from a product backed by Stretch. So think Aave or Morpho. These are lending protocols where you can post Buck as collateral. You could leverage it a little bit and get a higher yield if you believe Stretch to be creditworthy. You can also segregate the yield on a platform like Pendle and go levered long the exposure or lock in a fixed rate, right? You're essentially creating a futures curve on a product backed by STRC. Then finally, Buck is instant and fractional. There's no market hours, no T+1 settlement. Anyone outside the US can just purchase it 24/7, 365, and send it anywhere in the world. Obviously, I believe this to be a massive opportunity for strategy and for Buck to start eating into the stablecoin market. So how do we do this? Our treasury is mainly STRC, and that pays an 11.25% return of capital dividend. We then over-collateralize our treasury holdings with 5% or more, right now it's about 40%, USDC. What this allows us to do is twofold. One, we can reduce the trailing volatility of STRC, which is like 5% right now, to close to zero, right? This is the digital money idea, the high-powered money idea that Saylor talked about in that quote. We also can provide the liquidity for mints, redemptions, forced liquidations at any time, 24/7, 365. We then pass through a 10% yield stream to holders. And there's obviously a discrepancy between the yield we receive on the back end and the 10% we pay out. We use that extra 125 bips spread to buffer the over-collateralization. Now, you may think, is this all tangential to the Bitcoin thesis, right? Like, does this help Bitcoin? And I'd argue yes. It's very, very in line with a Bitcoin ethos. That's because when people buy Buck, every dollar that goes into Buck, we use to buy STRC. When we buy STRC, strategy goes out and they buy Bitcoin. So ultimately, $1 of Buck purchased is $1 of Bitcoin purchased. And this is what I believe to be the gateway between kind of the low volatility needs of general people in the world and the high-powered digital capital, the real settlement layer between institutions that Bitcoin ultimately will become. Thanks for listening.
Ready for this closing session? We're going head to head with the State of the Union. This is the state of Bitcoin. I'm excited to announce a fireside chat hosted by Strategy CEO Phong Le in conversation with Jeffrey Solomon, Special Advisor and Vice Chair of TD Bank. They'll be speaking about digital assets at TD. Welcome, Phong and Jeffrey.
All right, we're gonna bring this bad boy home today.
Let's go.
We started at 9, it's 5:30. We're competing with the State of the Union, whatever dinner you're planning on going to.
It's gonna be a big league
strategy party. So you're like, who's this guy, Jeffrey Solomon? We'll get into that in a minute. He's a legend, by the way, and you'll start to understand why, which is why I decided to bring him up. But part of what I want to set some context is TD Cowen has been one of our biggest banking partners over the last 5 years of our journey. And when you think about part of what strategy has been doing, we're really at the intersection of DeFi and TradFi. And if it wasn't for Jeff and previously Cowen, we wouldn't be where we are today. You know, you saw Lance speak, excellent sell-side analyst who really understands Bitcoin. You heard Peter Haynes speak, who fully understands things that were new to us, index inclusion, MSCI, all these kinds of things. And maybe most importantly, TD's a party sponsor tonight, so the drinks are literally on Jeff.
I think we should just skip dinner and go to the party.
Yeah.
Go on.
So, thank you for the partnership. Last thing, when Saylor's hitting the ATM, these are the guys who are actually executing the ATM. And they've been a huge part of that too. So thank you for that. But so, Jeff, why don't you just start with, give us a little bit of background of Cowen and then TD and sort of how that came to be and what your role was at Cowen.
So first, before I get started on that, I should, just because this is a mutual admiration society, legend aside, what you all have done for us at Cowen and now at TD is opened up our minds to the world of possibilities at this intersection of DeFi and TradFi. And if, you know, when we started at Cowen, the Cowen was a challenger bank. You know, we're always looking for growth and we're looking for disruptors. That's kind of what we do. We know that disruptors inherently need to raise lots of money to disrupt the industries they want to disrupt.
and we're looking for partners that we can back who have a vision. And ultimately, at the end of the day, our job is to raise them the capital and to position their stocks in the hands of mostly institutional investors, which is where we live. But when I had my first conversation with Michael, and then we had the conversations with you about how we could actually transform an uninvestable asset for the most part, for most Americans. How do we transform an uninvestable asset and make it available to everybody? That is a fundamental change in the way people were thinking about that asset class. Bitcoin for sure, but then when you look at the growth of digital assets beyond that, if it hadn't been for that opportunity and your ability to open up that aperture, we might not be having this conversation. And I think it's forced a lot of other people, both in DeFi and TradFi, to stand up and take notice. And I think when we first started doing this at Cowen, it was a risk because it was unknown. There were some regulatory hurdles we had to cross. There's some things we had to do, but we were willing to roll up the sleeves on the strength of the partnership and your ability to deliver on what you exactly what you said you were going to do. And I just think that's a rare quality. And so I want to just start by expressing my gratitude, because what we've been able to do now that we're a part of TD is change the way we're thinking about traditional finance and the intersection of traditional finance and DeFi. And the strategies that we're pursuing and the education that's gone on, the cultural shift that we've been able to bring into this organization is in large part a derivative of the exercise that we did together and we continue to do together. And so just before we talk about anything else, I just want to express my gratitude to you and to Michael for giving us the opportunity. I like to say when it was a lot less obvious. And then for sticking with us as we had to educate a very large, globally systemic important bank on why what we were doing was just groundbreaking and compatible with our regulatory architecture. I can't stress that enough. Like what we've been able to do over the last 3 years together should show every financial institution the art of what is possible when you partner with people who disrupt industries. And there's more to come on that front, but I just think that, to me, you want to talk about legendary, that is legendary. And I just wanted to start by expressing my gratitude.
Thank you. I feel like we should hug it out, but we'll do that later.
Come to XS later on.
All right, so tell us the backstory, Cowen, and your role there, and a little bit for those who are not aware of Cowen and sort of how that came to be.
Yeah, so Cowen was a 100-year-old investment bank that I like to say Cowen was resilient, right? It was started in the middle of the First World War. It survived a global pandemic the first time, a Great Depression, a Second World War, and countless other things that happened, including the last global pandemic. And what we did effectively at Cowen, I started in the business as a hedge fund manager. It's so funny hearing everybody talk about all the quantitative analytics and volatility and stuff like this is stuff I was doing in my hedge fund in the 1990s. I started as a hedge fund manager. We bought control of Cowen and did a reverse merger and merged our firm in to Cowen in 2009 after the global financial crisis. On the theory, get this one, that they were going to break up the big banks. Remember that? And that we wanted a seat at the table as everybody was going to be leaving all the big banks. We wanted to have a place where we could attract talent. We were wrong about that. About the breaking up of the big banks. And there's a lot of instructive stuff in here as it relates to the disruption that's going to occur that we can talk about. But what we ultimately ended up doing was finding a lane, and that lane was around disruption. So the one thing we would say is we were really good at raising money and really good at research at Cowen and equity distribution. So the things that we've put in place with, for you and for the investors in strategy, that's what we're really good at. That's what we were really good at 15 years ago. And we chose industries that were disrupting, things like fintech and biotech and a bunch of other technology industries where there was a need for new capital so we could raise money and generate fees, investment banking fees, but also do it for companies that would add alpha to people's portfolios. And this was our big idea. You ready for this? We knew that in people's equity portfolios, that over 50% of the money that was coming into the equity market was coming into indexes. And what we said was, never been in a meeting one time with a management team or an investor where anybody has ever said the following: I'm okay being average. Like, nobody says that. Because at the end of the day, our human nature is that we want to win, we want to outperform, we want to generate alpha. And so our view was, even though most people are going to plow money into these passive indices and ride the wave of whether the index was going to be doing, which you saw from Peter, how important that is, we didn't think that was going away. We just thought that the portion of their portfolios that would be actively managed was going to be smaller, and that the number of people that were going to be servicing that community was going to be smaller, and they had to be excellent or they were going to get eliminated. And so we went right to the, how do we add alpha to people's portfolios? How do we help companies outperform? How do we help investors outperform? We want to be the source of alpha. So for a long time, our moniker was, let us help you outperform. And I was stunned when we looked at no other bank on Wall Street ever had the audacity to say, we will help you outperform. None. And so we decided that that's what we wanted to do. And in doing so, this is what I always wanted in my portfolio as a customer. We transformed Cowen into a place where companies and investors could come if their sole purpose was to add alpha to people's active portfolios. That's what we did. And lo and behold, in 2022, TD showed up in my office. Two senior people at TD, who I've become very friendly with, showed up in my office. I really thought they were going to be asking me, like, for our transaction banking business. We were about a $600 or $700 million company at the time, $800 million somewhere in that market cap. When we did the merger with Cowen, Cowen was 80 million, just to put it in perspective. And about 5 minutes into the conversation, they were asking me a lot of questions about culture and a lot of questions about our strategy that they seemed to know an awful lot about. And I'm like, whoa, why are you here? And they're like, well, have you ever thought about doing something strategic? I'm like, well, I think about that every day. And they're like, with us. I'm like, with you? Like, with you, TD? Like, no, I never thought about that. And so they proceeded to show me what our future was going to be. And literally 15 minutes into that presentation, I'm like, oh my God, I'm going to be working at a really big Canadian bank. Because that is how much... That is exactly how much, like, sense. So how the industrial logic was so great of putting these two organizations together. I'm like, I got to figure out how to do that. And it's turned out to be fantastic. Like the combination of Cowen and TD, our businesses did not overlap. They complement each other. You can see people like Peter, who's a legacy TDer, right? And you know Davies Beller, right, who is a legacy Cowen person, right? First of all, we don't even talk about that anymore in the organization, but you see how that combination of talented professionals get together, and when they start to feed off of each other, what can happen. And that is essentially what we do. Last thing I'll say is 1 + 1 always equals 3 if you do it right. And what we've been able to do in convertibles, Cowen did not have a convertibles business. TD did not have a convertibles business, but together, TD and Cowen do have a really successful convertibles business. And you helped to put that on the map. We lined up for you with a team that we were able to attract because the combination of TD and Cowen is a compelling career opportunity, and it speaks to an unmet need. And because of you, we've been able to move our way into the top of the league tables so that we're now able to demonstrate our prowess beyond just what we do for strategy. And that is exactly the industrial logic at work at TD. And I just couldn't be more proud of everybody at TD and everybody at Cowen who helped to make that happen. It's really been, that's sort of our history in 5 minutes or less.
It's such a good Bitcoin story, which is strategy, especially during 2022, had challenges finding banks who were willing to do some of the innovative things that we wanted to, like an ATM as an example. And so we found this alpha-seeking challenger bank with awesome CEO who's willing to fight the good fight in Cowen. And then I remember you called us up one day and you said, hey, there's this thing happening and TD is going to buy us. We're going to merge. And our view was, this is great. It was a sort of a Trojan horse move to get a large bank, a too big to fail bank, to adopt digital assets. And you actually were quite successful in doing that. So let's talk, we'll get back a little bit into where TD goes to digital assets in a minute. I'm sure a lot of folks want to understand, so $34 billion of equity was issued by Strategy using the ATM over the last 2 years, 2024, 2025. We were, in both years, the largest issuer of equity in the capital markets in the US, by far. And that includes IPOs, and that includes ATMs, that includes prefers, et cetera, et cetera. Tell us, from your perspective, there's somebody buying that equity, right? And they know it's going into Bitcoin. And how does that look from your perspective when you see that amount of capital going into a company like Strategy to buy Bitcoin? Give us some perspective on that.
So let's just talk about the history of ATMs for 2 seconds. Yeah. So when I was first doing these things called equity lines, they were called equity lines. Remember those in like the late 90s? Like people thought it was kind of like a little bit like DeFi. Honestly, there was like, ooh, all that stuff over there. And, is there a regulation? And I remember going to the, how are they doing this? And it was a very sort of niche-y financial innovation. And I remember going to the SEC in the early 2000s to say, you guys actually need to update your continuous offering rules. Like there is a rule here, but no one really knows how to use it, and you need to give guidance on this. And once you give guidance on this, it will open up issuers will be able to use this continuous offering process. But you need to clarify the rules. And we actually gave advice to the Division of Corporation Finance in order to get that done. We knew that there were industries, even when I was in the hedge fund space, I was already financing companies that were growth and disruptors in the 90s and 2000s in parts of our portfolio. We knew that there were companies that were disrupting industries. I focused on biotech. I focused on early stage technology and disruptive technology. They all needed capital. But the public offering process, the organized public offering process, as we heard from the IPO discussion earlier today from BitGo, it's a little bit clunky, right? And it takes a lot of time. And once you're public and your story is well known and it's published, like you don't need to necessarily go through that. You can if you want. It's just there are other ways to access capital. And the ATM enables you to actually access capital in places where the liquidity might be coming from people who are individual investors versus an organized offering that by definition almost always goes to institutional investors. This is what's so interesting about what's happening with you at Strategy and what's happening in the industry. We've talked about this a lot, right? Most of the financial innovation that's occurred has occurred from what we call the center, where the dealers and the banks innovate, and then there's all these capital rules, which we saw earlier, right, that force us to have to push the dealer, like the inventory, to the periphery. And you've seen that with the proliferation of, like, there used to be big dealer desks in equities, and then mutual funds and hedge funds and a bunch of other people. We see it in private credit, right? Banks used to be the center of private credit. Now there's all these private credit funds at the periphery. That's been the nature of how things have gone from the center to the periphery. But here in DeFi land, it's going the other direction, right? The people who own Bitcoin first are individuals. The revolution is happening at the periphery, and it's moving its way inward. And so what the ATM allows people who understand what's happening versus institutions that may not understand what's happening. The ATM allows you to access the people who actually understand what's happening and want to own the credit, because we can have a conduit through which we can offer shares to them directly without actually having to market to them in an organized offering where they would otherwise be excluded. This is a really important point. A lot of you are focused on DeFi because it's democratizing. And it is. But there are mechanisms through which, in a regulated environment, you can get access to individuals in a very democratic way. a lot of the buyers of strategy probably have Robinhood accounts, and they're engaged in these alternative trading venues, dark pools or whatever you want to call them, or they're on the exchange, right? And we are selling them stock through the at-the-market offering. I don't know who they are, but if they're interested in bidding for that stock and you're the seller of that stock, it's just as if somebody else were the seller of that stock, and they may not know. But here's what you did that's different than many other ATM issuers. You actually tell people what you're doing. The requirement under the ATM rules is that you only have to publish once a quarter. How much did you raise in the ATM? But strategy, you have said, no. We're just going to tell you exactly how much we're buying because we want you to know that information. And that's available to you. That's optional, right? That is you taking transparency and disclosure because in your culture, right, to a different level. So I actually think the ATM, I mean, there's a lot of different companies that use them, a lot of folks in biotech and real estate, anybody who's capital intensive that wants to offer their shares on a continuous basis. There's a big business that we have there. But you've actually taken it to a different level, and it's part of your ethos, which is to give individual investors a different way to access what you do through that mechanism. And that's why I think the marriage of the ATM product, we saw that early on. We were a leader in ATMs, and we're able to highlight to you why doing it together, we could take it to a completely different level, and we have.
Awesome. Thank you. You know, your title is special advisor, which I think doesn't exactly explain what you're doing now at TD. I'll paraphrase it. You basically are coming up with TD's digital/crypto strategy. You own it. Give us some perspective. You've been in the financial services industry for 40 years. I mean, you went from being CEO of Cowen to leading the digital asset strategy for a much larger organization. Why'd you take the role? Why are you passionate about digital assets in traditional finance?
So I'll give you, like, it's a personal journey, right? Like, I knew I wasn't going to be CEO anymore. And I'm not going to lie to you, like, it's fun to be the CEO most days.
It's fun.
It is, right? Like I say, I still have my CEO magic wand. I keep it in my closet. Every now and then I go and touch it. It doesn't light up. That sucks.
Can I borrow it?
It sucks. When you have one. You just need to use it more often. But you know, listen, the opportunity set for us at TD was immense. And so my job over the first 2 years after the merger, and we're about to celebrate our third anniversary, which is third anniversary of the closing of the merger, which is March 1st. And so for my first 2 years, I was heads down, laser focused on making sure the integration worked. You know, people said to me, oh, you made a great sale. And I'm like, my job is to make it a great buy. And it has been. So about a year or so ago, you know, I was winding down my integration work, and I'm like, you know, full disclosure, my contract said that March 1st of 2026, I'm free to go. And, you know, I was okay with that. Like, I feel like everybody's winning, and I'm not in the way of that. And I feel like I helped it, and so I'm good. But towards the middle of the year last year, they're like, actually, we'd like you to help us think about this thing after the Genius Act. Because Cowen Legacy was the only firm on the street to trade spot crypto institutionally in 2020. That is a crazy idea, right? People traded derivatives, and you know, you could go to Goldman Sachs and they would trade options or over the swaps and stuff like that, but nobody traded spot for institutions. We did. And so we understood, like, what is the mechanism for this? How would it work? I honestly think at Cowen Digital, we had ring-fenced it as part of the merger, and if it hadn't been for FTX, I think we would have been, I know a lot of people say the same thing about this. So in our case, we had convinced the bank to sandbox this thing. Let's go to the Fed and let's go to the OCC, let them see what it looks like to have like an institutional trading arm, and let's not be scared, right? Once FTX happened, I mean, there was no way to have it. So we dismantled all that. But the knowledge and the people in the organization that still understood it. So what did we do? We took a look at, in the Genius Act, where is it that we can play? And this is, I think, a lot of banks are doing the same thing. So if you take anything away from this, like the banks aren't going away. And actually the banks, I think, are going to be really happy to be players in this space. And I know there's a lot of like discussion around whether or not in a regulated environment, who's going to be allowed in and who's not going to be allowed. I'm not here to pass judgment. I'm just telling you, banks, I thought they were going to be dismantled after the global financial crisis, and they got stronger. Like, every bank is going to figure this out that matters. And so they're all going to be collaborators and cooperators and competitors for everything that's happening in this space. It's just a matter of time. And so what are we thinking about? We understand fundamentally that in 1994, like Bill Gates famously said, banking is important, banks are not. That was 1994. So anybody who knows that recognizes that we're like the honeypot of middlemen. Like, there's an entire ecosystem in Silicon Valley that wakes up every day that tries to disrupt middlemen. And we've seen it happen in every other industry. It's just, you know what Silicon Valley doesn't really like that much? Regulation. So they've stayed away from highly regulated areas because there's been other places where they can disrupt without having to deal with the morass of 10 regulators in the US. That's what we do really well. We navigate that because we have to. And so where is this happen? Where is this convergence happening? Now that we know that our core function of take a deposit, make a loan is disruptible, right? Well, then what are we doing to try to get in the middle of that? Because the future of banking is probably not taking zero interest demand deposit accounts and making loans. It's going to be in the movement of money. It's going to be in fees and advisory services. And it's going to be in consultative relationships. And banks are already set up to do that, right? We compete head to head with the do-it-yourselfers because there's a certain percentage of the population that wants to talk to a financial advisor. So E-Trade doesn't disrupt traditional finance. It's just another venue for people. Robinhood doesn't disrupt it. Those people who make all that money on Robinhood wake up one day, they're like, ooh, I really need to speak to a financial advisor. Hello, we're over here, right? It's collaboration and cooperation. And so we're going to figure out at TD and at every other major financial institution how we're going to play in this ecosystem. I would argue that it's mostly going to start with products we understand really well, payments, deposits. Right now, most financial institutions still can't trade crypto, by the way. In Canada, fun fact, until November 1st, well, actually we were anticipating this, on November 4th, we were only going to be allowed to have 1% of our net capital in anything that was digital asset related. That meant that if we were making a margin loan secured by a digital assets treasury company like Strategy, that would count against that bucket. At TD, that number, ready for it? We have about $100 billion of tier one capital. So we could put $1 billion in digital assets. And we went to the Canadian regulator and said that makes us non-competitive. And they're like, ooh, how's 5% sound? And that's where we are in Canada, 5%. That's going to change. It's just a matter of time. If you think that traditional finance players are slow, the regulators are even slower. But they've been given marching orders by the legislators and the same in Canada and MiCA, right? And the message has been delivered. Crypto and DeFi and digital assets have gone from do not touch to you must touch. You don't have a choice. Because actually, regulators will regulate, and they want to see what's going on in there. And we're being told, figure it out so we can see it. So this is not like the big bad banks conspiring to keep people out. No. We're being told that we have to open up our architecture to embrace this so that the regulators can see everything they want to see. And what are they doing? This is why CBDCs don't really work. CBDCs don't really work. Central bank digital currencies don't really work because the central banks would rather outsource AML and KYC to us. Like, why would they want to build an architecture in which all the nefarious activities happen directly with the central bank when they have an apparatus where we make sure that the bad people don't get in? And so they're like, oh, okay, well, why don't you guys set that up? And then we could just look at it. And so what are we doing? We're focusing on stable coins. We're focusing on tokenized deposits. We're focusing on how we can do innovations around Bitcoin because it's widely distributed. We want to be able to sell products based on Bitcoin. All of that stuff we're teeing ourselves up to be able to do. And the regulators are like, figure it out. And so that is the stark change from 12 months ago to today. We're being told you don't have a choice. And that's what we're doing. And that's what we're doing at TD. We're figuring it out. We're crawling, walking, soon to be running as we figure out, how we're going to play in this world.
Well, look, I think it's awesome that TD acquired Cowen, and I think it's doubly awesome that they put you in a role to set the digital asset strategy for the next foreseeable future at the organization. The partnership, as I mentioned at the beginning, has been amazing, and as people start to work in the traditional finance world with digital assets, it's very easy for me to say that we often recommend you as a partner to them. And so I appreciate the time. I don't want to hold anyone any longer because drinks are on Jeff. And thank you. Appreciate it.
All right. Thank you.
Of Bitcoin for Corporations here at Strategy World. Thank you so much for coming. We also really appreciate BitGo, which has been our room host today. The panels and sessions start again tomorrow at 9 a.m. in this room, so we look forward to seeing you. And next up, we're going to have the Strategy World Party. That's at XS at 7:15. But before you leave, if you haven't submitted your questions for Phong Lee and Executive Chairman Michael Saylor, please do so. You can actually scan the QR code that's on the tables. Please submit your questions. We're going to be doing that live Q&A tomorrow at 4:45. Have fun tonight, and thank you so much for joining us.
Fueled by them to see the horizon, turn us to thousands, and we'll grow.
Good afternoon, everyone. I'm Natalie Brunell, author of Bitcoin is for Everyone, and I'm honored to be here with all of you. If you've been to Strategy World and Bitcoin for Corporations before, then you know that this isn't just another conference. This is where the leaders putting Bitcoin on their balance sheets come together not to catch up, but to push forward. And that brings us to our keynote. Agree with him or challenge him, there is one thing you cannot deny about our next speaker. Founder and executive chairman Michael Saylor doesn't borrow his beliefs from the room. He brings them into the room. For more than 3 decades, he's been a builder at the highest level, taking a startup and turning it into a category-defining enterprise. But over the last few years, he's done something even more rare in corporate history. He's led a public company through this era of monetary uncertainty by making a decision that was radical and to many unthinkable at the time. He chose a new foundation, not as a trade, not as a headline, but as a strategy. And he didn't stop there. Through the introduction of innovative digital credit instruments, he showed the world that Bitcoin isn't just an asset you hold. It's a way to unlock capital, give every investor a seat at the Bitcoin table, and redefine what corporate treasury can be. The results have forced the world to pay attention, because in an environment where most leaders are just trained to optimize for quarters, Michael Saylor has the courage to think in decades. He has a gift for taking big, complex ideas, money, energy, technology, freedom, and turn them into something you can feel in your bones, a call to build something that lasts. He will challenge you, he will entertain you. He'll drop a line you'll repeat at dinner tonight, and maybe quote for the next 10 years. So if you're taking notes today, here's my suggestion. Don't just listen for what he thinks Bitcoin is. Listen for what he believes your company can become when you stop optimizing for short-term comfort and start optimizing for long-term strength. Ladies and gentlemen, please welcome the founder and executive chairman of strategy, one of the most visionary voices in modern finance and technology, Michael Saylor.
Thanks for joining me today. This talk is about everybody's favorite subject. I'm going to speak with you about how to make money. Literally, how to make money. How to make money for your family, for yourself, for your company, for your public company, for your country, for everything you love. And specifically, I'm going to talk about how to make money digitally. And the title of the talk is Digital Credit, but really, this is about a revolution in the way we think about money. So let's just start with the subject of digital credit. You know, what is digital credit? Well, digital credit is built on digital capital. Well, digital capital is Bitcoin. How do we create Bitcoin? Well, we put together a bunch of technologies that were available, proof of work, public key cryptography, peer-to-peer networking, distributed timestamping, some semiconductor technology. And of course, the fundamental question is, what is Bitcoin? And people debate this ad infinitum, but it just seems quite obvious. It is digital capital. What is digital capital? Well, it's economic wealth stored digitally. What is economic wealth stored digitally? It's the ability to move something of value somewhere else on Earth over a digital rail, right? People oftentimes ask, well, what's the use case? What's the value? Well, the value is if I can send $1 billion from here to Tokyo, that's valuable. Try taking $1 billion of land out of Tokyo. Try to take $1 billion of gold out of Tokyo. Try to remove $1 billion worth of companies from Tokyo, or $1 billion of mineral or oil and gas rights from Tokyo. You just can't do it. On the other hand, you can move $1 billion of Bitcoin into and out of Tokyo, and if you can do it, a computer can do it, and AI can do it. And so it seems very straightforward in the world of digital, that if everything we've got that's digital is better, whether it's digital photos or digital music or digital video or digital communications or digital intelligence, then when we finally have digital wealth, digital capital, it will be the basis of something that is extraordinary and beautiful. And Satoshi gave us this. The truth is, there's nothing deeply complicated about it. It's just putting together, it's an engineering breakthrough, putting together a bunch of techniques that were readily available and well-known in the day. It was the way that it was used that was an extraordinary breakthrough. Digital credit is very similar. There's nothing deeply complicated about this. What we're doing is we're taking a common thing, a publicly listed company, a public security, a capital asset, digital capital asset in this case, a preferred security, the idea of a monthly dividend that's variable, and a tax treatment, return of capital, that's been around since 1910, and then an ATM actively managed. And you put together all of these components, no one of them is all that difficult. You pretty much could understand them if you're a sixth grader. You put all of them together, and you create something which is much more than the sum of its parts. You've created an extraordinary breakthrough in the entire world of credit. We call it STRC, STRC. What is our company doing? What does strategy do? Our company is converting capital into credit. We're converting economic wealth into a stream of cash flows. That is the big breakthrough. You need an operating company in order to take a block of economic energy and turn it into a currency, peg it to a currency, strip away the risk, damp the volatility, extract the cash flows in the form of yield, and compress the duration to now. I don't want to wait 30 years to get rich. I just want you to give me money every month or every day forever, consistently, without risk. The former, right, is a capital investment. I buy a big chunk of Manhattan and I wait 30 years and maybe I get rich. The latter is a bond, or is it a money market account? So this is all about conversion of capital into credit. And you might wonder, well, how did we discover stretch? Sometimes people ask us this, and this is the most poorly understood concept. Most people don't really think deeply about capital at the first order. But STRC is at the end of a long journey. I oftentimes say, we got a PhD in leverage at strategy. Well, let's just start with a basic question. How do I raise the capital to invest? If I want to invest in real estate for 40 years, where's the capital come from? If I want to buy gold and hold it for 40 years, where do I get the capital? If I want to buy Bitcoin and hold it for 40 years, where do I get the capital? Well, I'm going to tell you the easiest place to get the capital, and it's the worst place. It's an exchange. You go onto an exchange and you use exchange leverage. So I post $100 and I do a 50x levered Bitcoin buy. And when you lever up 10 to 1 on an exchange, they loan you $1,000 of capital against your $100. And when you lever up 50 to 1, they loan you $5,000 of capital, right? And of course, that's DeFi, that's crypto. People think this is a wonderful thing. If you look at my chart, you can see exchange leverage is 1 hour capital. If you think about the credit terms, the risk factors, the covenants on the credit, and the optionality that you have for the credit when you enter into the relationship, and you ask the question, how long do I have the use of this capital on a probabilistic basis? Well, the engineer would say that's the stochastic duration of the capital. What is the stochastic, the likely time frame I have the use of the money for? Well, on an exchange, you might have that money for an hour. If you lever up 50 to 1 and Bitcoin trades down 2%, you're going to get margin called. They force liquidate you, and you get all your capital ripped away in an hour. So on one extreme is very short duration capital. What's the next big idea? Well, I do a margin loan. I borrow the money under Reg T, or I do asset-backed financing. I borrow against my Bitcoin or borrow against a stock or an asset. How long do you have the capital for? Well, when you get the margin call, you've got no more than a day. You might have 4 hours. But that's about 1 day capital. That's like repo financing. When you read the history of long-term capital's bankruptcy or Lehman Brothers bankruptcy, the reason they're bankrupted is they were financing $100 billion or hundreds of billions of dollars of long-term investments with 1 day money. Right? Okay, you invest the money for 10 years and you have the use of the capital for 1 day, and you think, what could go wrong? Okay, that's a duration mismatch. Well, we had some of that. We had a Silvergate loan where we actually borrowed from Silvergate, and when Bitcoin crashed, you have to post more collateral. That creates extreme anxiety for your equity investors. It's reflexive it'll unwind your company. That's why it's not a great idea to do asset-backed financing. The next idea is senior debt. You go and you borrow money from a bank, or you borrow money via a bond that has covenants. Well, I've actually marked it stochastically as about 1 year money. And you're like, well, if it's a 5-year loan, why do you think of it as 1 year money? Well, the term is 5 years. The covenants are checked every quarter. You might get to the end of the quarter where you break the EBITDA covenant or break a lien of some sort, at which point either the loan comes due, it accelerates, or the covenant prevents you from accessing the capital markets anymore. So you have lost the ability to raise additional capital because you tripped over a covenant. That means in order to grow the company, you have to pay off the loan. So you thought you had you have a 7-year loan, but you have to pay it off in order to raise any more money if your EBITDA ever falls by 2%. So it's kind of a banker trick where I pretend I'm giving you a 7-year loan, but it's really a 7-week loan because I know you're going to have to continuously refinance it. So senior debt is actually stochastically much shorter duration than you would think. Junior debt is like a junk bond with no covenants. You've just got a big interest bill, and so you've got it a bit longer, but it's still very expensive. Convertible debt is a bit longer because you've got a very low coupon. Maybe you've got a 0 coupon or 1% coupon convertible debt. You can carry it for 5 or 6 years, but eventually you have to pay it back. So convertible debt is a little bit longer duration on a probabilistic basis. But as you can see, as we march through these debt capital, we find something better. If you ever credit default, if you default on your interest bill, if you can't refinance, or if you bust a covenant, you lose the capital. In the extreme case, the equity goes to 0. The company's bankrupt, right? That's very dangerous, if not toxic capital. When you get to equity, right, if you look at a senior preferred like STRF, well, you have the money for a while, but you've got covenants and you've got penalties if you don't pay the dividend, so it's a little bit longer. But it's better than debt, but it's not as good as junior prefs. The junior pref doesn't have the covenants, so you've got more optionality, fewer covenants, longer capital. The convertible prefs have a lower cost, fewer covenants, longer capital. And then when you get to a variable preferred, what's going on is the optionality is exploding. You're getting more optionality. You don't have the option to vary the coupon of a bond, but you do have the option to vary a monthly dividend. So as the optionality explodes, the duration lengthens. And so of course, the last form of capital is equity. I sell $10 million of equity, I have the money forever. Well, from a net present value point of view, that means I've got economic benefit for about the next 100 years before the benefit becomes third order. So if you look at the table, you can see if you want to invest for a long period of time, you'd really like to use equity. But if you can't get the equity, what's the next best thing? Well, it's variable preferred credit. We discovered digital credit and stretch because we kept moving out this curve of risk, and we found what we thought was the longest duration capital other than equity. Now, what is digital credit? It's solving the investor dilemma. The dilemma of the investor is I either get double-digit returns and I get deferred tax treatment on equity, and I take large volatility, large drawdowns, and I might lose my capital. Or I buy credit where I have principal protection, low volatility, but I lose the double-digit returns, and I have to pay ordinary income tax, or I have to pay capital gains tax every time I receive anything in that year. So what if you wanted the benefits of equity and the benefits of credit, and you wanted to get rid of all the liabilities of both? What we did with STRC was created this instrument which gives double-digit returns, deferred capital gains tax treatment, low volatility, principal protection, all at the same time, right? And that's the big unlock there, right? You don't have to make a compromise. And who's it designed for? Well, it's definitely designed for retail investors. It's also designed for corporations, but you can also offer it to an institutional investor, a hybrid investor, or a crypto-native investor. So there's lots of different classes of investors that might want this. In the process of building the longest duration credit, we inadvertently discovered that all of the dividends for that credit are return of capital dividends. There are three types of ways to tax credit. You either tax it as ordinary income, and you got to pay income tax up front, or it's taxed as capital gains, or it's taxed as a deferred return of capital. You don't have a tax on it. Well, in order to create return of capital, you have to have a treasury company that doesn't have positive earnings and profit that would create a tax liability that you'd have to pass on to your credit investors. So what we discovered was we could create credit where the tax benefits go directly to the credit investors instead of accruing to the issuer. And because as an issuer we don't actually generate taxable cash flows, we don't need the tax benefit. Most credit created by companies was always to the benefit of the issuer, to the detriment of the investor. And we stumbled upon a new idea. What if we created credit which was the benefit of the investor? The best credit. The credit becomes the product, not the means to the product, right? Well, so you create this, and now the issue is, how do I assess the digital credit? What's the mathematical framework for assessing credit risk? And really, we created three metrics. BTC rating is the amount of collateral coverage. Like if you're BTC rated 5, it means you got $5 of equity for every $1 of credit outstanding. BTC risk is the probability that you get under collateralized at the end of the term. If you have $5 today, will you have only $1 of collateral at the end of the term of the credit, to pay it back, if you had to pay it back? And then if you calculate that BTC risk, you can back into a credit spread. What is the fair credit spread above the risk-free rate that you have to pay the investor to offset the risk, right? So there are simple formulas here for people that like formulas, but maybe the bigger point is the credit spread of investment-grade bonds today is 78 basis points. That means you're getting paid 0.75% more than the risk-free rate in order to take the credit risk of a company like Apple or Microsoft. The credit spread of junk bonds, or high yield, I guess, is 288 basis points. So those are the two benchmarks worth looking at. And now we move to the theory of asset-backed credit. What is it? Well, the idea is I buy a capital asset that's going to return 30%, and I strip off the first 11%, and I pay it to the credit investors. Maybe I buy the S&P index, I expect to pay 12%, I strip off the first 6%, and I pay it to the credit investors. If gold is going to appreciate 10% a year, I could create a preferred instrument that pays 5% a year and pay that to the credit investors. So, logic says you're not going to pay a dividend greater than the return of the capital asset over 100 years. That you're going to eventually run out of collateral. But you can certainly pay a dividend rate lower than the ARR of the capital asset. And that takes us to the question of what's really going on here. It's signal processing. Okay, digital capital is highly volatile, growing in a rate. If you look at that chart, that orange line kind of looks like the Bitcoin price chart if you've looked at it over the past 10 years. It's doing this. The credit line is what most people want. People don't want to get rich suddenly in the distant future, unexpectedly, after a roller coaster ride. What they want is to get risk steadily with very, very low volatility, no anxiety. They don't want the fighter jet, they want the jumbo jet airliner, and they want to recline in first class while they go to their destination. So digital credit is just stripping out that smooth 11% out of that very volatile 30%. Now, where does the excess volatility go? There's a conservation of energy. Conservation of volatility. So if you want to take a 30% roller coaster ride and strip it down to 11% jumbo jet luxury ride, then you have to put the volatility somewhere else. So what you can see is the excess volatility goes to common equity. And what I've just shown you is basically digital equity, digital capital, digital credit is completely digital stack. It's changing every 15 seconds. In our case, the equity is MSTR. It's up 52% ARR. The capital is Bitcoin. We expect to be up 30%. The credit is the STRC. Now, what's the highest yield you can pay on digital credit? Well, if you expected 30%, then you have to plug in the collateral coverage, what's the BTC rating, what's the duration, what's the volatility. Once you plug in your assumptions, what pops out is, well, in this case, I can pay 15% and still stay investment grade on that assumption set. You go up to 23% and you're still in high yield. But there is an envelope of dividends you can pay out, or a dividend ratio you can pay out, that's just a function of the volatility and the performance of the underlying capital asset. So what's this chart show? This chart shows if you're a skeptic and you think Bitcoin's going up zero, there's a very small amount of credit you can create, and most of it is low dividend yielding, and a little bit of it is 5 to 10%, and a very small amount is more than 10%. If you think Bitcoin's going up 10% a year like the S&P, you see you can issue a lot more credit and you can have a bit more flexibility on the dividends. As your view of the capital asset, whether it's gold or Bitcoin or real estate or the S&P or whatever, as your view of that improves, as you think it's going to improve over time, your ability to issue credit and higher yielding credit is enhanced. And you can see what's going on here. If you're a bull and you think Bitcoin's going up 30% a year, you can see you can issue quite a lot of high-yielding credit that is investment grade. That's the big idea here, if you're staring at this. And of course, if you think about high yield, right, you're willing to accept a slightly higher risk instrument, then you can create a lot more credit. You can create exceptional amounts of credit if you think Bitcoin's going to appreciate faster than the S&P. And of course, if you're a Bitcoin bull, you can see you can issue monstrous amounts of credit, even 1x collateralized at this level, right? And so the amount of credit you can create is really a function of those variables. Now, so how risky is STRC? What is stretch? Well, I put it on the chart. If you're a Bitcoin skeptic and you think Bitcoin's going up zero, it looks like distressed debt. If you think Bitcoin's, a 10% grower, it's almost high yield. It's like kind of suboptimal high yield. But then as you start to have a better view of Bitcoin, it starts to float into the high yield. And then, of course, if you're a Bitcoin bull, it's investment grade. And so what I've laid out here, we call the theory of digital credit, but really it's just the theory of asset-backed credit. You could do the same exercise with the S&P index, Mag 7 stocks, NVIDIA stock, gold, real estate. Now, why haven't people? Well, because the Investment Company Act of 1940 prevents you from levering or capitalizing a publicly traded company on equity portfolio or securities. So no one does this in the public market on securities. You'd have to go to gold or real estate, and the performance in gold and real estate has just been not compelling enough to be worth the trouble. Bitcoin is the first time when you have a non-security asset which is outperforming the S&P where it's worth the trouble. And that takes us to the question of, well, what's the performance of this stuff anyway? Well, since the all-time high 4.5 months ago, Bitcoin's fallen 45%. That's the capital investment. If you're a capital investor, you got no dividends and you lost 45% of your wealth. Just wait for 10 years, you'll be fine. I'm okay with it, but your 3-year-old's not okay with it. On the other hand, look at STRC, right? STRC is for everybody else. It's actually lost 0% of its value. It's paid 4.5% in dividends through a very bad, big capital market drawdown. Since the beginning of the year, same story. STRC holds its value and pays a dividend. Bitcoin's down 25%. Do people want this stuff? Well, it's trading 130x more liquid than the average preferred stock and 1,000 times more liquid than the over-the-counter preferreds. This is, in fact, the most successful, most liquid preferred stock probably in the entire century. Okay, and this is 6 months old, right? And I would love to tell you we knew what we were doing, but what I just showed you was we were running from risk, from credit risk, until we got to prefs, and then we were chasing after the ideal product until we got to stretch. And so at the end of our journey, after trying 10 different things, we found the 11th thing, and then the market told us they liked this. We didn't know that they'd like this. Stretch is seasoning, the health keeps improving. Here what you can see is that each month that goes by, it spends more and more time in its target range. The volatility strips off, it holds its principal value much higher. And so what are we competing against here? You're competing against a multi-trillion-dollar universe of credit instruments. Most of them yield 3-4%. Most of them have long duration. The world of credit hasn't changed much in 50 years. You're trapped in the 20th century. Most credit instruments are created by issuers whose objective is to pay you the least amount they can with the worst tax treatment. Right? When a conventional credit issuer issues credit, they're keeping the tax benefit to themselves. They're minimizing what they pay you. And the irony is when it's over the counter, it's illegal for you to buy it. Huh? Say that again. Most credit, it's manufactured to be awful, very tax inefficient, and it's illegal for you to buy it. Well, why does that even happen? That's just the way the world was 30, 40, 50 years ago. What we've done is flipped it on its head, and our view is, well, we actually want to pay you the highest possible dividend, make it tax deferred, and make it easy for you to buy it, right? That is the credit revolution. So why do you have to wait 10 years to find out if you get paid back? I mean, strip the duration down to a much shorter amount, increase the dividend, and then make it easy for the individual. So what's the tax equivalent yield on this? If you're a company, well, let's just start with the number. It's 11.3%. If you're a company, that's the same as getting paid 14.3% because you don't have to pay corporate income tax on this. If you're an individual in Miami and you are able to defer the 37% federal income tax rate, it's like a tax equivalent yield of almost 18%. How does it compare to everything else? Well, you can see it's anywhere from 50% to 4 times better than all the other credit in the world, right? And the next best thing is like private credit, which is sort of illiquid, and it's half as good for a taxpayer, and it's 60% as good for a non-taxpayer, just on the basis of yield. What if you're lucky enough to be an individual living in New York City? Okay, digital credit is like a bank that pays you 23.3%. If you live in San Francisco, it's like a bank account that pays you 22.6%. Okay, so as you can see, this is, 4 or 5 times better. Okay, what else did we discover? Well, when you create an instrument like this, it's return of capital. It means that you collect a dividend, you defer the tax on the dividend, you reduce your basis in the instrument, and after 10 years, you've reduced your basis from $100 down to 0. If then you die and pass this on to your heir, they get a step up in the basis, and it steps up to $100, and they can start the same depreciation again. So you actually get the benefit of shielding your 10 years of dividends, and then your heir gets to shield another 10 years of dividends. Now, I'm not suggesting that you run this on 10-year cycles. But what I am suggesting, more to the point, is the difference between investing $100 in a T-bill and holding it 20 years versus investing $100 in Stretch and giving it to your heir and them holding it 20 years is, at the end of the 20 years, your heir has $922 of Stretch, and their income each year is $100 versus $3.75. You literally have 25 times as much income after 20 years. If you're interested in generational wealth transfer, this is an incredibly powerful vehicle, right? It's so powerful it kind of makes you sick to think you might pursue the alternative. And if you're a company, you can see that, your choices collect 3.6% from a money market, or the equivalent of a digital bank that pays you 17% in New York City. So, who are the real disadvantaged players in the credit market? It's the individuals that pay their taxes and operating companies. Because your nonprofits, your endowments, your insurance companies, they just don't pay tax. The government doesn't pay tax. So if you actually work for a living, or your company works for a living and does stuff, you're the one that benefits from this kind of instrument. And You know, we've gone around the world talking to companies about buying Bitcoin. Well, what I've concluded is that Bitcoin for corporations is stretch. Like if you go to most companies with hundreds of millions of dollars of capital and working capital, it's probably easier for them and better for them to buy stretch than it is to buy Bitcoin. It's very difficult for them to convince the board of directors that they should buy a 40 vol asset that with no cash flows, that they have to market every quarter because it might screw with their P&L. But on the other hand, convincing the board of directors that they should actually collect 2 or 4 times more cash flow and not have volatility, that's easier. It's like, instead of you taking $100 million and buying Bitcoin and getting on the roller coaster, just give me the $100 million. I will accept all the risk. I will accept the roller coaster. I'll over-collateralize it. I will give you the 10 or 11% yield back. I'll solve the tax problem. And I promise not to sell the Bitcoin. And so we're in the business of not selling Bitcoin. We got very good at it. We have a PhD in hodling, you know? And so I figure, why don't we just hodl for the thousands of companies instead of try to convince everybody else to do what we're doing and convince their shareholders and their board of directors? So then you see this chart, right? And what is this saying? Look, if your time horizon is less than 4 years, you need the money in 12 months. You need the money in 24 months. You need the money in 6 months. You need the money to make payroll. That's working capital. You put that into a credit instrument like stretch. If you don't need the money for 4 years, if you're a capital investor and you've got a 10-year, 20-year time horizon and you just want to get wealthy, well, then you either buy digital capital, which is Bitcoin, because there's no counterparty risk, and that has the most optionality, or you buy digital equity, amplified Bitcoin, like MSTR, because there you're getting more Bitcoin. But you have to have a long time horizon. 4 years is the minimum, in my opinion. 10 years is a healthy, or 7 to 10 years is the right time horizon for that. And of course, what you see, which is not disputable, is there's not a person in the world or a company on earth that doesn't have capital they need in the next 4 years. There's a huge amount of capital that's tied up in making payroll or paying the annual bonus to the salespeople at the end of December. It's like, I've got it sitting on the balance sheet. I'm generating 2% after tax, but maybe I'd like to get 10% untaxed, right? Maybe I'd like 5 times as much. And so what's the impact of actually allocating a corporate treasury to stretch? Well, you can see here, if you put 35% of your treasury into STRC, you double your cash flow. It doubles the cash flow of a company to put 35% in. If you're a public company, you probably don't want to go above 40%, but if you're a closely held private company, you could go to 60, 70, 80%. The difference between holding T-bills and holding stretch is 2.9 million versus 11.3 million a year. Right? It's not quite, it's almost 4 times as much cash flow. And what about the rest? Well, look, I was saying to a company that's in the Bitcoin space, I said, you know, you're in the Bitcoin space. If Bitcoin goes to 0, you don't have much of a business. So that being the case, you've already absorbed the existential risk of Bitcoin going to 0. So rather than collect 2.9 million a year, why don't you collect 11 million a year? Right? You might as well make 4 times your money. You've already accepted the Bitcoin existential risk. So for people that believe in digital capital and digital assets, it's a no-brainer. Just quadruple your treasury or double your treasury yield. That takes me to the issue of digital money and digital yield. So I told you I'd show you how to make money. Okay, I'm not saying just buy stretch as an individual or your company should buy stretch. Those are the 2 obvious ways to make money. But what we've observed is you can take digital credit and you can use it as the building block for digital yield and digital money. You can step it up or step it down. It's like sucralose. It's a universal sweetener, right? It is the active element of money making. So we've got a product which is 11% with like a vol of 10 to 20. You can cut it in half and you can create an instrument that pays 7.5% with much lower vol. Or you can double it or triple it, amp it up in order to create something that pays 18% or 24%. Okay, so I can dial it up and down, but let's take this idea a bit further. Stretch's digital credit. Digital money I would define as zero volatility, daily liquidity instruments. If you give someone zero vol and liquidity every day, you've created high-powered money. Digital yield is non-zero volatility or illiquid. There's nothing that says you can't lock up the money for 3 months, lever it 2 to 1, right? And maybe strip the vol or leave the volatility, right? You can do that as well, but I wouldn't call it money, I would call it yield. Now, the big idea is digital credit is programmable. And most people think programmable means like, oh yeah, I want to like do something computery with it. No, I've got a much bigger idea for you. Programmable means I take the credit and I turn it into a token, a private fund, a public fund, an ETF, an ETP. I make it a bank account, I make it a crypto account. So I turn it into a type of credit. Then I put it on a platform, the NASDAQ, the London Stock Exchange, Solana, Ethereum, Binance, Coinbase, Base. I put it on Aladdin, I put it on a Fidelity mutual fund system. I offer it through Morgan Stanley or JP Morgan's private wealth, system, or the Merrill Lynch system. There are a lot of different platforms I can put that on. Then I decide how much volatility I want. Turn it down to 0, turn it up to 25. You can strip the vol by creating a volatility buffer or a volatility reserve, or you can leave the vol or amp the vol. That's a decision, right, you make. Then liquidity, right? You can offer people hourly liquidity. You can even turn the yield into streaming yield. Stream the yield every hour, every day, every week, right? So, or you can turn it into it's a private fund. It's a 7-year duration, and we'll give you the ability to extract 10% of your capital every quarter. Or you can create liquidity or staking. You can stake it, by the way. If you think about the DeFi idea, you can stake this for 30 days, stake it for a year, you can lock it up, you can unlock it, and then you decide how much yield you want. I mean, probably you're not going to crank it down to less than 5 or 4% yield, although, the guys at Hope, they said, well, if we just take European money markets and we add 10% stretch, we go from a money market that pays 200 basis points in euros to 300 basis points in euros. 10% makes it 50% better in Europe, right? So you could actually create something which is a world beater, right? Even with a small increment. It's like, how much sucralose do I have to put, sugar or whatever? How much do I put in the food or salt to actually make it taste good? So you can crank the yield up to 30%. You can crank it down to 3%. You can convert the currency to yen and euros. These are all opportunities to add value. And then once you've done it, right, then is it a fund? Is it a coin? Is it an account? Right. How about your bank just pays 8% to everybody tax-free, right? I mean, what was the big idea? Just wire me $100 billion. I pay 8% instead of, JP Morgan pays 2% after tax. Well, are you going to do anything else? No. Just that. It's like my message to the Emiratis. It's like, the UAE has a $250, $300 billion a year gross national product. Why don't you just have, banks in the Emirates pay 8%? People will wire you $10 trillion, take 100 basis points of that, and now you just increase the gross national product by 50% with 12 people. Well, what are we going to do? We're just going to collect their money. It's like too simple, right? But oftentimes what you'll find is people will jump through hoops and juggle chainsaws and feel like they're making progress. But when you give them the simple idea, it's like too good to be true. Like they're afraid to do the simple thing. Yeah, we'll just offer the bank account that pays you 8%. So with that, the digital credit ecosystem, it is emerging, right? Layer 1, we can't take credit for. That's Bitcoin. Layer 2, we're in the business of creating that credit instrument, right? What are we going to do at our company? Well, we're just going to build the AUM of Stretch as high as we can, build the liquidity as high as we can, laser-like focus until people have $1 billion a day of liquidity, $2 billion a day of liquidity, $5 billion a day of liquidity. Strip the vol as low as we can, but we're never going to be able to offer pure digital money or digital yield in every possible flavor or package on every platform, nor do we want to. So the layer 3 is that digital money, digital yield layer, and we're already seeing an exploding ecosystem of partners, Buck, Saturn, Apex, Hope. It's very exciting. If you've got a Bitcoin treasury company, you got $500 million, and you're trying to figure out what do you do next, create an ETF, upgrade and wrap stretch with it, and then get the license to be the first company in your market to be able to offer this digital monetary or digital yield instrument, right? So it's a license to print money. How do you make money? Well, offer 5-6% digital money in Japan to everybody and take 100 basis points off it. And that leaves me with, the result of all this. If you go about the process of creating digital credit, then you create value for the digital equity. So MSTR is digital equity. You can see for the past 5.5 years what's going on, right? Bitcoin is outperforming the S&P in gold. MSTR has amplified Bitcoin. If you can sign up for the vol, you can actually get the reward. Now, amplification creates volatility. How much? This is the top 10 company, the most volatile companies in the S&P 500. I'm showing the top 10 to you, right? We're number 3, right? There are 2 companies in the S&P that are more volatile, but here's a more important chart. What you're seeing there is the absolute open interest, where we don't have the highest open interest, but we're one of the top 15. But what we are is the number 1 open interest, market cap adjusted. So in terms of the relationship of open interest to the underlying market cap, we are the most intensely interesting company in the S&P universe. And if you look at the bottom chart, that's showing trading volume, liquidity. And what you can see is we're the most liquid equity in the entire S&P universe. Okay, so did we actually spend money to get that? No, we didn't spend a dime. We spent no money to become the most liquid, most interesting company in the entire S&P 500 universe. That is the result of creating digital credit on digital capital, right? And what is the use of the capital? The use of the capital is to create the credit. What's the credit do? The credit creates amplification. The amplification creates Bitcoin per share. The Bitcoin per share creates the equity premium. It is the function of the company. And if you turn up that amplification, you can double the Bitcoin per share over 7 years. You might triple it over 7 years. So if you're the equity investor, you're buying a company that generates Bitcoin per share. If you're the credit investor, you're buying a credit instrument to pay US dollar yield. But it's just a very simple swap of Bitcoin yield for US dollar yield. You can't have the one without the other. But as you can see here, this is a very powerful model. And the way it works out is once you crank up the amplification, you can expect to outperform the Bitcoin by anywhere from 30% to 100% or more, and have a heck of a good time while you're doing it. It's definitely very interesting. For those of you interested in the relationship of amplification to growth rate, here it is. It's not very complicated. And on the subject of digital, it's all recorded. You can download that, and you can screenshot that and study it. CJ will probably do 1-hour podcast on that formula. Ask him. The big idea of digital is every 15 seconds we're creating value. Okay? In 15 seconds, we might sell $10 million of credit, buy $10 million of Bitcoin, increase our capital by $10 million, loop, rinse, and repeat. We are synchronizing the capital and the credit. How do you build a $10 million building in 15 seconds? Right? We're doing it without people, We're doing it without labor. There's no tractors, there's no bulldozers, there's no land, there's no expensive long-form contracts, right? You don't have all of the friction of the world, right? The reason that digital equity is so compelling is because you're creating digital property, digital capital, and digital credit instantly in a synchronized way, friction-free, in cyberspace, in digital space, in financial space, if you will. And that makes it the most transparent, most efficient, most compelling type of credit. And so what are you going to do if you, look, if I could snap my fingers and I could build a digital building in 1 second, don't you think I would probably sell it to you cheaper than the guy that took $1 billion to create an actual building in 10 years? If I can do this, I can give you a better deal. So what are we doing? Well, we're just making sure the credit's twice as good or 4 times as good. We can pay 4 times as much because we have the most efficient credit generator in the world. And I will just end with this thought of the reflexive flywheel. It's not complicated, but it's the credit creates the amplification. The amplification from the credit creates the volatility. That's what creates the open interest in the options market. All of that creates enterprise value. You're doing something, you're accumulating capital, and the capital increases the size of the enterprise. The capital we're gathering is going into Bitcoin, creating capital appreciation. We're appreciating the value of the Bitcoin network. You can't buy $55 billion of Bitcoin without the value of Bitcoin being higher than if you didn't buy the $55 billion. We're also putting capital appreciation on our own balance sheet. The credit creates the equity premium. How are you not a Bitcoin holding company? Well, we're doubling our Bitcoin per share. Well, if you double your Bitcoin per share, I'll give you 100% premium, right? If I'm an equity investor, I have to have something to believe in. You're doing something. The credit business creates the equity premium. The equity premium attracts more capital. The credit thereby attracts new investor base. You get credit investors. You get retirees, and corporate treasurers. They wouldn't have bought Bitcoin. New investors. That diversifies all the macro correlations. The business is going to trade versed on the junk bond index or the investment grade index or the forward yield curve or the euro versus US dollar index or the relationship of Bitcoin to gold or people's forward view toward Bitcoin, or their view toward big tech or macro or something, or maybe they just get excited about the future of digital credit. You've got a lot of different correlations. Each of those attracts new pools of equity. All of those things strengthen the brand. Everybody wants to talk about you. The brand is who wants to talk about you. So you're continually building awareness. And that creates optionality, right? We have the option to sell the credit, not sell the credit, raise the dividend, lower the dividend, right? The more optionality creates more volatility, creates more equity premium, and that creates trading because people disagree with you. It's like, I think it's a bad idea. I think it's a good idea. I'm going to short it. It's too cheap. It's too expensive. Well, I don't mind if people short $50 billion of the instrument, they got to buy $50 billion of the instrument back at some point. That's creating the liquidity. That creates credit. In this particular case, the credit attracts credit. And what I mean by that is people are more likely to offer you loans against the stretch or against the MSTR because of the liquidity in the instruments, and that attracts more capital. All of that brings arbitrageurs who think that someone mispriced something and they want to sell that to buy that and hold that and then get rid of that. And every guy with a Bloomberg that thinks he's smarter than you are, and maybe he is and maybe he isn't, but it doesn't matter, right? I mean, because they're bringing capital to the party. The entire thing is just a massive reflexive flywheel because the more stretch we sell, the more Bitcoin goes up in price. The more stretch we sell, the more MSTR capital grows. As capital and MSTR grows, liquidity grows, we raise more equity capital, the Bitcoin price goes up. So we're driving MSTR, driving Bitcoin, driving stretch, and of course, soon to be driving this entire ecosystem of digital money and digital yield. everybody that's upstream to us, levered to Bitcoin, is in the ecosystem. Everybody downstream to us, levered to Stretch, is in the ecosystem. Who are we competing with? None of those people. We're competing with under-collateralized junk bond issuers that are going out of business in 6 months that are offering you 5% yield, and somebody's buying that garbage, right? And so, yeah, at some point, really distressed credit issuers or illiquid private credit, they will find it harder. Look, now, nobody's going to stop buying T-bills because of this stuff. You don't got to worry about that. We're not competing with the U.S. government. We're competing with the marginal borrowers issuing illiquid, low-yielding, tax-inefficient junk bonds, high-yield bonds, private credit, and other types of garbagey credit instruments. And then the ones that sell things over the counter that you can't legally buy. And we're actually making it available to you. So who wins? The world wins. The digital asset economy wins. Everybody wins. And how big is the market? Well, there's $300 trillion of garbagey credit right now. And it's probably going to double over the next 10 years. So if you can get 5% or 10% of it, there's a $50, $60 trillion opportunity. What do we need? We need you. We need you to go tell people that this is an opportunity for the CFO or the treasurer. Tell your retired dad that maybe this is an opportunity to put in the retirement account. Talk to your credit investors. Talk to digital assets investors. If you run a business, think about getting rich off of this. Get the first license to sell digital money in Poland or the UK or France or the UAE or Japan or Brazil, or put it on a crypto network or put it in an ETF, right? What is the thing that everybody in the human race wants more of? Money. It's the universal utilitarian product. Everybody wants more money. So I admonish all of you to go out and make some money. Either make it for yourself or make it for your customers or make it for your friends and family. And do it because it's the right thing to do, and it could never be done before. And 30 years from now, everybody will have already done it. Thank you for your time today and for your support.